Morning, which probably explains why futures here in Europe are a little bit more positive, Tom.
Yeah, after modest gains yesterday in terms of what we saw across the European picture, just 0.2%. It was energy, it was financial services at the top of the list in terms of the sector-by-sector breakdown, as telecoms and utilities on the downside for European stocks yesterday. Futures then pointing to gains of 0.6%, pointing to a healthy session. FTSE 100 futures looking to add just 10 points. The outperformance could come through from the DAX. DAX futures pointing up by close to 190 points, up 0.8%. Anna, what are you looking at on an individual stocks basis?
Yeah, we've heard from a few corporates over the last 24 hours, and we have to factor in what they've been telling us, Tom. Let's start with the luxury space. LVMH, very much in focus, ahead of some other luxury earnings. The fashion and leather organic sales number, certainly disappointing, but some people are pointing out the Chinese business and the US business, the areas of future growth not too bad. So despite Middle East negativity, what do we see from the luxury sector? It could see some retreat at the start of trade. BP is certainly in focus. They are flagging exceptional oil trading gains as the energy price has been soaring, as we well know, and Publicis confirming its full-year guidance despite the macro context. So we will watch for movement in any of those stocks, Guy.
Okay, so we've got a lot to price in this morning, a lot to think about. Let's see exactly how the market is going to do that. Initially, we've got to price in a little bit out of the United States. Clearly, what is happening with the oil trade is going to impact London, the commodities story. Though BP, I do wonder whether its narrative, as Anna's just taken us through, will offset some of that. But the FTSE 100 is up by, let's call it 1/10%. How does the CAC trade this morning? What does the luxury story do? We'll have to wait and see exactly how that filters through. But LVMH is certainly a heavyweight in that market. So we'll work our way through that trade into the wider luxury space over the next few minutes. The DAX is called positive. The CAC is actually up 0.2%. The DAX is called very positive, though, this morning as the energy trade kind of feeds through there. We'll wait and see what the SMI does, but maybe a kind of midway point is the IBEX this morning. The Spanish market, Tom, up by 0.6%.
We're seeing upside that's coming through for the likes of copper, for the likes of gold and silver, and so basic resources is one of the gaining sectors, top sectors right now. I misspoke earlier, by the way. European stocks ended lower by 0.2% yesterday, but you did see the gains coming through for financials and energy. Today, basic resources near the top of the list, up 1.3%. Autos also gaining, a bit of a challenge session yesterday, so that's helping to lift the DAX then. The auto sector currently at the top of your list, up 1.4%. Tech is performing well. Again, guys been talking about the gains that come through for the semiconductor space, and you saw that in the Asian session as well. Tech today up 1.2% in the European session. On the downside, it is energy, of course, given that oil is below that $100 a barrel, and energy is down 0.4%. The biggest loser across your sector so far, Anna.
Yeah, absolutely. Interesting that basic resources is doing pretty well today. We've seen, some of the underlying commodities go higher because of supply constraints, aluminium being one of those. But elsewhere within the commodities space, there's a focus on the possibility of a longer-term peace deal between the US and Iran, and what that does to risk sentiment and sort of risk appetite, driving that particular sector a little higher. So there's a sort of number of dynamics, but they all add up to basic resources going higher this morning. And to answer your good question, Guy, about whether BP, how BP fares, it's given some really bullish guidance, but at the same time the oil price is weaker. Well, it seems that the latter is in the driving seat. That stock down by 1.4% right now.
Yeah, in some ways that makes sense. Like if you believe in the optimism, if you believe that things are going to get better from here, oil prices are going to go lower, and you're going to maybe sort of see that more broadly. And people trade these as baskets. Like in some ways it's hard maybe to sort of separate out the single stock story. Yeah, absolutely. And just to come to the luxury space, because we have consumer products and services now the worst performing sector, and the reason for that is LVMH down by just shy of 3%, and it is taking some of the other names within that space a little bit weaker. Certainly Christian Dior down by 2.7%, Hermes and Kering down
just a fraction of 1%, but we're waiting for more earnings to come through from the luxury sector. So we'll keep that in mind. Let's talk to Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, with us this morning to take stock of where we are. Peter, very good to have you with us. Thanks for joining us. So we've seen this narrative developing then in the last 24 hours, certainly, that with the ceasefire of last week, with the what seems to be suggestions that we'll be heading towards peace talks once again between these two parties before the ceasefire ends, there seems to be some optimism, some hope in the markets. Maybe stocks can decouple from what we've seen from energy prices. So is this a time to be loading up on US stocks? I mean, what's the Goldman Sachs view?
Well, our view is that the direction of equities is moderately higher at the index level. We think there's going to continue to be a lot of rotation beneath the surface, but we do think there's good value now in the US equity market. It's derated quite a lot, and underlying profits we think are going to remain strong. This will probably be the 6th quarter in a row of double-digit earnings growth in the US. So the multiple has come down from quite high levels. It's looking relatively attractive. And I think if we continue to see moderation in oil prices and some of the concerns about interest rate rises begin to fade, then I think we've got a reasonable degree of upside, and particularly in some of the things that have lagged behind in the market.
Okay, so what's got better for the US stock environment since the start of the war? Because oil prices are $30 a barrel higher still. We've priced out some of the rate cuts that we were expecting. So I wonder what looks better to sort of justify us prices going back to the levels they were at the start of the war.
Yeah, absolutely right. There has been a deterioration in the mix of growth and inflation. That's true for the US. It's true for other areas as well. But I think fundamentally, the strength of underlying profits is really what's supporting equities. Now, expectations are high going into this season, but as I said, this has been a long streak of double-digit profit growth, and a lot of that growth is coming from areas of the market that have actually derated. I mean, if you look at the US in particular, tech profits are probably going to be growing at 40% year over year. Roughly 90% of the earnings are coming from that sector, and yet it is derated quite sharply. So I think part of the recovery in the US and maybe other markets is in the rebound in some of the areas that have pulled back, largely not because of the war, but because of concerns about disruption coming through in the tech sector itself.
Are you happy with 20% earnings growth this year? Is that what the US is going to deliver?
I think it's going to be less than that. But
how much less than that?
I think more in the low double digits, but that's still a reasonable degree of growth.
The market's got much higher than that priced at the moment.
Well, has it? I mean, the multiple has come down in the US from 22.5 times down to 19 or so. And a lot of the biggest stocks in the market have derated more than that. So I think as long as they're generating decent profit growth, and some of the biggest stocks are going to be generating profit growth well above 20%, then I think that's enough to continue to support the equity market, to make moderate positive gains. I think a lot of the action in equities, as it has been in the last year, is really going to be beneath the surface, where we're seeing lots of rotation and lots of alpha opportunities and differential even in the same sectors.
Can the US, if the US economy is kind of starting to slow down, can that profit momentum remain?
It's slowing down, but from a very high pace. Sure. I mean, we're talking about growth, at the beginning of this year, around 3% at an annualized rate. That's above trend. It's certainly slowing, but we're still seeing positive profit growth and private sector balance sheets.
What's driving that profit growth?
Well, it's a combination of decent revenues. Remember, inflation is higher, so revenues are a function of nominal GDP, which has actually been quite strong, and still very, very good and healthy margins in a lot of the biggest companies which dominate the index. And that's been true in other markets, for example, in Europe as well, where you've seen a recovery in some of the sort of laggard, what we would call halo-type companies, those that in more traditional industries with heavy assets, but a lot of less competition for new degradation of those assets, and they're seeing stronger demand, and that demand in part is spilling out from the capex of the big technology companies.
It sounds like Peter's telling us that stocks are an inflation hedge.
Are they an inflation hedge? Are European stocks an inflation hedge, given the slower growth and the higher input costs for European corporates generally versus their US counterparts?
Yeah, well, again, massive difference between relative winners and losers, but in aggregate, you've got some higher inflation. Nominal GDP is still holding up quite well, And many of the more traditional industries, in Europe in particular, are enjoying a renaissance of demand, partly in relation to the desires to strengthen and build out energy infrastructure, as well as things like data centers, of course, but also in defense, which is increasingly a priority, not just for European countries, but for many others in the world as well. And that increase in spending is generating higher revenues and therefore also, in some cases, higher margins.
Where are you most concerned about margins beyond those sectors in Europe then?
Well, clearly in the areas that are around the consumer and that are very sensitive to higher input costs and commodity costs, because we have seen a very big rise in oil prices. That spills over into slower consumer spending and confidence, and spills out into some of the other areas that you were talking about, luxury, consumer staples, and so on. Many of them have got quite high valuations. So I think there are some really interesting opportunities that are arising in the market. I talked about tech. If you look at it globally, it has a lower valuation now than industrials, for example. That's quite unusual. And so I think there are pockets of areas in the markets that are looking really interesting. And so while we may not see very significant rises at the index levels, I think we're still going to see lots of opportunity for investors to differentiate across sectors and within sectors as well.
Peter, we're going to be heading into the European earnings season. We're already in it, I guess. We've had some of some large companies reporting. It might be too soon for all the sectors to give us a huge amount of clarity as to how war in the Middle East impacts their business, or even what AI can deliver on the more positive side. So what are the areas of focus when we speak to CEO after CEO on this programme? What would Peter Oppenheimer like us to be asking them and focusing on?
Firstly, I should say in Europe, profit growth is not going to be as strong as the US again. The expectations for growth, we think of around 4% year over year. Only around half the companies will actually report on a quarterly basis. But within that, again, you've got massive differentiation. You've got banks up, we think, around 7%, energy stocks around 17%. But if you exclude those, actually slightly negative earnings in Europe. And I think there are really two areas that investors are going to be focused on. One of them is the effect of rising input costs and to what extent that may be moderating margins, or in some cases actually helping to support or boost margins. And the other, of course, is AI and technology. What companies are utilizing it and beginning to see any benefits from it. And anything that gives us more clarity on that, I think, will be well received by investors.
I thought the US economy was all about the consumer. Isn't it all about the consumer? Isn't the consumer under pressure at the moment?
It is under pressure, and we've seen some moderate rise in unemployment and consumer confidence we saw in the Michigan survey. Not great at all. But bear in mind, from an earnings perspective, it's important for the economy, roughly 70% of the economy, but less so for the market. The technology companies are still the bulk of the earnings, and they, I think, are going to.
So I can ignore the economy and focus on the market. They can tell me two very different things.
Very different.
Do they at some point have to reconverge?
We've seen the same thing in Europe. We've seen a tremendous year or so of returns in Europe, albeit coming off from the highs during the war, but very little economic growth. So I think these two things can diverge, and it's important to recognise the different drivers of both.
So pretty significant double-digit profit growth in terms of the US picture on the earnings front, around 4% on aggregate year on year for Europe. What about the UK? Before we let you go.
The UK, I think, is going to have stronger profit growth, partly again because the composition of the index, at least the FTSE 100, is very positively correlated with energy costs, commodity prices, and so on. The banks also, we think, are going to do very well. Bear in mind the FTSE 100 is one of the strongest returning markets this year, up 6 or 7%, I think, at this stage. What's interesting is the FTSE 250 and the 350, which is more domestically focused, is very cheap, and I think is overpricing weakness in the economy. It's trading at around a 15th percentile of its historic PE, and that compares to most markets which are in the 80th or 90th percentile of their historic PEs. So the domestic market in Europe, I think, offers a lot of value.
We like to be gloomy here.
Yeah, in the UK, sorry.
We like to be gloomy here. Peter, great to see you. Thank you
so much.
Never gloomy. Peter Oppenheimer. Goldman Sachs Chief Global Equity Strategist. Let's take a quick look at the Core 6 and figure out what is happening there. LVMH is a feature that we are certainly watching very carefully this morning. It is down by 2.5%. Everything else looks okay. Chip stocks in particular. Look at what ASML is doing once again. Take a look at the SOX index over in the United States. It has been flying, so we are seeing positive performances there. Nova's not having a bad day either. But let's go back to that LVMH story and get a bit more detail with Chloe.
Good morning, Guy. Indeed, as expected, LVMH is down. It's down about 2% this morning after the sales of its fashion and leather goods unit, which is the most important division for LVMH, really disappointed investors this morning. And so analysts are saying that the impact of the conflict in the Middle East on sales is really overshadowing the progress that has been made in other parts of the business, with particularly actually quite a good performance in the US and China. But that is kind of taking a bit of a backseat compared to the impact of those weak sales in the Middle East. So a bit of weakness there for LVMH. It's also weak across the board for oil companies. They are reacting to oil prices being down because the US and Iran are considering further talks to extend the 2-week ceasefire that is currently going on. And so we are seeing weakness everywhere, including for BP, which actually just said this morning that it expects its oil trading results for the first quarter to be exceptional. But that was not quite enough to offset the impact of those lower oil prices this morning. On the other hand, a sector that's reacted quite positively to this optimism around the likelihood of peace in the Middle East is miners. And so we are seeing that across the board with with a green across the screen for those miners. And in terms of metals moving higher, gold in particular is moving higher after a couple of days of weakness. And so we are seeing Fresnillo and Hochschild Mining, 2 gold miners, react positively to that this morning. And finally, the chip-making equipment manufacturer BE Semi has received a higher price target from Bank of America. And so we are seeing that really boost the stock this morning, up almost 5%. We are getting the earnings next week, so that's also a name that we'll be watching out for.
Chloe, thank you very much indeed. Chloe Melly, of course, with some of the stocks on the move this Tuesday. Coming up, shares of LVMH, as Chloe was saying, lower this morning after sales results disappointed. What are the factors hampering demand then at LVMH? That is next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back. 18 minutes past the hour. Brent is dropping a little bit right now on the back of a headline that we're seeing from Reuters suggesting that the US and Iran could return to Islamabad for talks this week. Could return. One of the prerequisites seems to be the reopening of the Straits of Hormuz. There is no indication that that is happening. Crude is currently down, not at session lows, but we're down at kind of by 1.3% right now. So that's what we're seeing in terms of the market reaction to what we're getting on the geopolitical headlines. Let's talk a little bit about what we are seeing in the market this morning in terms of the sector story. Luxury under a little bit of pressure. Unsurprising, given what we saw from LVMH yesterday. Sales at the business's key fashion and leather goods unit falling at the start of this year. The Middle East conflict certainly hitting Louis Vuitton and Dior. Andrea Felstead, Bloomberg opinion columnist, joining us to discuss what is happening here. What do these results tell us?
Well, for me, they told us that the luxury recovery story is intact where it matters. Obviously, it's, sales have really been hurt by what's going on in the Middle East. But the US, no sign of the US consumer pulling back yet. China's fragile recovery seems to be going forward. In fact, in fashion and leather goods, the key division, both US and China improved in the first quarter compared with the last quarter of 2025.
Do you think that story is replicated by others in the space? I'm thinking of Kering, which reports later today.
Well, Kering has got this issue with Gucci, so we have to see whether
when does that become not an issue for Kering?
I think when sales start to go in the right direction, and I'm not convinced they are going to, because they've got their new designer Demna, and his products arrived at the end of February. A few of the see now, buy now from the catwalk show. Chanel's had a really strong response to its new designs. LVMH was saying Dior also is selling well from Jonathan Anderson's new designs. I'm not convinced the response to the Gucci products has been quite as exciting. So, I mean, I'm sure they will say they're selling well, but I don't think they're probably selling as well as some of the others.
Okay, so that's LVMH and Kering. We're also going to get numbers, I think, from Hermes. Is that Wednesday?
Yes,
Andrea?
yes.
Now, this is a business that has it almost been uncompetable with? I mean, such has been the demand and the long wait times for some of their bags.
Yes, it has. And now we are seeing that other people, particularly Chanel, are competing with it, which has raised a lot of questions about whether Hermes can continue to deliver. And it's going to be fascinating, because what we're seeing is the resale values for the Birkin and Kelly bags are starting to moderate. And when you look at the chart, you can see they really went up at the time of the luxury boom and have come down, which indicates that perhaps Hermes is a bit more cyclical and a bit more subject to the whims of the market than we thought it was, given those long wait lists.
Can I bring it back to your first point around LVMH and some of the fundamentals in terms of key markets?
Yes.
You're not worried about the Middle East. You saw a 50% drop in sales there. Not unexpected, given the conflict, I guess, but it was worse than estimated. But China is what I'm getting to, and whether or not you are confident now that China is materially back.
I don't think China's getting any worse. It's been sort of bumping along the bottom, I'd say, for the last 6 months, and there are signs that it is starting to improve. It's got an awful long way to go, but there are signs it is getting better. There is a bit more excitement around the new products, so it seems to be going in the right direction. The worry is that some of the issues from the conflict spill over to inflation, slower economic growth, and that hurts not only China but the US, where was particularly vulnerable to stock market swings.
Andrea, thank you very much indeed. Andrea Felstead from Bloomberg Opinion on the luxury space. We're going to be speaking with the CEO of Kering later, so we'll get some questions, no doubt, around Gucci. Catch our interview with Luca Di Maio at 3:30 p.m. London time on Thursday. Don't miss that interview with the head of Kering.
Yeah, so coming up later this week. In the here and now, though, still very much focused on what's going on in the Middle East and oil prices. Oil prices falling on signs that Washington and Tehran may revive peace talks following the start of the US blockade of the Strait of Hormuz. For more, let's talk to our oil and shipping reporter, Waylon Sun. Waylon, good to have you on the programme. So let's start with the big picture around what's moving things, and then we'll get to some of your great reporting around individual vessels. But the diplomatic efforts seem to be doing something for futures, bringing futures prices lower. But in the physical market, the blockade and the fact that even less energy is getting out of the Strait than was previously the case is the area of focus. So how do you add all of that up together? What's your focus this morning?
Exactly. So as you rightly pointed out, right, like futures markets are really headline driven. They are looking for signs of ceasefire, and that's why we see Brent and WTI drifting downwards since yesterday, because both US and Iran appear to be showing signs of goodwill to come to the table to talk. And also, crucially, even though the US has imposed a blockade, we haven't seen any flare-ups in attacks or missiles being fired from Iran into the region. So in general, there seems to be a floor right now. But of course, in the physical market, the longer each day that Hormuz is not open, the more barrels would disappear from the physical market. We already have a lot of the Persian Gulf producers shutting in production. Saudi Arabia and the UAE have tried to divert some of those flows to the Red Sea, but those are limited. We are talking about tens of millions of barrels disappearing per day. So that's a serious concern in the physical market itself.
Well, and I know you and the team, as Anna was suggesting, have been monitoring the individual ship flow through the Strait of Hormuz and the testing ultimately of this US blockade. One ship in particular, the Rich Starry, which is sanctioned by the US but is linked to China. Where are we in that story? Has it navigated the Strait? Is the US looking to potentially intervene?
That's a great question. So what we saw just maybe half an hour ago is the tanker itself. And mind you, it's an oil products tanker, it's not a crude tanker. So it's actually making its way down south into the Gulf of Oman. Its journey appears to be not inhibited by anything. But of course, we have to put a caveat that over there in the region, electronic interference is pretty severe. So ships may not appear physically where they are. But so far, throughout the whole journey, the ship has made its eastward journey from within the Persian Gulf after the US blockade, and it's now in the Gulf of Oman. So what are we looking out for here? And we have to bear in mind that this blockade that we're talking about is not the same one that we saw in the past few weeks, because when ships try to transit the Strait of Hormuz, that's actually in the hands of Iran, who has tried to attack the ships. But now when we see a ship safely exiting Hormuz, it's not an issue about Iran at all. It's about where the US Navy is. And currently, we don't know where the US warships are. We don't know whether the ship has safely made it out in the open sea yet.
Well, just a final quick question from me. The Saudis are worried about the Red Sea. How worried should the rest of us be about the Red Sea?
That is a big outlet for Saudi Arabia, which is a major producer for the OPEC. And they have been managed to divert some of those crude away, but not all of that, because its main outlet is still in the Persian Gulf. So around 7 million barrels per day through the East-West pipeline into the Red Sea. And about, if I'm not wrong, 5 million barrels per day is meant for exports. So that's the limit that we're looking at. Any further attacks on the capacity, on the output and the pumping capacity for the pipeline will certainly put the oil market to test. And already ships are not that willing to sail into the Red Sea because of fears of the Houthis.
Yeah. Waylon, thank you very much. Waylon Sun, oil and shipping reporter. Thank you for joining us. Coming up, we'll continue to focus on commodities. We'll talk to Eva Manthi, strategist at ING. Aluminium in focus there. This is Bloomberg.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Good morning, this is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is the opening trade. We are 30 minutes into today's session. We're seeing some optimism then across these equity markets, and that has been underscored by reporting suggesting that the US and Iran could potentially meet again to revive those talks around continuing the ceasefire or maybe even coming to some kind of deal. Across the European markets, then the benchmark seeing gains of 0.7%. The last time I checked, it was the auto sector was on the upside in terms of the best performer across the sectors, energy on the downside. DAX currently up at 1% as a result of that, a little over that, and autos is playing that part there for Germany. 0.5% is the gain that you're seeing in the CAC current over in France, adding 42 points, and less strength coming through for the UK, given the energy component, but nonetheless, gains of 0.3% for the FTSE 100 so far. Guy, what are you seeing?
Gilt's having a pretty good day. It's basically kind of 5 to 1 in terms of up-down. You've got 492 up, 91 down within the stock 600. Look below the surface to see whether or not this rally is convincing. Yesterday in the States, certainly the underlying story, the volume, kind of what is happening in the turnover picture didn't look quite maybe as convincing, but certainly you saw the chip stocks doing very well. So volume also maybe painting the same picture here in Europe this morning. But back to that chip story, it is certainly continuing to be one of the leaders here in Europe. BE Semi's having a good day, ASML's having a good day. These are heavyweight stocks now. ASML certainly a heavyweight. BE's up by nearly 5%. Givaudan's having a fairly good day as well out of Switzerland, particularly the fragrance side of that business performing very strongly. That is what is being highlighted by that company on its earnings. It is being rewarded. It's up by 5.5%. The downside, though, we've already talked about it. ASML is the kind of the big upside gainer this morning, and LVMH is a significant drag. It is down by nearly 2% this morning on the back of the numbers that we saw. Andrea Felstead, though, painting, I would argue, a more positive picture. Imperial Brands reiterating guidance this morning, not seeing an impact out of the Middle East. It is being, though, as you can see, knocked lower by the market. What was the market expecting? Clearly more out of that business in terms of its earnings. Maybe an upgrade was what some were looking for. That's not what's happened. British American Tobacco also under pressure as a result of what we're seeing within that sector. So that's the kind of the stock market story. What are we seeing elsewhere? Anna.
Yeah, let's get a rundown of some of the other corporate news flow. We'll start with corporate news flow, at least, that we're tracking this morning here at Bloomberg. Bloomberg has learned that Amazon is in advanced talks to acquire the satellite operator Globalstar in a deal that would boost the tech giant's efforts to build its own satellite operations. Sources say a transaction could be announced as soon as Tuesday, but a final agreement has not yet been reached. Chinese President Xi Jinping says the global world order is crumbling into disarray. In his first public remarks since the Iran war broke out more than a month ago, Xi is also vowing to play a constructive role in the Middle East, positioning the Asian power as a stabilizing force amid the conflict. And the U.S. Secretary of State Marco Rubio is to join working-level peace talks between Israel and Lebanon. That's set to take place later today. According to a State Department schedule, Rubio will join a meeting at 11 a.m. Eastern Time between the two countries' U.S. ambassadors. Tom.
Okay, let's get more details in terms of the constraints that are being put across the commodity space as a result of the effective closure of the Strait of Hormuz. Aluminium jumping to a 4-year high. Just one example. That was in London as President Trump's blockade of Iranian ports threatened more disruptions of shipments of that metal from the Persian Gulf. The Middle East accounts for about 9% of global aluminium output. For more on metals, Eva Manthe, commodity strategist at ING, joins us. Eva, can we start on the aluminium story then? At a 4-year high at the close on London markets yesterday, what is the nature, what is the extent of the constraints, the disruption that we've seen out of the Middle East when it comes to the production of aluminium?
For aluminium, the Middle East conflict is really a major supply shock. So now we're talking about 3 million tons of Middle East smelting capacity, which is roughly 4% of global supply, going offline. And it looks like it's going to be long-lasting. And that's already tightening an already constrained market. So even before the conflict, we are expecting the aluminium market to be in a deficit. So right now, on our numbers, the global aluminium market is heading for a deficit of around 2 million tons this year. And you can see the stress is most visible in the physical market for aluminium. You see premiums are rising, availability is tightening, and stocks in global warehouses are also drawing down. And Europe is particularly exposed. It's heavily reliant on imports after years of domestic smelter closures here. Europe is reliant on roughly 30% of its aluminium coming from the Middle East. And we've seen that dependence has increased further since Russian aluminium flows to Western markets fell sharply after the invasion of Ukraine. And for aluminium, we've seen already how sensitive this market can be to supply disruptions during that Russia-Ukraine conflict.
Eva, you're painting a pretty dire picture. Are the inflationary impacts of this, do you think, underestimated? How quickly could this unwind, that pressure and those constraints, if we get a reopening of the Straits of Hormuz?
I mean, for aluminium, these losses are really here to stay. So some capacity could return, but not very quickly. And aluminium damage to those smelters isn't easily reversible. So once you see those pot lines shutting down, restarts are very slow, complex, and capital intensive as well. So even if the conflict ends tomorrow, bringing that capacity back to the market can take 6 and up to 12 months. So that means that those supply losses we've seen so far are likely to persist even if geopolitical situation improves.
Eva, good morning, it's Guy. How much demand destruction would we need to see to balance the market?
So demand destruction is the biggest downside risk to our forecast. But it's not really about how high prices go for aluminium, where you see that demand destructions is about how long they're going to stay there and how long that conflict is going to last. So it comes down to for how long we're going to see that flows through the Strait of Hormuz being constrained.
Often we talk about if copper prices are high, aluminium is the substitute. What's happening with copper prices right now and what we're seeing in terms of the manufacturing process, the sulfur that's required? Give me a kind of sense of where you think the copper market is going to go and its relationship back into the aluminium market.
So you see copper prices trading at the highest actually in 1 month this morning, and that comes to all that optimism we've seen that the US and Iran will restart peace talks. And metals have really been hit by fears of rising energy costs and what that what impact that's going to have on economic growth. And today, the markets are pricing in the easing of that macro conflict. So it's a very headline-driven market for metals. But in a de-escalation scenario, copper would likely outperform. If we see rate cuts, a weaker dollar, or a rebound in risk sentiment would also support copper prices.
What's in the driving seat then, Eva, for these metals prices? Is it supply restriction or is it hopes of peace? And I guess it depends on which of the metals you're talking about.
Yeah, exactly. It depends. So for aluminium, the story is really the supply risk, the supply tightening, and that's likely to continue to support aluminium prices probably till the end of the year, because we are likely not going to see that production that's already been constrained coming back in the next few months. But for metals like copper, it's the growth demand story is still the main downside risk. So if we see a more prolonged conflict, this would raise downside risk for growth and by extension copper and also other industrial metals demand.
Eva, how insulated is the Chinese market via stockpiling to some of the dynamics that we've seen, some of the higher commodities prices that we've seen? So if you take aluminium, for example, there's really no supply issue for the Chinese market. They're the biggest aluminium producer in the world, of course, and they have China has a capacity cap on its production, so they have reached that at the end of last year. So there's not much more production increasing coming from China, but they really don't have a supply issue at the moment.
Eva, great to catch up. Thank you very much indeed for your analysis. We greatly appreciate it. Eva Mathi, commodity strategist, joining us from ING. Coming up, the HSBC CEO warning that the war in the Middle East could be denting global confidence. More from our exclusive interview. That's next. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions.
poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Welcome back. This is the opening trade, 8:43 here in London. European equity markets on the front foot as there seems to be rising hope and perhaps even expectation of a meeting, another ceasefire meeting between the US and Iran. We wait for details and watch stocks go higher in the meantime. Back to the impact that this is having on the global economy. HSBC CEO George El-Hedry says the conflict in the Middle East is beginning to dent client confidence as investors navigate an increasingly volatile global landscape. Speaking to Bloomberg exclusively, he expressed concern that the war will have a much wider impact globally, but struck a resilient tone about managing this risk.
There has been a global trend of diversification of booking centers that's been taking place for a number of years now, specifically by our wealth management customers.
Right.
So they've been using booking hubs, such as Hong Kong, of course, such as Singapore, such as the UAE, both in Dubai and Abu Dhabi, such as Switzerland, the UK, the US. And they have naturally been diversifying their wealth to be managed across multiple of these hubs, partly to be able to benefit from the expertise that each market brings, and partly as a matter of risk management. That trend continues. Insofar that this is, this concerning the Middle East today, frankly, we have seen very benign movement. I think the resilience of the Middle East as a long-term hub for wealth management and capital has not changed. But of course, everybody's hoping to see the end of the current conflict and praying to see the end of the current conflict soon.
You're also a global trade bank, so what do you see in terms of change, if any, of trade flows? Do you see any of that since this war erupted? And how does it differ from maybe last year when we were talking about tariffs?
So trade has certainly been disrupted. Now, it's been tariffs of 2025 have disrupted trade with the US. This time we're seeing a major disruption in trade far beyond the Middle East, but in particular towards Asia because of the Strait of Hormuz closure. We believe there are multiple hundred, probably up to 800 ships that are still locked up in the Gulf. And, of course, the passage daily 150 ships has dropped to maybe 5 to 10 ships at best. So that is hugely disruptive. The impact of such will be felt way beyond the Middle East, and that is one worrying factor for us, not just in price of goods, oil, refined products, LNG, LPG, but also fertilizers, metals, etc. But it's also going to be felt in the availability of such goods. And we worry that a continuation of this conflict will have that impact globally, way beyond the Middle East.
That was HSBC CEO George El-Hedry. Sticking with the banking space, Goldman Sachs' first quarter earnings revealed a surprise drop in bond and rates trading revenue, unnerving investors ahead of today's first quarter reports from other major lenders. Goldman CEO David Solomon addressing the bank's volatile quarter.
2026 began with a degree of optimism. Markets hit record highs and confidence continued to build, with most clients focused on growth, strategic activity, and capital deployment. As we've said, things rarely move in a straight line. And as the quarter progressed, the macro environment started to weigh on sentiment. Volatility increased meaningfully amid concerns around AI-driven disruption in sectors like software, heightened uncertainty in parts of private credit, and the conflict in the Middle East.
Charlie Wells is here with an update on Goldman Sachs. So, Charlie, what stood out to you? It wasn't all bad for Goldman. There was some pretty amazing strength that came through for the equities team, but there was that challenge around FIC. What for you stood out?
Tom, it really was that miss on FIC, on fixed income currencies and commodities that really overshadowed what was a strong report, a miss to the tune of $800 million versus analyst consensus, especially in this environment where there has been a lot of volatility, where there were expectations that that could benefit that desk. So again, analysts may be getting a little bit overly optimistic there, but there was reason for optimism, and we saw that come through in this equities trading beat. Goldman beat their own record by over $1 billion, setting the best quarter, not just at the bank, but in the industry at large. So again, really positive news coming from there. But analysts had also been looking to see what that investment banking fee backlog might look like. And we got some indications that it might be softer going forward. So dampening optimism. If we flip and take a look at some of the commentary that came from executives on that analyst call, this is an earnings season where these calls matter just as much, if not more, than the backward-looking numbers. So we got David Solomon, the CEO, talking about private credit. We knew we'd get questions about private credit. We had Solomon really making a pitch for at least how Goldman does private credit. And again, an explanation from Dennis Coleman, their CFO, talking about that miss in FICs and talking about how their commodities business had been strong, about how currencies had been strong, but it was really where mortgages and rates tended to bring that segment down. So if you look at how the stock performed yesterday, it was really hit by this earnings report. The question as we go into the market today, does the market continue to see this as idiosyncratic or as part of a broader problem?
We're going to find out, aren't we? Got JPM, Citi, Wells is going to be on deck today. What are they going to tell us?
Well, look, we've seen, really positive stories coming through for Citigroup. So again, we're going to be looking for commentary about the transformation that that bank has been going through. And if you look at their share price, beating Goldman for the past couple days, really. So again, comments there, but something to look out for. And this kind of in relation to yesterday, FIC to equities trading at Citi is high. So if there's a negative surprise from Citi, that could negatively impact the share price as well. JP Morgan under a little bit of strain compared to some of its peers. They actually have a lot of high expectations on FIC growth as well. That's something based on yesterday's report from Goldman to look out for. But JP Morgan as well, a differently shaped bank. And so we're going to get a different narrative. Let's look at where the revenue comes through at JP Morgan, because we'll get different questions, a different story. You see this big chunk here. That's consumer and community banking. So getting a view on the American consumer, we're starting to get questions about inflation, on creditworthiness. We could get a different indication coming from JP Morgan, so important to focus on that when it reports today.
Charlie Wells, thank you very much indeed. Let's take a look at what else we are going to be watching throughout the day. 9 a.m. UK time, so counting down to this, just a little under 10 minutes away. The IEA oil market report drops. We'll break that for you, of course. 1:30 p.m. UK time, different metric when it comes to inflation, core producer prices, PPI, out of the US. European earnings, we've seen the luxury names under pressure today, well, at least LVMH is. Kering is reporting later today. Total energy sales, they'll come through as well as revenue. And on the earnings front, as Charlie was saying, JP Morgan, Wells Fargo, Citi, plus BlackRock in the finance space and banking space, of course, reporting. And at 10 p.m. UK time, we're going to be hearing from Christine Lagarde over in Washington.
Let's talk about these markets. We bought the dip. Dip's been bought. SPX back to where it was. All good. We can move on.
This bonds are rallying, equities are rallying.
Conflicts in the rear view
dollars
mirror.
down.
Buy stocks. Is that the right trade?
I think it's very hard to say in the next week or so. I'm racking my head around what this positivity is about, and to me it only has to be around ceasefire talks, the fact that they're still continuing, and you'll get hope that there'll be more talks next week. And we know the timeline was 2 weeks from the origin. Also, maybe we have another week of this positivity on the back of that, because, we have had negative things like US CPI last week that didn't really hit markets. Yes, it was better than expectations in terms of coming in lower, but it was still very hot. So we'll get US PPI later today, but I struggle to see how that shakes markets. We're getting earnings season, but it may be too early to see that negativity in terms of the stagflationary shock in those numbers. So I struggle to see what kind of stirs the market unless something very negative happens in terms of a deterioration in ceasefire talks, or maybe another party comes as an issue in terms of China with sending its ships through the Strait.
Yes, I mean, that's something we're watching closely. The Chinese response has been interesting. It's been evolving, it would seem, over the last 24 hours. So you really don't think that any of the data cuts through then, Skylar, so, and nor the earnings stories. So it's all just about one story right now?
I think it's because if it is a temporary shock, markets can look through it. So we'll get PPI later today, and I think it's not a huge number for two reasons. The first is, as I said, we got CPI numbers last week, and the market reacted positively to that, despite the fact that month-on-month inflation was up 0.9%. Now, PPI has already been on a hotter trend than CPI, and it does feed directly into the PCE numbers. And this number, again, is expected to be hot. So the second reason is there's already a high bar for it to come in hotter than expectations. And if the market wants to look through it because it thinks that there's going to be energy prices down in a month from now, then it can.
Bond market's performing well today, but you're pointing out that there's a divergence between European bonds and their US counterparts. What are the bond markets telling you?
Yeah, I mean, it's really interesting because equity markets are reaching for levels, particularly in Europe, that are kind of above Iran levels in terms of the levels we were seeing a month or so ago, whereas bond markets, yields are still very much in Europe elevated. They're still in that kind of high range. And I think there's two reasons for this. One is we think about the central bank response. We'll get some speakers later today, including Lagarde. And there's not a reason to get rid of that optionality for hikes. And that hike pricing has been very sticky because we've seen that there's been a reaction from central bank makers that they're worried about that inflation, even if it's proving to be only a few months that we get it. And then the second reason is just you're getting more bond supply, right? We've had more support out of some European economies. France, there's a little bit. Spain, there's more. We got Germany yesterday adding to that fiscal support in terms of lessening the impact of energy prices. And we've recognized that there needs to be a higher term premium as a result of that as you get that more issuance.
We can ignore earnings, right?
I mean, not entirely.
Okay. Within reason. Can I ignore earnings calls? Because they're the forward-looking. I want forward-looking information here. Are the earnings calls going to? Is it too early? The earnings clearly aren't going to show it, but the earnings calls might. Is that where I look for the volatility and the clarity maybe on what is happening?
Yeah, I mean, absolutely. If you start to see more negativity in those forward outlooks where companies are going, maybe airlines go, oh, we're going to have prices increase quite substantially and we're not able to pass that on because consumers aren't as strong. Or if you look at the bank earnings later today and you see that consumer spending was already down prior to the conflict and maybe this just makes that worse, then certainly you can look at the future and be a little bit more pessimistic. It's just really, though, a question for a bigger impact of whether or not you can look through. So, yes, we may get earnings downgrades, but will we get earnings upgrades on the other side of that? And that really depends on where the energy price goes.
Okay, Skylar, with that in mind, thank you very much. Skylar Montgomery-Koenig from the Bloomberg Markets Live team, and she was talking there about energy prices, very important well, to all asset classes, it would seem. And we do see oil prices a little bit weaker. This is futures down by 0.8% on Brent right now. We are still watching all of the action around the Strait of Hormuz. We take on board what our colleague was saying yesterday about earlier on, about the electronic interference. So difficult to be entirely sure about where some of these vessels are. But the Rich Starry has attracted a lot of attention because it has been trying to clear the Strait of Hormuz, and as yet we've had no indication that there's been any intervention from the Americans. It's Chinese owned and suggesting it has a Chinese crew on board and suggesting that very loudly, which seems to be something that ships are doing to try and protect themselves wherever they are, perhaps.
The ships we don't know where they are the US ones. So we don't know where this vessel could be intercepted. There's two different blockades. They've got the Hormuz blockade, and then you've got the US could chase this tanker across.
We saw them chase across the Atlantic,
exactly.
in the aftermath or in the run-up to what's happening in Venezuela.
Yeah. If you look at the map, it's made some progress during our 2 hours of being on live TV. China's come out pretty strongly during the 2 hours that we've been on. Some of the most vocal criticism, actually, of the blockade, or at least US actions around the Middle East. So they're obviously monitoring this as well.
Calling it dangerous and irresponsible.
Will the US intercept a Chinese-flagged vessel?
It would be a major provocation.
Precisely. But then that, if they don't, it undermines the whole case, because the idea is that the Iranians can't sell oil to the Chinese. And if the Iranians can sell oil to the Chinese, then what does this blockade do?
We'll keep watching the Rich Starry and
Rich Starry
and other similar vessels. Christine Lagarde is speaking later on today. In fact, 3 p.m. London time, we'll be hearing from her in an interview. So stay with Bloomberg TV for that. That's it for the opening trade, guys. Back with the pulse next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Oil falls, global stocks climb. This as the United States and Iran are said to be moving towards fresh face-to-face talks ahead of next week's ceasefire deadline. Turning to corporate news, United CEO floating a tie-up with American, a deal that could create the world's largest airline. We'll have more on our scoop a little bit later on in the programme on that story. And luxury is certainly losing its shine. LVMH shares dropping as sales disappoint with Middle East tensions hitting demand for Louis Vuitton and Dior. Let's talk about the markets. Let's show you what's happening. I mentioned some of the headlines. Brent crude is down by, let's call it 0.6%. Now that's futures Brent. Real Brent, if you want a barrel, a little bit more expensive than that. Stock 600 up by 0.8%. Germany's outperforming a little bit. Luxury's under a little bit of pressure. Oil stocks under a little bit of pressure as well. And look at what's happening with yields. You're seeing a bit back into the market. The UK is certainly a beneficiary of what we are seeing this morning. How does that translate into the European picture? Let's show you some green markets. This is what we're looking at. The DAX is up. The auto sector is having a fairly good morning. The CAC's being held back by what is happening with the LVMH story. The UK is being held back by what is happening with the BP Shell energy story. That's certainly a limiting factor for that market, which has been outperforming year to date. So we have plenty to talk about. So let's get going.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome. You're watching The Pulse. I'm Guy Johnston. I'm right here in London. Let's talk about what's happening with the energy market because, as ever, that appears to be front and centre. So we're just getting the IEA energy report. Now, we heard from Fatih Birol yesterday talking about what is happening in this market, but we're now starting to get some details from the IEA on its position. So the IEA, this is the headline that is dropping right now, sees oil demand falling for the first time since 2020 amid the war. So what they're pointing to here appears to be demand destruction, which is really interesting. There is evidence of that already coming out of Asia. There are parts of the Asian economy that are already under pressure, and we are seeing restrictions being applied in terms of energy. And that maybe is what we're going to see maybe writ large across the world, maybe not in the United States, but potentially here in Europe. So the early indications coming through from the IEA report, which is just beginning to drop right now, is that we are going to see potentially potentially some demand destruction. What are we seeing in the Gulf right now? What are we seeing in terms of the picture as it develops? Well, there's been plenty of news to digest this morning. So let's get some details on what we're seeing here. Jumana Basetchi joins us out of Dubai. So let's talk about, first of all, what is happening in terms of the blockade. We've got a Chinese ship testing the US blockade. Now, it's through into the Gulf of Oman, but we don't know what happens next. Jumana, what are people thinking is going to take place here?
Yeah, and I'm also just going to pick up on the IEA report as well. Yesterday, Fatih Birol, the chief of the IEA, on the sidelines of the IMF, said that no one is immune from an energy crisis. And indeed, this is what we just saw now. For the first time since 2020, they're now predicting demand destruction for the whole of this year. And what's interesting about the report, Guy, is it mainly is on back of OECD numbers dropping. And they're forecasting a decline of 240,000 year on year. That is a 200,000 downward revision from where they were prior. And half of that is coming from the United States. So, this isn't something that's going to resonate well with President Trump as he thinks about the next couple of weeks. They also cite energy demand destruction coming through from Asia as well, but there notably demand is still growing, obviously because of the higher growth numbers. But to your point, Guy, what we started to see is the impact of the anticipated physical supply diminishment and the impact that is going to have on energy demand in the coming months. And overnight, there were reports suggesting that the latest tankers that went through or successfully transited the Strait of Hormuz before the war even started are now making their final destinations. They're arriving at these refineries. After that, there's a big question about where these supplies are going to come from. And in these markets, we've been talking about the big wedge between what's happening in future space versus physical. You continue to see the upward pressure being built on physical supplies. And at some point, that is also going to lead to demand destruction, which is coming through from the IEA report. To bring it back to your original question, look, these straits, even though we have a US blockade that was introduced overnight, is still effectively shut. And I know we've been talking a lot about this one oil tanker that is potentially traversing through, but this compares to 100 to 120 a day that were passing before the war. Now you've got a trickle, less than half a dozen. As long as this situation persists, you are going to continue to see tightening pressure on these physical supply of energy coming from the region.
Jumana, talk to us about the diplomatic update.
So there's been a lot of talk this morning about the potential to progress to a second round of discussions. Mediators seem to be working really hard, the diplomatic channels. The latest Reuters reporting that there could be a second round of negotiations taking place in Islamabad as soon as this week. That has not been confirmed by neither the US nor Iran. But the indication from President Trump yesterday was that he had received a call from the Iranian side. He says that they are keen to make a deal. And also, the Iranian president, Pezeshkian, said that they also, in turn, are willing to continue with negotiations as long as it's done within the scope of quote-unquote international framework. So where we go from here, unclear at this point where the talks are going to be held. Could be Islamabad. Some people are saying it also could be in Geneva. Switzerland throwing their hat into the ring. Remember, they held the prior rounds of nuclear discussions. And on the table, you've got to think, the other main issues that we've been addressing throughout the course of our reporting the last week. One is obviously the fate of the Strait, and the US are trying to do something about it now by wresting that leverage away from Iran. But the other is what happens with Iran's nuclear file, whether they're going to agree on enrichment limits, enrichment suspensions. There was some New York Times reporting overnight suggesting that they were open to a 5-year suspension. The US were pushing for 20-year. Do we get some sort of halfway house agreement between the two? Again, a big question. And then also the matter of relinquishing that highly enriched stockpile material that they're sitting on. What is the fate of that material? These are some of the questions that are going to be posed. And we're looking to get more color, hopefully, in the next couple of days as to whether these negotiations will happen. Remember, the ceasefire itself is set to end on April 21st. So there is a time, ticking time in the background as we work towards that ceasefire expiry.
Absolutely. Market's got a very careful eye on that clock. Jumana, thank you very much indeed. Jumana Basetchi joining us out of Dubai. for the moment, just the possibility of talks recommencing seems to be enough to get markets higher. Risk is definitely on this morning. You can see that on the screen in front of you. DAX is up very nicely, up 1.1%. Stock 600 up by 0.8%. FTSE's a little bit of a laggard, but not by much. CAC is being held back by LVMH. But nevertheless, we are risk on. The market is trying to look through what is happening. It's trying to look for a better story developing. Paul Skinner, Investment Director at Wellington Management, joins us now. Good morning, Paul.
Morning, Guy. Great to see you again.
So the Stock 600, not the Stock 600, the S&P 500 is back to where it was.
Yep.
As we went into this war.
Absolutely.
Does that make sense to you?
I've got to say, we actually think there's more volatility to come. So you can say it makes sense for the time being, but longer term, maybe not. Because what we see is the market being a little bit too sanguine about where oil price is going to be at the end of the year. At the moment, it discounts about $70 a barrel. We and our commodity team, because at Wellington we trade across the asset classes, the commodity team do a lot of work, and they think the lowest it's going to be is about 85. So we've got an inflation pulse coming. Yeah, that is going to, and the important thing is that we look through these little fluctuations as to what the policy response is going to be. And the problem with the central bank's policy response is that 90% of developed market central banks are running policy ahead of target. So they don't have any flexibility, any slack so we're going to see a reaction. And the question is, how fierce is that reaction from central banks? Because we are at a time now where central banks obviously running inflation hot, but we've also got governments with huge debt burdens. And you know, that debt burden has grown dramatically over the last 10 years, from 80% of GDP to 120%. And so you've got these two, factors: central bank loose policy, governments with fiscal loose policy, which is sort of institutional indulgence, which means that we're at a tense point.
You're telling me rate hikes are coming. Is that what you're saying?
I'm afraid so. And, it all comes down to your central bank, because we think there's going to be big dispersion. There's going to be different...
That makes sense.
Yeah, a lot of different reactions in countries, in sectors, in companies. And that's going to come out from where your central bank sits on that growth and inflation spectrum, because we know they've got both those targets. We've got some that are inflation fighters, the ECB, Sweden, Switzerland, all on that end of the spectrum. In the middle, we've got Australia, Canada, probably the US in the middle. And then there's ones who are sort of growth protectors. UK, inflation above target for 10 years. Japan, where inflation's broken out, and they have got their foot flat on the gas. Now, what's happened to those countries is we've seen their yield curves stay steep, and obviously pressure on certainly the yen, sitting at 160. If that breaks, you're going to see a big currency move. And clearly, we're not bullish on sterling either. So it depends where your central bank sits in that.
So you think the ECB is going to hike and the Fed's going to do nothing? That sounds like...
That's the most likely outcome for us, absolutely. Yeah.
Equity markets don't seem to care, though.
Sorry?
Equity markets don't seem to care that much. They're back to where they were.
Because we are not watching that inflation come through. It's going to come through in the next few months.
Are stocks a hedge against that, though?
Against that inflation question?
If I can pass it through.
Very, very good question, because we've only had 5 energy shocks since the 70s. And it's not the actual energy shock that dictates how risk assets behave. It's the policy response. We saw that in the 70s. In 74, the UK hiked rates because inflation was high, but the minute growth faded, they cut rates. That embedded inflation. We ended up with stagflation, a disaster for risk assets. 79, which incidentally was the Iran Revolution, people followed, or certainly the Bank of England followed the Bundesbank playbook, which was to raise rates, wait till inflation started to fall, and that ended up with a recession, but a much better response for risk assets, much better performance through the thing. So it depends on your policy response.
So you'd rather a recession than stagflation?
I think stagflation is proven to be the worst possible outcome for risk assets. And we've got lots of cases.
So what do I do in this environment that you're painting? What does a portfolio look like?
I think what you've got to do is shorten up duration in shorter duration assets. You've got to be very, very careful where you are where leverage is, because even within countries, a period of higher yields, lower growth is going to affect the more indebted countries. So in Europe, France, Belgium, Italy, spreads are going to widen on those. And you must look at that in companies and where you're investing. So if you're in a lot of high-risk, high-yield companies, that's dangerous. Get back up in quality, really well-managed. Sorry, Kim?
Give me some examples. So where am I? I'm coming from there. Where am I going to? Well-managed companies. Every company tells me
there's
they're
lots in the communications. If you're looking at high yield, which is where a lot of retail has their money at the moment, you want to be in well-run companies. Charter Communications in the US has, basically they had their leverage 4 or 5 years ago. They've been running down leverage. That's what we want to see. We want to see leverage coming down because, as I say, if cost of capital is going up and growth is slowing a bit, you need to be in this.
Cash in the UK is giving me 4.5%. Are those kinds of companies going to give me more than half 4.5% in terms of the return?
They will if policy is managed correctly. Right. Absolutely right. Now, that high yield spread that you get is going to do, power for the return. You're up at 6.7%. So it is going to give you a demonstrably better return. But we need to make sure the Bank of England responds correctly to an inflation pulse and doesn't sit back and just protect growth. Because historically, protecting growth has been a disaster for risk assets in an environment where you're seeing an inflation pulse like this.
The problem with raising rates is that the governments have a problem with their debt at the moment.
Absolutely correct.
And the UK economy has not responded well.
But Guy, as I said, the yield curve that's failed to sort of flatten and has remained steep is the UK. So by being irresponsible with how much they raise rates, with people regarding them as an inflationary Bank of England, you've got a steeper yield curve. Cost of capital is that much greater. Other yield curves are flatter. So this is if you can earn the respect of the markets, that cost of capital at the longer end that comes down. That's what you want.
That's been certainly a challenge for the UK over recent memory. Lovely to see you, Paul. Thank you very much for stopping by. Paul Skinner, Investment Director at Wellington Management. Coming up, Francine Lacroix speaking exclusively with Christine Lagarde about Europe's economic challenges from the Iran war to monetary policy expectations. It is the IMF spring meeting. It is taking place as ever in DC. I can't wait to hear what Christine Lagarde has to say a little bit later on today. Coming up, though, on this show right now, the multi-billion euro takeover offer that could transform Italy's telecoms industry. We are going to speak to the CEO of Poste Italiana on their bid for Telecom Italia. That conversation is next. This is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back. 17 minutes past the hour. You are watching The Pulse. I'm Guy Johnson right here in London. Let's talk a little bit. There are so many things happening outside of this war that we're spending so much time talking about that we need to actually spend some time talking about them. So let's do one of those subjects right now. Poste Italiane's 10.8 billion euro offer basically to buy the full control of Telecom Italia is a huge subject in Italy right now. It would return the former phone monopoly to basically government ownership 3 decades after its privatization. Matteo Del Fante is the chief executive of Poste Italiane and joins me now. Good morning.
Good morning.
Nice to see you in London.
Thank
you very much indeed for being with us. Okay, the first question I want to ask you is a really straightforward one. I'm a Poste Italiane, get my air right, shareholder right now.
Yeah.
Your company is simple, it's straightforward, I can understand it. I kind of went through it this morning and had a look at it. You have a great dividend, you're a great income producer. Why are you going to complicate this for me by trying to buy Telecom Italia and making the whole thing just so much bigger?
I don't know. I feel like the world is getting, is changing a little bit.
Okay.
And maybe companies need to adapt to a changing world.
That sounds reasonable.
So we started this trip. It's not that, we woke up in the morning or we receive a call from, the government saying, why don't you do this? We enter the capital with a 27% stake of ordinary shares of Telecom Italia more than a year ago.
Yep.
It has been the best 12 months market performance of Telecom Italia shares for the last 25 years.
So your timing is excellent.
Okay, so we have 1.5, we more than double our investment. We made 1.5 billion euro of capital gain. And we spent 1 year working to extract synergies because there is a lot. And that's what the market appreciated over the last 12 months in us coming in. And then we realized that with a 27% stake, it was too long and not reaching the full benefit of synergies and doing something really special together.
So you can't do it with being a partnership. A partnership's not enough.
I mean, first of all, is unbalanced in terms of sharing the synergies by definition, because I own 27%, the market owns the rest, and I'm contributing.
You want the rest
First of all. Second is two different investor base, two different constituencies. Having TIM has a legal entity, part of a project into a group makes entangles fast in technology today. So we cannot wait the conflict committee to say that if the price of the commercial agreement to sell, is the right one and call the lawyer. There's no time for this today.
Right. No time for calling the lawyer. That sounds like good advice. Is there a danger, though, that it becomes... At the moment, you've got a easily understandable business.
Yeah.
If you put this all together, it starts to get quite complicated.
No, that's a fair point. And to be entirely honest, we could have gone all in 1 year ago.
Yeah.
And the reason why we didn't go all in 1 year ago is exactly for that kind of, awareness. But this 12 months gave us the confidence that at the end of the day, Poste being a platform company, which is made of client, by definition, product, all linked up by technology, okay? And TIM is the perfect fit in terms of client, because they have, enterprise, public sector clients that, don't really belong to our portfolio. And they have a product, obviously, in TLC and technology that is a perfect fit to our strategy. So it's much less complicated than, honestly, after 1 year looking into the company, I had thought outside in last year.
So you have a better understanding. Are there bits
better.
Are there bits that you wouldn't want?
No.
You want it all. There's no kind of.
I mean, we will
fit.
work with the company to see, what kind of optimization we can do together. Right. But at the moment, we see everything in good shape in the company.
Why do you think the market was undervaluing TI before? And why was it undervaluing TI?
I think there was first a leverage problem that goes back to many years ago. Then there was a ordinary shares versus saving shares problem, which was solved between December and January. And the new CEO that was appointed 4 years ago has fixed both problems. So he helped the market getting back confident into the share. Then we came in as a governance stable, supporting management, shareholders, and that was also a big game changer. Okay? That's what the market is telling us, and so now it's time to think 10, 15 years down the road, and that's a very strategic industry where it's not a matter of the state willing to be there. It's a matter of there is a technology transition. Either you do it or you don't do it.
Right.
Okay? And we want to do it. So it's as simple as that.
Okay, so that raises an interesting question. Which bits of TI are most interesting now? Because if you look at is it the cloud business? Which bits of it now look really attractive? Because the cloud business certainly stands out.
Let's make it simple. The consumer business, we already have a mobile company. We are the biggest distribution network. It's a natural fit. Done. Okay?
Okay. So that all fits together.
Fine. On enterprise and public sector clients, team has the historical heritage relationship for all Italian clients. Okay? And these are clients that were born with the connectivity contract, which are going down, obviously. Then are becoming cloud contracts. They are becoming cybersecurity. They are becoming Internet of Things, AI. And that's where, we need to support the company and push the company into that client base. And we are much more than, and that's one of my focus. I need to make clear that Poste is a very technology-intensive company today. And merging with that client base and the technology of team is a very powerful combination.
But it also sounds like you're going to have to spend a lot of money on technology. Is that what does the capex story look like?
we will do whatever it takes.
Right.
Think that we have a very strong balance sheet, and it's a capital-intensive industry. I'm very happy to support it.
Okay. Just before I let you go, because I can see the clock ticking over there. Any impact from the war? Any impact as a CEO of a big Italian company? What are you seeing right now? What is the consumer?
We're all very worried, on a personal basis. As a CEO, I have an impact every day on my share price. I have an impact every day on energy cost.
How much have your energy costs gone up?
Luckily enough, we have hedged as a company all our gas and electricity costs before the start of the war. But we're using a lot, we're 26 million vehicles all around the country using petrol, and that's gone up significantly. So we're renegotiating with our clients. So we're doing a lot of deliveries for e-commerce platform.
Should the government help with that? No.
No, the government, probably will help retail for as much as they can, but corporate needs to do their job.
Nice to see you. Thanks for talking about the us. We really appreciate it. Matteo Del Fante, the Chief Executive at Poste Italiane. Okay, coming up, we're going to talk about diplomacy. We're going to take you back to that story coming out of the Gulf and get the latest on it. Thank you very much. I hope you've been enjoying the show. There's more next.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And
I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. You are watching The Pulse. I'm Guy Johnson in London. Let's talk about your top stories. Oil down, global stocks up. This as the United States and Iran are said to be moving towards fresh face-to-face talks ahead of next week's ceasefire deadline. United Airlines CEO floating a tie-up with American, a deal that could create the world's largest airline. We'll have more on that scoop in just a few minutes' time. And luxury under a little bit of pressure this morning. LVMH shares dropping. We're down by 1.6%. We are seeing sales being hit in the Middle East. Certainly the Middle East war having an impact on Louis Vuitton and Dior. Let's talk a little bit more about the oil story as well and figure out what's happening there. The IEA says it's expecting oil demand to fall for the first time since 2020. The publication of the latest energy report coming less than 24 hours after President Donald Trump's naval blockade of the Strait of Hormuz began. Let's get the thoughts of our Middle East energy markets reporter, Anthony DePaola, on what we are seeing here. Let's talk a little bit about what is happening with kind of the picture in the Gulf. What are we seeing in terms of entries and exits? Give me an update on how this market is performing.
Good morning, Guy. Yeah, we're seeing pretty much stasis in the Gulf with not much movement at all, really. We've still got tankers blocked inside the Persian Gulf, not able to transit Hormuz. On the one hand, we've got Iran, which is trying to regulate traffic going through, meaning they want tankers to go through and ask them for permission, even in some cases pay a fee. And then you've got the U.S. blockade saying any tankers that go to Iranian ports, carry Iranian crude, or even pay that toll are going to be interdicted and stopped on the high seas. So it's really brought vessel movements down as well. Obviously, as you said, it started yesterday about around 6 p.m. in the evening Dubai time last night was when that deadline was. And really, in Monday up until the run-up to that, we only saw a handful of vessels pass through, a big drop from what it was on Sunday. So it's really had the effect of chilling any kind of transit out of the Gulf. We did see signs of one vessel looking to go through, a Chinese tanker, not sure if it's loaded or not. We're watching that to see what happens in terms of testing that blockade. But with all this, we've got prices down. Prices are down because the U.S. Apparently and Iran are talking about getting back together later this week for some more talks. We had that deadline pass, and we didn't see a resumption of actual conflict violence and attacks in the Gulf, which could potentially damage more production or export facilities. So we haven't seen that happen. So that's why oil is taking a beat. But we do have this report from the IEA saying, as you said, demand is going to fall for the first time since the pandemic, even warning that some refineries in Asia may run out of oil if these tankers don't get flowing. And really, that's what the Gulf needs to see. The Gulf producers need to see tankers moving. They want to see tankers getting out of the Gulf. They want to see the free transit of vessels before they can go ahead and make that decision to increase production. So that's really what they need to see, those vessels coming in and out, freeing up some of the storage before that needed production can ramp up. And that's really what the market is watching for, Guy.
Yep, going to watch it very carefully. We continue to track the Rich Dari as well, as you say, as it makes that exit from the Persian Gulf out into the Gulf of Oman. Anthony, thank you very much indeed. Anthony DePaola, our Middle East energy markets reporter. So we're watching the diplomacy very carefully. We've got signs, indications that the US and Iran could return to the negotiating table this week, we think, in Islamabad. Details are still coming through on that front. This, as Secretary of State Marco Rubio is also hosting ambassadors from Israel and Lebanon in Washington, D.C. today. We're hoping for maybe progress on that story as well. Let's get a take on all of this. Emil Hokiem, Director of Regional Security and Senior Fellow for Middle East Security at the IISS, the International Institute for Strategic Studies, joining us now. Emil, thank you very much indeed for your time this morning. So the indications are, we understand this morning, that we could see Iran and the US returning to Islamabad for further talks. Does that make sense to you? And why do you think this second round of talks could be happening?
Well, thank you for having me. Clearly, the US and Iran want to buy some time, and they're not yet ready to jump into another round of fighting. And there is considerable regional pressure, from Pakistan, the host, but also others, to try and do as much as possible to avoid a resumption of the war. The problem is the gap between the parties is enormous, as we saw during the first round of negotiations. There's not much preparatory work being done, although the two delegations went back home to brief their principals about, the baseline, and share an understanding of what the maximalist position of the other side are and what could be done. So this next round, one should not have high expectations about what they can deliver. We'll see what the agenda is going to be. Will the agenda narrow to, Hormuz, the nuclear issue, and perhaps the issue of sanctions, or will it be still, as the Iranians put out, a 10-point plan? The Americans at one point had a 15-point plan, which almost made it impossible to really start in earnest a dialogue. So it's the narrowing of the agenda that will tell us whether there is a possibility for a breakthrough. And if there is a breakthrough, it won't be something dramatic.
Okay, let's break that down. What do you expect? Do you expect that we will see a narrowing in terms of what both sides are setting out? Or do you think we're basically going to walk away from another round of talks in Islamabad with basically, again, no narrowing of either side, no compromise by either side?
I suspect we'll see a narrowing of the agenda, but at the same time, we won't see any compromise. I think it's still a time for posturing on both sides. Each country is working on its narrative, trying to portray, some kind of strategic successes, push a narrative to domestic and regional audiences that they have cards in their hands, that they're not going to cave, and so on. The big question for me is what can happen during this time. A blockade is an act of war. And the U.S. military tends to, as is on the screen right now, will conduct kinetic operations to secure that blockade. So we're still on the escalation ladder. The Iranians will be prepared. They will look for opportunities to head back directly at American vessels if they come through. And some of those ships can have up to 300 sailors. So there is a risk there. or indirectly, if Iran is not able to import what it needs, it could hit Gulf facilities, ports, and prevent the other side from getting what it wants. I mean, it's already blockaded. But the point is, there are more military options on the escalatory ladder than there are political, diplomatic options on the table at present.
Okay, so you, by the sounds of things, you think there is a reasonable probability at this point that we return to kinetic action, that we return to fighting.
Yes, I think it's a more likely than not that we will see a resumption of the fighting. Perhaps not at the same level of intensity, but the problem is there are no real guardrails. Things can go very quickly from 0 to 100. They don't have to go from 0 to 10 and then wait for a few days and then move to 50 and then get to 100. And that's the danger in the current situation. I would add something else. This is not a two-way war between the US and Iran. Israel is in the mix. And for everything we see now, Israel is not interested in a sustained ceasefire. It still thinks that there is more to be done in Iran and will be pushing the US and may conduct its own operations during this time. And finally, there's the issue of Lebanon. This is an arena that looks a bit peripheral, but it's quite key. I would argue at this point, it is linked to this conflict. If there's no ceasefire in Lebanon, the chances that the ceasefire in the Gulf will hold will be eroded.
Final question, and this is one that everybody's thinking about when it comes to the global economy. Does the strait remain closed? Is that something that you think could persist for more than a few more days, more than a few more weeks? What is your timeline in terms of reopening the Strait of Hormuz?
I mean, bearing a real diplomatic settlement, which I see unlikely, I think the strait remains closed for days and weeks to come. It's really the responsibility of the negotiators right now to understand what the cumulative cost of the global economy is. But as far as the Iranians are concerned, they figure out how to develop leverage and impose a cost on everyone because they cannot defend themselves. And so they're willing to impose that cost. And the US, I think, still doesn't have a clear military solution for that problem. And I don't think there is a military solution. So the likelihood is that, the Iranians, still control the clock and can still impose a cost. And unless they're given something that they claim amounts to some victory, they will be unwilling to relent.
Emil, great to catch up. Thank you very much indeed. Emil Hoyakem, Director of Regional Security and Senior Fellow for the Middle East at the IISS. Thank you very much indeed. Let's turn our attention to kind of China's view on all of this. The Spanish Prime Minister, Pedro Sanchez, is in China. He says China is the country most likely to help resolve the blockade in the Straits of Hormuz. Speaking after talks with Xi Jinping in Beijing, the Spanish leader said intervention by China could bring an end to this conflict.
Se me antoja muy difícil encontrar otros interlocutores.
It seems very difficult to me to find other interlocutors who can untangle the situation caused in Iran and in the Strait of Hormuz beyond China.
Más allá de China.
Daniel Bastiero is in Beijing. He's Bloomberg government Spanish reporter. Pedro Sanchez has made a series of visits to China. Is this one delivering anything? What are the takeaways from these talks?
Well, Guy, if Spain's goal was to reduce its trade deficit with China, the strategy hasn't been very successful. The deficit is now larger than ever. Even though Spain increased its exports to China by 7% last year, China still accounts for 74% of Spain's total trade deficit. Spain does appear to be making progress, however, in attracting more Chinese investment. Politically, Spain and China are moving closer. We saw that clearly this morning here at the Great Hall of the People in Beijing, where President Xi Jinping often offered warm words to Prime Minister Sanchez. Xi Jinping said both countries are, and I quote, on the right side of history and share opposition to U.S. military action in Iran, which the Spanish leader considers illegal, as well as to Israeli attacks and strikes in Gaza and Lebanon, and more broadly to U.S. intervention abroad. In short, Sanchez is positioning Spain as China's closest partner and friend in Europe, while also presenting himself as an alternative to Donald Trump. Two goals that increasingly go hand in hand, even if that irritates Washington, something that the Spanish Prime Minister doesn't seem to care about.
No, he doesn't. And it's fascinating to watch the impacts and the fallout from that. Daniel, thank you very much indeed. In Beijing, Daniel Bastiero, our Spanish government reporter, traveling with Pedro Sanchez. What are we going to do next? We'll turn back to the markets. We'll turn back to some of the single stock stories we're watching so carefully this morning. Shares in luxury giant LVMH under pressure. Last night, results disappointing. We'll talk more about what is happening there next. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back. You're watching The Pulse. I'm Guy Johnson in London. Let's take a look at what is happening in the airline sector. Shares of American Airlines up pre-market. This after Bloomberg revealed that the CEO of rival United Airlines, Scott Kirby, has floated a possible combination between the two. A merger could create the world's biggest airline. It probably is going to raise a few antitrust concerns. Let's talk a little bit about this and the fantastic work that we've been seeing coming out of our aviation team. Editorial leader Benedict Camel joining us to discuss. Benny, these are really big airlines in the United States, and I can't help but remember JetBlue and Spirit, and I do wonder whether or not that not passing should give us a clue as to the possibility of this passing.
You would think so, Guy, but we live in extraordinary times, and if you think about past mergers that didn't make it through, that was in a different era, and the era we live in now is, bigger is better, and audacious wins the day, and that's probably what Scott Kirby of United Airlines is thinking. So we reported last night that he has pitched this to senior officials in Washington. Now, this is preliminary, and it's probably him sort of launching a test balloon in essence, trying to see what he might be able to get away with. And the hurdles are obviously formidable. You know, there's you mentioned some of the sizes involved here. We're talking, you know, more than 2,800 aircraft as a combined fleet. We're talking close to 40% market share. We're talking significant overlap at airports, so massive, massive regulatory headaches and hurdles here, not even to mention that American Airlines has a less than optimal balance sheet. But nevertheless, if there's ever been a time to do something audacious and, dare I say, somewhat crazy, this might be the time, and at least that's what we think is what's driving Kirby.
Okay. When I first saw this story, I also thought, what does he see coming in terms of the need for sort of taking this kind of action? Is he getting ready for something, or is this just opportunistic?
It's probably a little bit of both. Kirby's always been an opportunist to sort of be able to look around the corner. We heard from him quite recently when things kicked off in Iran that, you know, now is the time to prepare for tougher times ahead. He's sort of weeded out some of the lesser performing routes. He's cutting some costs. He was one of the first people to really right-size the airline and push them more into sort of the premium part of the market, and he's earning the dividends from that. So you have to give him credit for being able to sort of anticipate what the airline industry might be doing next. And if you, again, think about consolidation that has happened in the industry, it's always happened in times of distress, and things won't be going back to normal anytime soon. So he's probably thinking, we're in a tough period for a longer time, and we have a political window right now that might be closing sooner rather than later. Remember, the midterms aren't that far away. So you might think, now's the time to try something, so I'm going to float it.
Benny, great scoop. Thank you very much indeed for bringing us the details of it. Benedict Kemmel, our aviation editorial leader, on that fantastic story. We're going to watch that one and see how it develops in DC today. Let's turn our attention to what is happening in the luxury space. LVMH shares under a little bit of pressure this morning. Not as much as they were earlier, but we're still down by, let's call it 1.7, 1.8%. We had details last night from the business and some significant misses in the key fashion and leather goods units. Louis Vuitton certainly impacting the business. The Middle East was under pressure, but actually China was okay, and the United States actually looked pretty good as well. So let's get the details on what is happening here. Andrea Felsted, maybe not as downbeat this morning as maybe the market is on what we are seeing in these results.
No, indeed. I thought they, you know, ticked all the right boxes in the areas that matter. So in fashion and leather goods, crucial division, got Louis Vuitton, Dior. US consumers had improved from the final quarter of last year when the comparisons were very tough with the year earlier because they'd been this sort of post-election boom that was anniversarying. China, you know, it is slowly getting better. Recovery is still very fragile. It's not getting any worse, but that also showed improvement. Those are really the two areas that matter for the global luxury industry's recovery. Obviously, what's happened in the Middle East is not helpful at all. They did also float the idea that some of the spending from the Middle East could be repatriated to other areas, which nobody had talked about before. So maybe all of that spending isn't lost. Some of it could move to other areas. So I thought on the whole, and they said without the war, actually, sales of fashion and leather goods would have been flattish. The other thing that was quite pleasing is that we're having this big creative reset in luxury at the moment. They said Jonathan Anderson's products at Dior were selling well, being a good response. So that's very important. That does seem to be helping Dior.
If we're getting to the weeds of designers, how's Demna doing over at Gucci?
Well,
Kering's about to report.
I'm not optimistic on Demna. I'm really not. I thought he was the wrong designer. I haven't been impressed with his products. I thought the first sort of collection with the crazy film was great. He was saying, come here, everyone's welcome at Gucci. There are lots of different type of customers that you know, Gucci can work for all these different type of customers. I thought the catwalk show in February was a bit of a step backwards. He did produce some items that went into stores and online afterwards, after the show. We'll get a feel for how those are selling. They're bound to say the reception was great and they're selling well, but I'm just not convinced. Chanel's had a fantastic debut with products by Matthew Blasi. Dior seems to also be selling well. I don't get the sense of the response to the Demna products has been as exciting.
How long does he have to get it right?
I think they've got to stick with him because, you know, they've had two big resets. So they had Alessandro Michele, who did the granny chic, big logos, fantastically successful until it wasn't. Then they had Sabato De Sarno, and this attempt to take it to quiet luxury, which didn't really fit with Gucci. Now they've had another reset with Demna, they want him to bring the sort of fashion authority. Gucci's about being exciting, being fashionable, so he's got to bring that. I'm not convinced he's going to do it, but they've got to stick with him. Now, what is also interesting is he was appointed before Luca Di Maio. So, Luke, if it doesn't work, Luca Di Maio can say, look, no, not my fault, here's who I... But that would mean like that would be like a third reset, and then that's going to put the sales recover. So I don't think they've got any choice but to stick with him and to try and make it work.
Let's talk about MS. It's been announced on its own. It's kind of the Ferrari of the luxury. There's a long waiting list. You can't get hold of a Birkin bag. Is that halo beginning to wobble a little bit?
Yes, it is. Now, if you look, there's two things going on. Bernstein do a very good index of the resale values of the Birkin. And Birkin Kelly, Mini Kelly, all the quota bags that everyone wants. Now, what is really fascinating is it exactly mirrors the luxury boom and bust. So it was over 2 times, 21, 22, come down to below 2 times now. So Hermes is as cyclical as the market, which was something that surprised me. Now, what we've also got going on is all this creative renewal, and Chanel has done an incredible job. Chanel were at the forefront of all these discussions about greedflation, pushing prices up too high. They've debuted all these bags, and suddenly everyone's forgotten about that. They just want to get their hands on the bags, and they have been clever in the pricing. They're not cheap, but they're not. They've massaged the pricing architecture slightly. They're also playing the Hermes game. They're making them waitlist. If you want a bag, you've got to go and put an expression of wish, and that just makes if you can't get your hands on one of these it bags, that just makes you want it even more. They've been very clever. Hermes hasn't got a creative renewal. Grace Wells Bonner will join to do menswear, and she's the lady who helped put the Adidas terrace styles on the map. So she's capable of building hype. But at the moment, they're up against all these creative renewals. It's grown in size. There are lots of Birkins on the second-hand market. So I think for the first time, they've got competition and questions about whether it's a sustainable.
Yeah, people were talking about the Birkin being a kind of asset class on its own, a kind of tradable asset class. That maybe fades a little bit. Andrea, nice to see you. Thank you very much indeed. Bloomberg opinion columnist Andrea Felstead. We are going to be speaking to the CEO of Kering a little bit later on. Catch that interview with Luca Di Maio at 3:30 p.m. London time, Thursday. So lots of questions. Andrea's just laid out some of the challenges that he is certainly facing. We've also got a great conversation coming up a little bit later on here on Bloomberg, coming out of DC. Francine is not in this chair because she's over in DC, and a little later on today she's going to speak with this lady, the president of the ECB, Christine Lagarde. Many challenges on Christine Lagarde's plate right now. What is she going to say to Francine a little bit later on? Could certainly be market moving. It is the IMF spring meeting in DC. This is what markets look like right now. We are bouncing back. There's hope that maybe further talks are going to take place between Iran and the United States. That's enough to lift things right now, and we are certainly on the positive side of the ledger, as you can see. So that's it from me. Up next, I'm going to return you to New York. Bloomberg Brief is coming up next. Hope you enjoyed the show. We'll do it all again tomorrow. This is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York, and beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing because I never watched the movies. I was traveling the business, but of course after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So example, Nobu Hotels idea come from him. He said, hey Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It is 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Matt Miller in for Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the trading day. Blockade stress test. A U.S.-sanctioned China-linked tanker sails out of the Strait of Hormuz, challenging President Trump's Iran crackdown in real time. And an airline power play, United pitches a blockbuster tie-up with American Airlines that could reshape the industry and trigger a regulatory fight. Plus, boring would be better. Big bank earnings continue today as shareholders hold out hope that the massive miss in FICC trading at Goldman Sachs yesterday won't carry through to JP Morgan, Wells Fargo, and Citi today. Let's take a look at what's going on with your markets after we closed up in the cash trade with a gain of more than 1% yesterday. We're adding to that today with futures higher by about 0.25% on the S&P, by almost 0.5% on the NASDAQ. Take a look at what's going on with treasuries this morning, where yields are coming down actually across the curve. The 2-year yield at 3.76 right now, off a little bit more than 1 basis point. The 10-year yield off almost 2 basis points at 4.2755, and the 30-year yield at 4.88 this morning. Obviously, we're watching oil, continue to watch oil closely, and it continues to come down. After yesterday, at this time, it was up 8% and then reversed that on the hopes that Iran would come back to the table for more peace talks. We're going to hear more about that today. The dollar is down 0.2%, but Brent and NYMEX are both off well under $100, with WTI trading at $96.38. For some of the individual stocks that we're watching this morning, let's get out to London. Chloe Melee is standing by. Chloe?
Good morning, Matt. Let's start with a big, very bold M&A pitch this morning. So our colleagues reported that the CEO of United Airlines had pitched a potential tie-up between United and its rival American Airlines. And so this potential deal would create the biggest airline in the world, which of course raises some serious antitrust concerns and could also trigger some potential backlash. And so we are going to be watching for any new developments there. But in the meantime, we are seeing that really boost the stock for both of those companies this morning. In more M&A news, Amazon is said to be nearing a deal to buy the satellite operator Globalstar, with a deal that could come as soon as today. So that's really boosting that stock in pre-market trading this morning. And for Amazon, that would allow it to compete with SpaceX in this very profitable broadband satellite market. And finally, Bloom Energy is also in the green today after Oracle agreed to buy power from Bloom to supply its AI data center. And so we are seeing that also really boost the stock, with Bloom Energy up almost almost 16% this morning in pre-market trading.
Chloe, thanks very much for that. We'll get back to you a little bit later. Coming up in this hour, we're going to speak with Katrina Dudley of Franklin Templeton on geopolitical uncertainties and price pressures. Plus, we're going to get a closer look at bank earnings with Saul Martinez of HSBC. But first off, Washington and Tehran are weighing further negotiations to extend the ceasefire before it expires on April 7th. There are now reports that the two sides could return to Islamabad as early as this week. This comes as a U.S.-sanctioned tanker linked to China sails out of Hormuz, testing President Trump's blockade on the waterway. Let's get to our team coverage with Jumana Bersetchi in Dubai and Laura Davison in Hong Kong. Jumana, let me first ask you about this this tanker that has sailed through the Strait of Hormuz. We hear it's linked to China and has been sanctioned, and yet it was allowed to pass. What do we know?
Yeah, well, you know, things could have gone two ways after the imposition of the U.S. naval blockade around the Strait of Hormuz. We woke up this morning actually to news of an uneventful night, and if anything, some progress perhaps on the anticipation of the next round of those negotiations, maybe later this week. And remember, we are ticking against a deadline here. The ceasefire does end on April 21st. But in terms of strait activity, there hasn't been a lot of movement. There is this one tanker, as you mentioned. It's called the Rich Starry. It is a sanctioned vessel linked to China. Now, this is its second attempt to cross the Strait of Hormuz. From what we understand, it attempted Monday morning. It didn't make the passageway, and then it tried again yesterday. And from what we can see, and we actually have a map that monitors this on the terminal. If you type map vessel go, you can track it yourself. But it seems to be exiting the strait now and making its way onto the Gulf of Oman, which doesn't necessarily mean that it's in the clear, because remember, CENTCOM isn't necessarily targeting the strait itself, but any Iranian port or Iranian coastline that is close to the strait. So not necessarily out of danger, but it does actually constitute the first test to this U.S. naval blockade that has been implemented since the late hours of yesterday afternoon over here in the region, and appears to be somewhat successful. And so perhaps that does actually pave the way to resuming some of those diplomatic discussions, which is clearly what markets and global investors are reacting to this morning.
Laura, you're our chief Washington correspondent. You're currently spending some time in Hong Kong, which is a great place to be because President Xi has made some comments about kind of the collapse of the Western order. What do we know about these talks, and how could China be helpful?
Yeah, this has been perhaps one of the most interesting sort of side stories of this Iran war to watch, is how China is positioning itself in being sort of a behind-the-scenes influence. We have seen China, over the past several weeks, push Iran towards the ceasefire and sort of continue to play a role influencing Iran. Today Xi was meeting with the Spanish Prime Minister in China and made a very pointed comment that the global world order is crumbling into disarray. He hasn't really made comments like that, and it's really noteworthy he did that with the Spanish Prime Minister in the room because Spain has been one of the European allies that has had the most tension with the U.S. Spain denied the U.S. use of its naval, some of its air bases, as well as its airspace during this conflict. So we kind of see, both Xi behind the scenes and China behind the scenes, looking to influence Iran, but also kind of looking to position themselves as a power player, as there's been really a lot of fissures between the U.S. and other NATO allies, and a lot of discontent there. China has been able to come in and sort of fill the void, almost acting like the adult in the room.
Jumana, how are the other Gulf states reacting right now, and what kind of role could they play? Because although, the Saudis apparently have gotten up to about 7 million barrels a day through their east-west pipeline, there's still a lot more oil that they could be shipping out, and at these high prices, I'm sure they want to.
Well, just on that point, before I respond to the to how Gulf states are looking at this, you saw the OPEC numbers yesterday. The OPEC group as a whole, the figures are down 27% month-on-month versus the prior month. The biggest drop coming from Iraq, but also Saudi Arabia, UAE as well. So clearly, the events over the last 6 weeks have disrupted their ability to produce at maximum capacity. We know that, even though there has been a lot of successful rerouting of oil. As you mentioned, the East-West pipeline. There's also the Fujairah-Habshan pipeline in the UAE as well. Now, as it comes to the situation right now, I will just say that it was of note to me that the Iranian foreign minister actually did have a series of calls yesterday with some of the key foreign ministers in the region, including the Qatari foreign minister and the PM. He also had a call with the Saudi foreign minister as well. This morning, the Saudi foreign minister had a call with Qatar. So it's interesting to see that the diplomatic channels are beginning to perhaps get unlocked and unblocked again. There is certainly a sense that the mediators are pushing aggressively to get US and Iran to come together. And this is something that I said to you yesterday, Matt. You know, remember on Sunday when Trump announced the naval blockade, he also said that the discussions and the meetings had gone well. And there were a couple of points that were still outstanding. And we understand from our reporting that those points pertain to, obviously, the future of the Strait, but then also the nuclear file as well. So I suspect in coming days, there's going to be a lot of focus on whether you can bridge the divide between the perhaps more maximalist stance of Iran when it comes to enrichment and their right to enrichment, and what the US are asking for, which is zero or low little enrichment and a suspension of their enrichment activities over the long run.
All right, Jumana Bersetchi and Laura Davison, really appreciate your coverage. As we were speaking, we got headlines across the terminal that the Chinese and Russian foreign ministers are going to be meeting in Beijing as well. So we continue to see alliances work towards a solution here, or hopefully they're working towards a solution. Let's turn to airlines. Speaking of alliances, shares of American getting a boost in pre-market trading. Bloomberg learned that United CEO Scott Kirby has pitched a possible combination. The tie-up would create the largest airline in the world between United and American, though the proposition would face intense antitrust scrutiny under normal circumstances. But how about under this administration? Let's get out to Bloomberg's Benedict Campbell and ask him, Benny, you know, the Trump administration has been really keen to strike down regulations. That was part of President Trump's campaign platform, and antitrust has been weakened substantially. How would this combination, do you think, look to this administration?
I mean, whichever way you look at it, it's still pretty audacious, but you make the right point. These are special times that we live in. Trump has always said that, you know, bigger is better, bigger is sort of the way to go, and this would be as big as it gets. If United were to combine with American Airlines, we would have a carrier with more than $100 billion in revenue. We would have a carrier with almost 3,000 aircraft. We'd have significant overlap, though, on a lot of hubs in the U.S., and significant market share in the US and globally. So quite a lot of antitrust issues that would come up. Surely consumers, surely rivals would take a very hard look at this. But this is Scott Kirby, the United Airlines CEO, probably seeing how far he can push things. He sees a window here. He sees an opportunity under this administration that he probably won't get again, certainly not under a future Democratic administration, if past failed deals are any guide. So he sees this opportunity, and he sort of floated it. This is our understanding a couple of weeks ago, two senior officials. Again, we don't know where talks stand right now. Nothing may come of them, but the fact that he's putting it out there is very interesting in its own right.
So this is a massive story, and we're going to continue to cover this throughout the day, Benny. But I have to ask you also about Lufthansa, because you happen to be obviously in the capital city, and I see a headline: Lufthansa faces worst strike in decade, and I feel like it's always the worst strike in a decade for Lufthansa. What's going on here?
Well, nothing's going on at that airline anymore. They really are in dire straits at the moment. This is an airline that's celebrating its 100th anniversary. There's a big celebration happening this week in Frankfurt. Chancellor Merz is there, and you know what better way to rain on their parade than to stage another strike? So we had the pilots on Monday and today, and then the cabin crew, who already struck last week, have come back and said, okay, we're going to come back for more on Wednesday and Thursday. So really, we're talking about a week of continuous strikes here, and this is starting to really weigh on the company. There was a time a decade ago when I covered this airline, and they were really in trouble then, and then they sort of entered a period where they got back to normal, they got a collective bargaining agreement, and things seemed to be working out for them, and we are now back in this endless cycle of strikes, and how the airline is going to get out of it, nobody really knows, but it's really weighing on the balance sheet. It's really weighing on sort of the public, which are moving to Deutsche Bahn, which is the rail operator, and you and I have suffered through their unreliability. So really, sort of made in Germany and German reliability are really being put to the test here.
It should be noted that they're not entirely unrelated, right? Lufthansa and United are both a part of the Star Alliance. So a problem with United could be, or with Lufthansa could be with United as well. Benny, great getting some time with you this morning. Bloomberg's Benedict Campbell, I'm sure we'll probably speak more throughout the day. Let's get to some of the other top stories trending on the terminal this morning. HSBC's top banker for Wall Street and Europe quits. Jerry Keefe has left just over a year after being put in charge. According to a memo obtained by Bloomberg, Keefe is taking a role outside the financial industry, which is fascinating. His exit follows a major overhaul of global operations at the Hong Kong-Shanghai Banking Corporation. LVMH results disappoint. Sales at its fashion and leather goods unit dropped 2% in the first quarter as the war in the Middle East weighed on demand for luxury goods. Shares fell as much as 3% in Paris. Louis Vuitton Moet Hennessy shares are down 26% year to date, their worst start to a year on record. And BP says its first quarter oil trading performance was exceptional as the Iran war drove a surge in prices. British Petroleum said its traders were able to cash in on volatility in the oil market, but gas trading results were just average. Coming up, a big day for big bank earnings. JP Morgan, Citi, and Wells Fargo all set to report before the bell. We'll push ahead to that next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Most
most of the volatility, I think, is positive. I think the companies understand how to make a dollar when you have these topsy-turvy markets. They've been here before. We've seen many examples of volatility the past several years. So I think it's just a different circumstance, but the same volatility. To some extent, I think volatility is your friend. But you may have had a loss of the golden quarter, and I think as we see the other players come out the next couple of days, it may look and feel a lot different.
JP Morgan, Wells Fargo, and Citi are all set to report before the bell following Goldman's disappointing FICC trading number, but record high equity trading revenue. Let's bring in Bloomberg's Charlie Wells for more. Charlie, we saw a blowout number, obviously, for equities trading, and then really a huge miss on the fixed income side. Is that going to play through to these other big banks today?
Yeah, I mean, that really is a question, and it's really sort of a surprise, because I think on that point about volatility, there had been really high expectations that both equities and FICC would benefit from that, from these trading desks able to talk about a lot of the uncertainty that's been in the market right now. But maybe analysts got ahead of themselves. That's what David Solomon was saying yesterday on his analyst call after those disappointing earnings on the FICC side, despite that blowout, despite that historic number coming from equities trading. And I think as these companies, as these other banks start to report today, JP Morgan, Citigroup in particular, we're really going to get a lot of focus on that area that maybe, analysts did get ahead of themselves. On the Citigroup side, I think one issue is the ratio of FICC to equities trading is really high. So that's a big number. So if you get a downside surprise, that could bode very poorly for the Citigroup stock. You've also got expectations for FICC growth at JP Morgan very high. So I think this is an area that analysts really hadn't been expecting to be under pressure, and but that could have really negative outcomes if they don't deliver on these high expectations.
The other big issues, Charlie, aside from the volatility that we see caused by the war and maybe a lack of confidence from that we're hearing from HSBC this morning, is or has been AI, right? Especially after that meeting that was called by Secretary Bessent and Fed Chair Powell. Plus private credit. And, Wells Fargo may have some real exposure to that as well. What do we know about these two issues? Which banks are going to focus on them?
Yeah, I mean, look, what we got in these calls and this call yesterday from Goldman Sachs was, again, an approach about these topics. David Solomon basically saying that he sees a lot of opportunities in private credit and really trying to, split the difference or kind of make a difference between kind of noise and the sort of headline risk that Solomon talked about on the private credit space that we've been hearing. We've been hearing a lot about the push for redemptions at a lot of these funds, but trying to basically say that, the way we do private credit at Goldman is different from how it is done elsewhere. So I think that's a story that we might hear from a lot of these banks, going into the reporting from Wells Fargo, from JP Morgan, et cetera. And then there was AI. There was a lot of talk about cybersecurity. There were questions about that meeting. That meeting was hastily arranged last week and really kind of, drove home the point that there's a lot of concern at these systemically important banks about what new AI models could do to security. Could they destabilize the financial system? What are they doing? And there was an attempt to really reassure analysts as they asked about AI, so no doubt we're going to get similar questions today.
Yeah, David Solomon saying that they're not only aware of Mythos, but they have the operating system and they're using it. All right, Charlie, thanks very much for joining us. Bloomberg's Charlie Wells, they're reporting on the banks. As I was saying, HSBC CEO George El-Haydari weighed in on the conflict in the Middle East and its implications on the lender. Take a listen.
Trade has certainly been disrupted. Now, it's been tariffs of 2025 have disrupted trade with the US. This time we're seeing a major disruption in trade far beyond the Middle East, but in particular towards Asia because of the Strait of Hormuz closure. We believe there are multiple hundred, probably up to 800 ships that are still locked up in the Gulf. And, of course, the passage daily 150 ships has dropped to maybe 5 to 10 ships at best. So that is hugely disruptive. The impact of such will be felt way beyond the Middle East, and that is one worrying factor for us, not just in price of goods, oil, refined products, LNG, LPG, but also fertilizers, metals, etc. But it's also going to be felt in the availability of such goods. And we worry that the continuation of this conflict will have that impact globally, way beyond the Middle East. Now, this being said, COVID was a bigger impact on trade flows and trade patterns. And we learned, businesses have learned how to recover from COVID. So frankly, the moment the conflict ends, we can push on a button and in a matter of months, we can go back to normal. But we just need to have this opportunity to push on that button.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield back on those deposits. So when there's $1, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Let's take a quick look at what's going on with oil this morning as we saw one U.S. sanctioned China-linked tanker get through the strait overnight. We're looking at Brent crude down 1% right now, 98.41 a barrel here. Even more striking is NYMEX down more than 2% at $97 flat. This is Bloomberg.
what some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, you know, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content and never the two shall meet, but there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. You know, stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg. It is 5:30 a.m. in New York City, 10:30 in London. Good morning. I'm Matt Miller in for Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the trading day. Blockade stress test. A U.S.-sanctioned China-linked tanker sails out of Hormuz, challenging President Trump's Iran crackdown in real time. And airline power play United pitches a blockbuster tie-up with American that could reshape the industry and trigger a regulatory fight. Plus, boring would be better. Big bank earnings continue today as shareholders hold out hope that the massive miss in FICC trading at Goldman Sachs yesterday won't carry through to JP Morgan, Wells Fargo, and Citi today. Let's take a look at the gains in futures after a 1% plus gain on the cash trade yesterday. So we're getting closer to an all-time high on the S&P. We are now trading in the cash session at a higher level than we were on February 27th before President Trump joined Israel to invade Iran. NASDAQ futures up 0.4%. The small caps gaining 0.5% here. Take a look at treasuries as yields come down pretty much across the curve. The 2-year at 3.76, the 10-year at 4.28, and the 30-year at 4.88. In terms of oil, we see Brent and NYMEX both well under, I should say, $100 a barrel, with WTI trading at 97.20 and Brent crude at 98.61. For some of the single stocks that we're watching this morning, let's get out to Chloe Melee in London. Chloe?
Good morning, Matt. Let's start with airlines today. The CEO of United Airlines is said to have pitched a potential tie-up, a potential combination between United and its rival American Airlines. So this is a potential deal that has the possibility of reshaping the airline industry, creating the biggest airline in the world, and therefore really setting off those antitrust concerns and triggering a potential backlash. And so we're watching out for anything more on this. But in the meantime, both American and United are up in pre-market trading. Moving on to more M&A news, and Amazon is said to be nearing a deal for Global Star, which is a satellite operator. And so this is something, this is a deal that could be announced as soon as today. And this is really boosting those shares in Global Star this morning, up almost 17%. And finally, Dell and HP are down this morning after NVIDIA denied a report that it was considering a big deal in that PC landscape. And so this is something that had really sparked, this report sparked a big rally in those shares. And now the denial of that rumor is sending those shares very much back down this morning.
Chloe, thanks very much for that wrap. A lot of M&A news to talk about this morning. Let's get, though, back to our top story in the Middle East. The U.S. and Iran are mulling a second meeting to extend the ceasefire after President Trump enforced maybe even failed to enforce, a naval blockade of the Strait of Hormuz. Reports say that the two sides could return to Islamabad as early as this week. Joining us now is Laura Davis. And Laura, I say maybe because I'm not sure about the details of that tanker that has come through. Maybe it didn't dock in Iran, maybe it wasn't carrying supplies, but it was sanctioned, and we know that this administration considers illegal. What do we know about the possibility of talks?
We know that there are talks about talks. The question is, will those come to fruition? Exactly who will be at the table? But there is a clock ticking here. There's just about a week until that 14-day ceasefire does run out. So, in the coming days or this weekend is really sort of the latest they could push these talks in order to, with the hopes of securing some sort of extension to the ceasefire. And that right now is really the best that folks can really hope for, given where the U.S. and Iran are on still some of these maximalist positions when it comes to Iran's nuclear program, when the Strait of Hormuz still being a mess in terms of who controls it, what's happening, who can pass through. We're in a situation where we're looking at kicking the can down the road a little bit to continue talks versus some sort of big peace agreement that would come together in just the next couple days.
What is the latest on the nuclear red lines that both sides have? I continue to see reports that the Iranians may eventually back down, or rather President Trump suggesting that they will eventually back down.
Yes, there's been a lot of wish casting from Trump here on what he thinks the Iranians could or should do. But he has been clear that his red line is that the Iranians will not have a nuclear weapon. They will not have a nuclear program. The Iranians have said that they have a right to a certain level of enrichment. Particularly they focused on the energy piece of that and being able to use nuclear energy for civilian purposes. That is essentially the deal that Obama struck several years ago. Is that that Iran would be able to have a certain level of nuclear enrichment. This is, of course, an ongoing piece of the pie. Iran now has a little bit more leverage in these talks than they did even some years ago because they now control the Strait of Hormuz. And as we're seeing, possession is 9 times of the law right now. And it's unclear that if this blockade will be enforced. Trump has said he will, blow ships up if they try to cross this blockade. But so far, at least in the past 6 weeks, Trump's bark has been much worse than his bite when it comes to following through on some of these threats of military force.
All right, Laura, thanks very much. Laura Davis, and their chief Washington correspondent, spending a little bit of time in Hong Kong for the month. Let's get now back to markets. Joining us here at the desk is Katrina Dudley, senior investment strategist at Franklin Templeton. Katrina, good morning. Thank you for waking up so early. It is, to me, fascinating that we're now in equities, or at least as measured by the S&P 500, at a higher level than we were before the U.S. attacked Iran.
I know. How could you look at geopolitical pressures and we talk about it? How many times would you expect us to go into a significant amount of conflict? We're only 6 weeks in, but to have equity markets not reacting in terms of a significant continued downward pressure. And I think that is a reflection of expectations that this war will be short. You've had 6 weeks into conflict. We've got that you were just recently talking about here. You've got the ceasefire. It's still got another 7 days to go. But as we look at it, what's driving that market is really the AI narrative. We are still looking at, oil is a tax on the consumer, but you still do have the higher tax refunds coming through. And I think that's kind of that strength is what the market's reflecting.
Yeah, it's interesting because we leaving aside the concerns that you may have in the Middle East, the geopolitical doesn't always have an effect. But you would expect the doubling of the price of oil to actually have an effect on earnings. And so far, it doesn't look like anyone's that worried.
Actually, when you're talking about earnings, if you look at the best performing sector year to date, it is actually the energy sector. So they're the ones who are actually benefiting from this higher oil print that we're seeing. But where we're looking at it is the pressure on the consumer, and particularly the low-end consumer. So if I look at the consumer at the moment, we have got low unemployment rates. We've kind of come off at 4.5% high down to 4.3. So we're still looking at a very employed economy. And that's been, interestingly, in contrast to the AI narrative, which has said that everyone's not going to have a job within the next year to date. So, the employment numbers are telling us something different. And therefore, when we look at what is the impact of these higher oil prices, I want to go back to, it is, as you said, consumer spending. but they are actually now just spending some of their tax refunds that we were expecting. So maybe we're not quite as optimistic as those proceeds from the refunds are actually being diverted into the tank, literally.
Right, and I mean, $4 is a high price, but it's not as high as it was in 2022. And as someone who's lived in Europe for a long time can say, it's really not high globally. I was looking at, you point out energy is the best sector, and right you are, and more sectors have put up gains this year than losses. We're now positive year to date. The financials have been the biggest loser of all of the 11 sectors in industrial groups on the S&P 500. What is your take on the banks? Is this a buying opportunity?
I think you've got 3 big banks giving earnings, so I think that there's benefits here to waiting. Often we say it's better to get in ahead of the print, but I think here we're looking for a lot of information. We look at what was happening at Goldman Sachs, and we see, the FIC revenue number was very disappointing. Yes, it was offset, but it was offset by equities and deals and deal activity. And with this geopolitical environment, with a lot of uncertainty, we are a little more cautious about the continuation of that deal activity to offset the weakness you've seen in FIC. Now, that's what comes back then. The surprise to us this morning was actually the news coming out of United that, hey, we may tie up with American. Of all of the types of companies you would think, high oil prices are very much, they do weigh on the airlines. Right. That said, I was looking to buy tickets for the holiday season, and I was unpleasantly surprised at how high pricing has been. And that pricing narrative is actually not just because of what's happened in the last 6 weeks. It's actually been a narrative that started before. So you actually may be having some pricing discipline in the airlines. You have this merger, which suggests that you're going to have even more pricing discipline. So maybe it is a good idea for us to see this consolidation.
It's funny, as a consumer, you're not pleased, right? But as a shareholder, you would be happy to see pricing discipline because, prices for airline tickets haven't changed much in the last 20 years.
Exactly, and we've been talking about it my entire career about when will the airline CEOs get discipline and not kind of look at getting strong pricing and say, hey, if I just drop my ticket prices $100, I can completely fill my planes. But if you've traveled recently, the planes are full, the prices are high, and I think if you look at it, the consumer is still resilient, and it seems as though they are not impacted too much by these higher oil prices. And the airline tickets, as I said, they were high before this happened. It's not that they slapped an oil surcharge to give this pricing pressure or pricing increments, and so we do think it's going to hold.
Safe to say you're still bullish on stocks. You still see, we're going to hit record highs in your take by year end, and that without Fed cuts. Do we need Fed cuts?
So look, we're going to take the victory lap that we were talking about, a broadening of the market, and I have to say that is what we've seen. We have seen the tech stocks take a bit of a breather, and we've seen the entire market participate. And from our perspective, that is healthy, and that's a sign of a very healthy stock market, and we do expect that to continue. On the Fed rate side, look, Powell has been so clear in terms of saying oil prices are not, we're looking at them as a temporary, impact and a temporary, it will come through in inflation on a temporary basis. So I do think that they're going to pause, but I'm not necessarily sure. We're against the market here. We actually think that we will have continued rate cuts, but it's probably we've shifted those expectations out to the right.
All right, Katrina, great to spend some time with you. Thank you so much for coming in early this morning. Katrina Dudley there of Franklin Templeton. Let's get to some of the other stories trending on the terminal for you this morning. A Bloomberg exclusive kicking it off that Katrina and I were just talking about. United Airlines CEO Scott Kirby has floated a possible combination with American Airlines. According to sources, Kirby pitched the tie-up to senior government officials. It's unclear if an actual process to explore the deal is underway, but any merger between the two would create the world's largest carrier. United and American Airlines both declined to comment. Amazon is in advanced talks to acquire satellite operator Globalstar. The deal would boost Amazon's efforts to build its own satellite operation and intensify competition with Elon Musk's Starlink. A transaction could be announced as soon as today. And banks may soon be required to collect citizenship information from their customers, according to Semaphore. Treasury Secretary Scott Bessent said an executive order is in process. The order would require a passport or other proof of citizenship to open bank accounts. Coming up, JP Morgan, Wells Fargo, and Citi on deck for earnings this morning. More on that with Saul Martinez of HSBC next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
Most of the volatility, I think, is positive. I think the companies understand how to make a dollar when you have these topsy-turvy markets. They've been here before. We've seen many examples of volatility the past several years. So I think it's just a different circumstance, but the same volatility. To some extent, I think volatility is your friend. But you may have had a loss of the Goldman quarter, and I think as we see the other players come out the next couple of days, it may look and feel a lot different.
We're just a couple of hours away, or really a little more than 1 hour away from big bank results. JP Morgan, Wells Fargo, and Citi earnings all coming out following Goldman's disappointing fixed sales, but record high equity trading revenue. Saul Martinez, HSBC head of U.S. Financials Research, joins us to talk about what we can expect. And Saul, good morning. First off, thanks so much for getting with us very early. You've got a lot to do today, I'm sure. What do you think about the fixed income trading results that we saw, the big disappointment that we saw yesterday with Goldman? Is that likely to play through to JP Morgan, Wells, and Citi?
Yeah, I think, oh, thank you for having me, first of all. It was a disappointment, clearly. I don't know that we got a great explanation from Goldman as to whether this is more generalizable or whether this is more of a company-specific dynamic. When you drill down on where in FIC, they did have good results in currencies, but the rates dynamic the rates business did disappoint. So it is something I think you have to be cognizant of, especially for JP Morgan and Citigroup, because they do have very sizable FIC businesses. We do think, though, this should be a good quarter for trading overall. Both Citi and JP Morgan have given indications of where they estimate markets businesses as a whole will end up in the first quarter. They're both guiding to low double digits to mid-teen type of growth there, which is higher than what you saw for Goldman, who grew 8% despite very, very strong equity results. So I do think it's something to monitor. It isn't clear whether it was more of a Goldman specific event, but we do think that in the cases of Citi and JP Morgan, the markets businesses should have decent results and faster growth year on year than what you saw at Goldman.
By the way, Saul, we're watching closely. Danny Berger and I are so focused on private credit. That story has been fascinating. What kind of exposure do you see at JP Morgan, at Citi, at Wells Fargo in terms of private credit?
Yeah, well, I think that's going to be a very big focus area for these results. What kinds of exposures? We don't have specific exposures. We can use regulatory data to get a sense of what the exposures are to private credit. I do think that the companies will be pressed to provide more details, not just on overall levels of exposures, but some of the details. What types of exposures do they have to non-listed BDCs? What kind of underwriting they're doing? Are these senior and structured? What kind of collateral? How much software exposure is there? What kind of advance rates or loan to values they have in these with private credit? I do think it's important to have some perspective here, though, on private credit. Lending to non-bank financials has increased quite a bit. But if you think about private credit, the concerns are direct lending and non-publicly traded BDCs. And direct lending is about probably, I've seen various estimates, $1.5, $1.6 trillion. So it's not a small amount, but the bulk of that is in entities that have permanent capital. Where you're seeing the issues is in non-listed BDCs with more retail funding. That, there's about $380 billion of assets in non-listed BDCs. The bulk of it is direct lending, but not all of it. So if you look at that relative to the size of bank balance sheets, banks have $13 trillion of loans. Just the banks I cover, I think, have $7 trillion of loans. I think it's a manageable risk, but it is something, I wouldn't say we're not concerned about it, because I think any hiccup in private credit, it would be negative for the stocks. So from a systemic standpoint, I'm not overly worried, but obviously this is something you do have to monitor given the growth of this asset class, and banks do have some exposures here. For Wells Fargo, I think it is probably the biggest or a bigger focus area. Let's put it that way, because this business lending, the business of lending non-bank financials broadly, but lending to financial sponsors is a bigger business for Wells Fargo. And they have been speculated to have some exposure to MFS, the defunct mortgage lender in the UK. So it will be a focus area, especially for Wells Fargo in these results.
So the advisory revenue at Goldman Sachs was notable yesterday. I think it was up 89% from the same quarter a year ago. They're obviously at the top of the league table, but JP Morgan's nipping at their heels there, and Citi's not far behind. How do you expect that business to fare?
I think it'll fare well. We've had very good M&A activity. The indications are from the banks that this was a good quarter, and the outlooks are generally seen as positive here. One interesting dynamic with M&A is that corporates have seemingly adapted to a highly volatile macro environment, seeing volatility as maybe a feature of the system as opposed to a bug, and realizing that they can't put off strategic investments indefinitely, and they're still doing M&A despite the volatility and looking to get the benefits of scale. You also have financial sponsors who are being pressured by limited partners to provide more liquidity, an exit event. So there are, and obviously the regulatory environment is more favorable than it was, under the Biden administration for deal making. So there are, despite the macro uncertainties, the backdrop for M&A does seem favorable. The investment banking outlooks that banks have provided heading into the quarter, which obviously include advisory, have been fairly, positive, with double expectations of double-digit types of year-on-year growth. I do think these results, especially on the advisory side, should be healthy, and the outlook for advisory does seem to be pretty benign right now.
Saul, thank you so much for spending some time with us. Precious time on a day like today. HSBC's Saul Martinez runs bank coverage for them. Coming up, those bank earnings and economic data are all part of your trading diary next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Let's take a look at what's ahead today. Bank earnings continue. JP Morgan, Wells Fargo, and Citi all out before the bell. We also get ADP employment data at 8:15 a.m. New York. You're watching the labor market closely. If you're watching inflation closely, we get PPI, the producer price index, out at 8:30. Don't miss our exclusive interview with ECB President Christine Lagarde. That's in my program, Bloomberg Open Interest, every weekday from 9 to 11. In terms of the movers, American Airlines is higher on the report. You can see 5% in the pre-market that United pitched a possible tie-up. Global Star up, said to be in advanced talks with Amazon for a deal to boost Amazon's satellite operation, and Bloom Energy up, Oracle agreeing to buy that power from that energy company. This is Bloomberg.
world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's going to be a lot of stress on the market.
Investors always hit the sidelines when you have uncertainty.
It's risky not to take risks.
The market is being very calm about this whole situation.
There's a lot of other themes that people are going to have to sort of roll their sleeves up on again.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, in the green for the year, the S&P 500 wiping out losses since the start of the war as the White House is playing up the prospect of further peace talks, and crude is coming off its fourth straight day, closing below triple digits. WTI trending close to 96 this morning.
This is a FOMO market right now. Everyone doesn't want to miss out on potential gains. As Bank of America strategists put it this morning, strong rallies suggest that the upside remains the greater concern. This is in stocks. The downside is in oil prices. As you see right now, poly-market odds of the conflict ending this month are 75%. That is the highest level going back since the start of this conflict. People are ready to just move on.
The White House playing up talks about talks. Let's get to the latest reporting from Bloomberg. The US and Iran in discussions about holding another round of face-to-face negotiations for a longer-term ceasefire.
And it could be as soon as this weekend, according to Reuters. And one individual speaking to Reuters said no firm date has been set, with the delegations keeping Friday through Sunday open. So another weekend where everyone will be working. But to Lisa's point, it's not just FOMO. The market is really starting to price in either there's going to be an off-ramp of peace and a cessation of hostilities for good, or the United States is winning right now. That is how the market is looking at this conflict.
I don't think the market's looking at anything. This market's moved on. Based on the price action of the past few weeks, this market has moved on. Bank earnings later on this morning will move on. JP Morgan later this hour, later this morning, Wells Fargo and Citigroup.
And it's fascinating because yesterday Goldman Sachs disappointed with one aspect of their earnings, the fixed income currencies commodities trading. And that sent the shares lower by almost 4%. That said, all the other financials were actually up on the day and the best performing of the day. So people looked at this and they said, this is a Goldman Sachs issue. This is an expectations issue. This is not a banking issue. And it's really something where the bar is still very high for the other players.
Company story of the morning is not in the financials. Let's talk about the airlines. Check it out. American Airlines and United. Scott Kirby of United, according to our sources here at Bloomberg, approaching American about a tire. Just think about that. Sprint and JetBlue couldn't get it done. And we're talking about American and United?
Well, so antitrust regulators might be more amenable to tie-ups, but probably not this one. That said, this is fascinating on a number of levels. First of all, Scott Kirby, the CEO of United, used to be the president of American Airlines. He knows this airline pretty well. Number two, there is going to be a period of distress. This is what a lot of different airline executives have talked about. If oil prices remain high, who are the winners going to be, and how much can you ultimately see some tie-ups get explored in this market?
Obviously, the regulatory environment is more amenable during the Trump administration, but this kind of tie-up is just potentially too big, especially with this administration ahead of the midterm elections is trying to talk about affordability. Not only are they thinking about this, Reuters said Scott Kirby approached President Trump directly at the end of February, and he was there for a meeting talking about Dulles Airport. He said, you know, I might make a play for American. I'm sure he pitched it in a way that Trump said, I love a big deal, maybe this can happen. But I'm not sure if the DOJ or the Department of Transportation is going to greenlight this.
We'll have more on this story later this hour. American in the pre-market higher by some 5%. Coming up this hour, we'll catch up with Brian Levitt of Invesco, with stocks erasing the year's losses. We'll speak to the French Minister for the Economy and Finance, Roland Lescure, as Europe faces an energy shock. And Gerard Cassidy of RBC reacting to the latest big bank earnings. JP Morgan later this hour. We begin this hour with our top story. The US and Iran weighing another round of peace talks as the Strait of Hormuz blockade enters day two. Bloomberg's Jemana Baseshi joins us now from Dubai. Jemana, welcome back to the program. Just how is that blockade holding up so far this morning?
Yeah, well, I will say, John, actually, it's become a bit of a side story this morning, insofar as the evening was rather uneventful. So the blockade went into effect at around 6 p.m. regional time, around 5 p.m. in Iran. And what we saw overnight was an attempt from several ships to get through the Straits. And there's one that we've been monitoring throughout the course of the morning. This is a U.S. sanctioned vessel that has links to China that has been making its way through the Strait of Hormuz. We understand now that it has passed through the strait and is on its way to the Gulf of Oman without any incidents. So, you know, this is perhaps the first example of a vessel or ship that's trying to make it through the strait under this new naval blockade introduced by the U.S. But I should say it's unclear whether it stopped at any Iranian ports, so not a real test per se. But I think the real story this morning is that there have been numerous reports overnight suggesting that we may be in for another round of discussions, and these are mediated discussions, of course, between U.S. and Iran. Reuters reporting that it could happen in Islamabad towards the end of this week. And remember, you have to go back to what President Trump said over the weekend. He did actually describe the talks as having gone well. There are a few outstanding points. He says the nuclear file is still going to be a focus. And again, you know, other outlets reporting overnight, New York Times suggesting that there's still ongoing disagreement on the extent of enrichment that the U.S. are willing to allow, whether it's low enrichment or no enrichment. The Iranians are saying that they want to push for a 5-year timeline on the suspension. The U.S. want to see a further timeline of 20 years. Whether the two can actually bridge the gap between them, you know, is a big question before we go into this next round of potential discussions, yet to be confirmed by both sides. But I will say that as far as the ceasefire is concerned, it is still holding up. And there have been multiple diplomatic channels being worked over the last 24 hours. The Iranian foreign minister had a call with the Qatari PM. He also had a call with the Saudi foreign minister as well, clearly moving in the right direction from, you know, the Iran Gulf perspective. And then let's not forget that the ceasefire, in theory, ends in a week's time. So if they want to get something done, then it would probably have to happen in the next couple of days, yet to be confirmed, though, by both sides.
Jemana, good to see you. Good to catch up, as always. Bloomberg's Jemana Baseshi leading our coverage out of the region this morning. Brent at 98, WTI at 96. To Jemana's point, the talks are ongoing. And so long as the talks are ongoing and the back end of the futures curve is behaving, this market seems to be comfortable with deploying just a little bit more capital and adding to the rally we've seen so far.
Yeah, it seems like a rush in, frankly. And a lot of people are talking about how the pain trade is to the upside, because ultimately that's what it's always been. And they want to forget about this. And they're getting a sign. Maybe they can start to do that.
Here's the view on Wall Street so far this morning. Brian Levitt of Invesco writing, if the futures market is correct and oil prices are around 80 per barrel in 12 months' time, that outcome would likely not be a deal breaker for the US economy. Brian joins us now for more. Brian, good morning.
Hey, good morning.
You are our FOMO guy. We always introduce you as our FOMO guy. If you're sitting this out, what are you missing out on?
I think the specter of April 9th, 2025 looms large. I think a lot of investors are contemplating it, where the administration backed off from its worst impulses on tariffs, and you had one of the best up days in the market you've had in years. And so this whole time, investors have been very cautious about missing this. And if we were to have said on February 27th at the close of the market that this conflict was going to begin, I don't think most people would have thought that the worst you'd see is 10% down in the Dow. Dollar barely moved, credit spreads barely moved, 5-year inflation expectations up a bit, but not a ton. Market's going to price out the rate cuts, but without much incidence. So it's been a market that obviously has been a little volatile around events. It's always volatile around policy uncertainty, but it's a market that's just wanting to look past it, at least to this point.
We've had a total reset. We've wiped out the losses since the war started. We're positive on the year so far. Where are you comfortable, just thinking about the risk-reward at the moment, given the reset we've seen, where are you comfortable being within the equity market?
So I'll take two questions there. One, are stocks going to continue to outperform bonds? We think so. You would be in a much worse environment with regards to spreads, inflation expectations, policy tightening, if we didn't think stocks were going to outperform bonds. Now, in terms of market leadership, that's a tough one, because coming into the year, all the leading indicators globally were in expansion, and that's small cap, that's emerging markets, that's value. And they, for obvious reasons, have given you a little bit of a slowdown signal here because of $4 gallon gasoline, so that gets you back into mega cap and quality. So which one is it? That's a very big challenge over the short term, right? Because we just don't know the duration of this. So I hate to use the word diversified, but I'd say, risk back to neutral, where you want to make sure that you have some higher quality mega cap in the portfolio, but also diversified into things like emerging markets that are likely to outperform as this improves.
So you're not alone. BlackRock also yesterday, Jean Bovin was saying that he also liked emerging markets with the assumption that this conflict ended. It's funny. It feels like taking a driver's ed class where they tell you everything that you can go wrong, and all the kids just ignore it because they try to just get past it. Just get me in the car. I want to go where I want to go. You hear Fatih Birol saying that prices are high, but they're not reflecting the severity of the problem. I agree there is a disconnect. We will see a convergence. At what point do you have to hedge against the chance that this is not over?
Yeah, so what I've been telling investors is that, look, we're not military strategists the same way we weren't molecular biologists in 2020, although we certainly tried to play them on television. So I watch what the market is telling me. And, look, when this started, people said, well, if this goes on more than a couple of weeks, we're in trouble. Well, it's now 6 weeks. Well, if this goes on 3 months, we're in trouble, right? So look at what the market is telling us. And, to come back to the same things, you're just not seeing breaks in the credit market. You're not seeing the bond market in disarray. So I wouldn't be thinking about it necessarily from the duration of it. I would be thinking about it from what the market is telling us. And the market is telling us that we're likely to see this come to a conclusion sooner rather than later.
A number of strategists have said that the market is also suggesting that tech needs to really take the leadership again, because that is going to be the area, to John's point earlier, that it might be most immune to inflationary pressures that are more likely, frankly, to $100 a barrel than $130 or $140 a barrel. So do you agree with that type of positioning versus earlier this year?
Yeah, that's what a slowdown would tell you right now. That's what $4 a gallon gasoline will tell you. No rate cuts. So you're back to an environment where you're looking for growth in what's likely to be a slower growth. But that can change fairly quickly. If you look at the backwardation in the oil market and you're back around $75 a barrel, the Federal Reserve comes back into play, you could see back that rotation to the broader market. So, that's a little bit of the frustrating part of it. And, we said coming into the year, this is the broadening market. This is the great global expansion. I remember talking to the team on Friday, February 27th, and said, don't talk to a pitcher during a no-hitter. This is great. And then we got the curveball. That is the Iran war. So, yeah.
Brian, how much of this, though, is Trump conditioning for the financial markets? I was thinking yesterday at the close, would we be here if it was a different president, if we had a different commander-in-chief?
That's an excellent point, and he's done a very good job of getting the markets calmed at certain times and anticipating a better outcome than what we might have otherwise feared. So we'll see. I mean, it's not clear that we would have been in this under all administrations, but it's also, not clear if we'd be willing to, walk away with a negotiated deal as quickly. So you have both sides of that. I think Trump, on certain days, has done a very good job with the power of the mic, the bully pulpit, being able to suggest that something's in the works when it's not necessarily. There's still that risk of that, no doubt. But I would still come back to the fundamentals of the market suggesting corporate America's in reasonably good shape, the global economy's in reasonably good shape.
It's kept you anchored, and you've been right to stay constructive throughout all of this. Brian, it's good to see you, as always. Thank you, sir. Brian Levitt there of Invesco. Bramo talked about the Bank of America Fund Manager Survey, some highlights of that. Expectations for growth, down the most since March 2022. Expectations for inflation, the highest since May 2021. The title of the piece this morning, bearish and long.
Yeah, well, I mean, this
right.
is...
Doesn't that tell you about how investors have thought about the last month? Bearish and long?
They don't feel good, but they keep buying, kind of like consumers. They don't feel very good, but they keep on going out and buying clothes and going out to restaurants. The other thing is this Bank of America Fund Manager Survey was taken over a period when the conflict was probably more severe, number one. And number two, it is a fantastic contrarian indicator. So if you want to get long, here's your confidence.
Get long bonds as well. Check out this headline that crossed the Bloomberg terminal just moments ago. The UK receiving a record £148 billion of investor bids for a 10-year debt sale. That 10-year yield moved almost 70 basis points through the month of March and got to the highest level since 2008 and a buying to come in. You saw a similar move in Japan just yesterday. 20-year debt sale, the strongest demand since 2019. So yields have backed up. Bob Michael at JP Morgan talked about it multiple times over the last month. Investors were ready to step in. They're stepping in.
I thought that the Japanese bond sale was really notable, given the fact that you saw the greatest amount of demand versus the supply being sold since 2019. These yields are attractive to people. People want income, and they're getting it. And I think the UK really highlights that.
The latest headlines on the bond market for you this morning. Let's get you some top stories elsewhere with your Bloomberg brief. Yahira's back with us for more. Hey, Yahira.
Good morning, John. The U.S. and Iran are considering a second round of talks before their two-week ceasefire ends next week. The New York Times reporting that during the talks over the weekend, the U.S. proposed a 20-year suspension of all nuclear activity, while Iran renewed a suggestion for a halt of up to 5 years. The Chinese president making his first remarks on the Iran war, Xi Jinping describing the international order as crumbling into disarray and vowing to play a constructive role in the Middle East. And United Airlines CEO Scott Kirby is considering a merger with rival American Airlines. Sources telling us here at Bloomberg, Kirby has pitched the idea to senior government officials. A merger would create the largest airline in the world. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour. Up next on the program, working towards a deal.
We've been called this morning by the right people, the appropriate people, and they want to work a deal. There's no fighting. Right now we have a blockade. So now Iran is doing absolutely no business.
Up next, we'll catch up with the former Deputy National Security Advisor, Victoria Coates. Live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Busy morning of bank earnings coming up. Later this hour, we'll hear from JP Morgan. Then in the next hour, you'll hear from Wells Fargo. Following that, we'll hear from Citigroup. Three big names reporting throughout this morning. Tomorrow, Bank of America and Morgan Stanley. In the equity market, your scores are shaping up as follows. Equity futures pushing higher, up by 0.2% on the S&P 500. Under surveillance this morning, working towards a deal.
We've been called this morning by the right people, the appropriate people, and they want to work a deal. They would like to work a deal. There's no fighting. Right now we have a blockade. They're doing no business. I didn't like seeing boats come out if they were doing business with Iran, but if they weren't, no boats came out. So now Iran is doing absolutely no business, and we're going to keep it that way very easily.
So here's the latest this morning. The US and Iran weighing another round of peace talks before the two-week ceasefire expires next week as the US blockade of the Strait of Hormuz enters day two. Bloomberg's Tyler Kendall has the latest and joins us for more. Good morning, Tyler.
Hey, John. Good morning. Well, diplomacy is still very much on the table as people familiar with the matter tell us that the goal is to hold another round of face-to-face negotiations ahead of next week's ceasefire deadline, because President Trump went on in those remarks to say that the timetable in Iran has not changed. Now, the White House maintains that this weekend's past negotiations did not yield results because of Iran's nuclear ambitions, though senior administration officials have repeatedly said they think that that is an issue that can be breached. And that comes on the heels of multiple reports yesterday that the U.S. had proposed that Iran accept a 20-year moratorium on its uranium enrichment during the talks in Pakistan. That would mark a shift from previous U.S. demands regarding a potential permanent ban on the program. And the New York Times had a little more detailed reporting saying that Iran had proposed a 5-year suspension. That's giving us a little bit of insight into how the dialogue went this weekend. And even with the prospect of further dialogue to come, of course, there is still that risk of escalation on the table. President Trump yesterday threatened to eliminate any Iranian attack boats that come near the U.S. blockade, and new overnight, Saudi Arabia is urging the U.S. to end the blockade altogether amid concerns that regional ports could be threatened. Now, John, President Trump also said yesterday that today we may get further details on which countries have reached out to the U.S. to help with the blockade, but he didn't provide any further information other than that.
Tyler Kendall with the latest. Tyler, we'll catch up with you in the next hour. Let's build on this conversation with the former Deputy National Security Advisor Victoria Coates. Writes the following: closing the strait will remove Iran's last economic lifeline, and they are not going to be able to tolerate that for very long. Victoria joins us now for more. Victoria, welcome back. The Iranian government is very, very good at stretching out negotiations, extend and pretend, extend and pretend. Is there any reason to believe they're willing to give up, or will be willing to give up, their nuclear ambitions?
Well, good morning, John. Good to be with you. That's the big question here. And yes, as President Trump frequently says, Iran has never won a war and they've never lost in a negotiation. So you do always have to watch that. Their long game, what they'd like to do is stretch this out for a couple of years, at least through November of this year. Their hope is that the Republicans will lose the midterms, the administration will be distracted by a hostile Congress, and then eventually a Democrat will get elected in 2028, and that will be, sort of their lifeline. But I don't think they can survive this blockade. Their internet has been essentially shut down for 1,800 hours. Their stock market's been closed since early March. Their commodities market has been closed around the same time frame. So if you shut off their ability to export oil on top of all that, you're facing a really, really dire economic situation inside Iran that I don't think is fully understood at this point.
When it comes to the blockade, why is the U.S. willing to have the blockade on Iran, but 3 weeks ago lift sanctions on their crude that was at sea?
Well, I think this is a real shift of approach, and the idea is to break the paradigm, break this historic leverage over the Strait of Hormuz that Iran has exploited at various times to essentially hold the global energy market hostage, and that we can't go on this way, that this regime is intolerably hostile to not just the United States, but to all of its neighbors in the region. And so if we can sort of turn this around on them and make this more painful for them than it is for our partners and allies, eventually we can break that. And the other thing I'd quickly point out is that we see a race toward alternative infrastructure in the region, not just the Saudi petrol line, the east-west line that's running now about 7 million barrels a day. UAE has a group of pipelines. They're looking at ports in Oman down below the strait that could be serviced by these pipelines. I think that Iran really has an asset of diminishing value here in the Strait of Hormuz.
I'm glad you brought up that pipeline, because the Wall Street Journal overnight was saying how Saudi Arabia is pressing the United States to drop the blockade because they're concerned that Iran will go after their ports elsewhere, maybe get the Houthis involved when it comes to Bab el-Mandeb, and then hurt all those exports that are moving through the east-west pipeline. Do you potentially think that the Iranians are willing to go there?
Well, this has always been a concern, but I found it very interesting. I mean, we're now in, I guess, close to week 6 of this conflict, and the Houthi have literally done nothing. They could have started taking pot shots at shipping through the Red Sea at any point. I think they launched one missile at Israel, and it was intercepted. So you've really had an extremely muted response from the Houthi, who may be rethinking their life choices as partners of the Iranians, given what's happened to Iran over this period. So they remain a concern. You've got to keep an eye on them, but they really haven't done very much as of now. I find that very interesting.
There also is a question of what China is doing through all of this. There were reports about Xi Jinping talking about how the international order is crumbling into disarray. There has been reporting that China is providing certain weaponry to Iran. How difficult does it make the meeting between Xi Jinping and Donald Trump in the middle of May?
Well, it certainly ups the ante, as it were, on that summit coming up in May, and I found the timing of that quite interesting as well. China was asked very early in this conflict if they were going to cancel that meeting, given that they're supposed to be such good friends with the Iranians, and they said no, we would like to see Mr. Trump. Maybe that is not entirely surprising. The president postponed it a month, but he's going to go. And I thought Chairman Xi's remarks at the visit of the Emirati Crown Prince itself also a telling development, that he wanted to host that high-level Emirati delegation at a moment when the Emirates are engaged against the Iranians. He said, oh, the rule of law is so very important. You can't descend to the law of the jungle. Well, that's fine and well, and maybe he should respect that himself as he's starting to take looks at things like Taiwan. So I think, China has been really muted. They really don't have the capability to project power the way the United States has, both in the Caribbean and in the Gulf. And so I think that we will have high stakes for the meeting next month, but I think President Trump does hold a lot of cards.
Victoria, it's good to see you, to get your thoughts and an update. No doubt we'll catch up with you again soon. Victoria Coates there, the former Deputy National Security Advisor on the situation between the US and the rest of the world right now. In just a moment, we'll catch up with the French government. We need to talk about the relationship between the US and the Europeans, the transatlantic divide that's opened up over the last 6 weeks.
Yeah, Xi Jinping was speaking in a meeting with the Spanish Prime Minister. So one of the European contingencies that has made themselves even closer to China, arguably, than the U.S. And with respect to France, how willing are they going to be to join the effort? How many contingency plans do they have to really support their economy as oil prices take a huge hit out of GDP?
And this comes at a time when Emmanuel Macron is saying he's going to have this conference about reopening the Strait of Hormuz, but we haven't yet seen material impact of the Europeans in the region.
We'll talk about objectives for that conference in just a moment. Coming up, we'll catch up with the French Finance Minister, Roland Lescure. With Europe under pressure from the war, plus Yahara has your morning movers. Check it out. United CEO pitching a massive airline merger. The latest report on that in just a moment. Live from New York City, you're watching Bloomberg TV.
80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Stocks advancing in yesterday's session, wiping out the losses since this war started on the S&P 500. On the Nasdaq, 9 consecutive days of gains. On the Nasdaq 100 this morning, positive once again, up by 0.4%. We've got a morning full of bank earnings for you. JP Morgan about 15 minutes away. Moments ago, numbers from Wells Fargo with the latest. Danny Berger has more. Hey, Danny.
Hey, John. It looks like a miss across the board. Let's start with the big number of net interest income. That comes in at $12.1 billion. That is a slight miss. The expectation was for just under $12.3 billion. The hope was it would be a Wells Fargo, at least with their outlook, aided by a lack of Fed rate cuts. But again, net interest income coming in with a miss. The other thing we were looking from this bank was following U.S. regulators' asset cap removal last year. Can they sustain momentum and add to some of their business? It seems that instead, we have a miss on both investment banking and total average loans. First quarter investment banking fees come in at $796 million. The estimate was for far greater than that, $835 million. Total average loans, that comes in, again, that's slightly higher, 996, so that is the bright spot for total average loans. Another sore spot for them is expenses. This is something Wells Fargo had missed big on last quarter and said, our expenses are coming down, we're having fewer severance costs. Instead, a slight higher amount for expenses coming in at $14.3 billion. The estimate was for $14.23 billion. The other thing we're looking out for is any drop in credit quality. Their provisions for credit losses, that is also slightly higher than expected, coming in at $1.14 billion. Again, that is only slightly higher. $1.13 billion is what we are expecting. The CEO, though, putting in the statement that credit performance remains strong despite those higher than expected numbers when it comes to credit provisions. Their headcount is down, but John, expenses are higher and a miss on net interest income and a miss on some of the growth engines that should have been there for Wells Fargo, like investment banking.
Driving the stock lower in the pre-market. Danny, thank you. Stay close. We'll get to JP Morgan later on this hour with Danny Berger. That stock is down in the pre-market by 2.6%. The way things are stacking up this morning, Wells Fargo first, JP Morgan at about 15 minutes time, and then we'll hear from Citigroup, Bramo, somewhere around the 8 o'clock hour.
Yeah, and a lot of what will determine the reaction in markets is how high the expectation is. Just to sort of give a frame of reference, Wells Fargo shares were lower by more than 6% heading into this so far this year. So already taking some of the heat out of that, JP Morgan's going to really be the biggie to understand whether they can capitalize on the capital markets boom that we've seen so far this year.
A slight miss on Wells Fargo. Some major news coming out of the airline sector we need to stay on top of as well. Let's get to your morning movers. Yahira has more. Hey, Yahira.
Hi, John. Exactly. One of the biggest ever airline deals could be on the table. We're reporting that United CEO Scott Kirby has floated the idea of a merger with American Airlines to senior government officials. So you are seeing shares of American up 5.25%. United also up on that news. We're also seeing shares of the satellite firm Global Star soaring in the pre-market, up 13.7%. Also on some potential M&A news on our reporting that Amazon is close to buying the company as it tries to compete with SpaceX and its massive Starlink network. We are also seeing shares of Bloom Energy soaring up 13.5% after expanding its partnership with Oracle in a deal that could deliver 2.8 gigawatts of power to Oracle's massive AI data center network. John?
Yahara, thank you. Thanks for the update. Still thinking about that American United tie-up. What's Kirby up to here? Is he anchoring us to the extreme so we can go after something else a little smaller? Where's this going?
Well, he wants to get assets. He actually was speaking to us earlier this year, and he was talking about how any kind of downturn, he is ready to pick stuff up. And does that mean entire airlines? Well, we shall see. I'm not going to talk about it. But this really is a question of what can get done given all the attempts in the recent past.
The latest on United Airlines and American. JP Morgan numbers, I believe, just crossing as well, Bramo. They're coming a little bit earlier than expected. Let's get into some of that. We just heard from Wells Fargo. Slight miss there on Wells. Heard from Goldman, driven lower yesterday, driven by a miss on FIC. The numbers elsewhere pretty decent. What are you seeing on JP Morgan?
Right now, a beat pretty much across the board. FIC sales and trading, let's start with that, given the fact that Goldman Sachs missed. It came in at $7.1 billion. The estimate was for $6.65 billion. Equity sales and trading revenue came in at $4.48 billion versus the estimate of $4.3 billion. You could see pretty much across the board talking about how performance was strong, talking about beating estimates on earnings per share as well as revenue. So a real question here about what they could accomplish that Wells Fargo couldn't when we just saw those results.
Equity sales and trading, to Bramo's point, upside surprise. Decent upside surprise from Goldman. The miss was on FIC. There is no miss on FIC when it comes to JP Morgan. Some commentary from the JP Morgan CEO, Jamie Dimon, as well. We'll get to those comments in just a moment. Danny Berger has some details for you right now. Hey, Danny.
Hey, John. I am looking at record quarters for equity trading. And again, this is important considering Goldman had a huge quarter too. Can JP Morgan beat it? They did not beat Goldman, but again, at $4.5 billion, just there under, it is a record. And again, that FIC number, even more important, considering that Goldman Sachs lost, that also looks to be something of a record for them. The last record was $5.8 billion, and this exceeds their estimates at $7 billion. The other really important thing for JP Morgan was the fact that they missed on their investment banking in the last quarter's results. They said it's because the pipeline has been delayed, so you should see that show up, and it has indeed showed up. Investment banking revenue, $3.1 billion. The estimate was for $2.7 billion. It's a standout for them. We'll see how the advisory numbers come in, but we're also getting some commentary from Jamie Dimon as well, saying that he hopes regulators prioritized well-designed regulation. Keep in mind, that's part of the reason why we're seeing their investment banking outperform, saying that the U.S. economy remained resilient in the quarter and several tailwinds are supporting this resiliency. Contrast that with what we heard from David Solomon, warning about concerns of economic and wider stress coming from geopolitics. Instead, we have a CEO of JP Morgan saying that there are tailwinds supporting this economy. And we're also looking to see any commentary on credit. Jamie Dimon saying that they have ample amounts of capital and liquidity and that consumers are still earning and still spending. So again, a beat across the board for JP Morgan, a record for their equity trading, a record for their FIC trading, and you have an investment bank after a blockbuster quarter from M&A that also beats something we wanted to see from JP Morgan considering they missed last quarter.
Danny, thank you. Finding ourselves saying beat quite a few times whilst looking at JP Morgan, FIC, equities, investment banking. The commentary is important from the JP Morgan boss, the CEO and chair, Jamie Dimon. At a time when we've just seen a massive energy shock, the economy is still resilient. There's tailwind supporting this economy. Consumers still earning, still spending.
And right now, they have ample liquidity, and they see credit quality as hanging in there. All of this with the beats in the capital markets. Key question has been, and it will be on the call, how much is the backlog potentially going to get shrunk as ongoing uncertainty continues in the Middle East? The markets may be moving on, but regulators and policymakers certainly can't do that.
This is an important headline from JP Morgan, just to wrap things up here. They see full year net interest income of about $103 billion. They had seen about 104.5. That number just crossed in seconds ago.
Yeah, so a little bit lower than what they had previously been seeing. Still, nonetheless, $103 billion is nothing to sneeze at and still would be, I believe, a new record. So it's not as if people are going to be crying about that. Nonetheless, how much are banks going to try to guide conservatively, given the fact, and I guess that's conservative, more conservatively based on some of the uncertainties?
There are many tailwinds here for this economy. The JP Morgan boss cites a few of them: fiscal stimulus, AI-driven capital investment. There is a key headwind we need to talk about as well, which is why we're even having this conversation, which is the shock in the Middle East and what can be done about it. We understand this morning, according to headlines, that France and the UK is co-hosting a summit this weekend to discuss safeguarding international shipping. I'm very pleased to say we can have that conversation right now around this table, because joining us is Roland Lescure, the French Minister for the Economy and Finance. Minister, good morning. It's good to see you.
Good morning.
Thank you for being here. Welcome to New York City. Let's talk about the objectives for this meeting. What can we hope for over the next week?
Well, we can hope for de-escalation. I mean, you know that France wasn't part of the conflict, as we're not a belligerent, we're not even warned that it was going to happen, but now we are where we are. And we feel, with others, the UK and others, we can be part of the solution. We need de-escalation first, we need those talks that are happening, and which hopefully will keep on happening between Iran and the US to move towards some kind of solution. But if we do have de-escalation, we feel that a coalition of the willing, countries from all over the place that have a part in the problem, because as you know, this Strait of Hormuz story is affecting us all economically in Asia, dramatically, and in Europe as well, that we can help pacify the strait. That strait is the knot of the economic impact of that conflict. If we can undo that knot, we know that we'll all be in a better place. So whatever we can do, once there's de-escalation, that's important, to help make the Strait of Hormuz more free, we will do. And that's what's happening on Friday.
What does that actually mean in reality, whatever we can do? Does that mean you'd have a military presence in the Strait of Hormuz? What does that actually mean?
Well, look at what's happening in the Red Sea, and it has happened for a while. There was Houthis there. They were making passage dangerous for ships. And we had, and we still have, coalition of partners that are just making it safe, just preventing, deterring attacks from the Houthis. And, we are in there, the Spanish are in there, there's a few countries in there. Obviously, the Strait of Hormuz would be probably a bigger deal to do, but we can do it, provided, again, that we have the escalation, we have some path to a lasting ceasefire. That will require major headway on nuclear, on ballistic capabilities of Iran that have to be gone. But once we have that, there's a case for non-belligerent country to be part of the solution to pacify the strait, which again is the knot of the economic impact.
We have to talk about consequences as well. I'm not sure how well understood the energy mix story is in France. At the European level, it's been a bit of a mess in places like Germany, particularly the UK. That's been highlighted so many times. Can you briefly describe the energy mix in France, how different it is and how insulated you might be?
I remember Rahm Emanuel, when Barack Obama came into office, that said, you should never let a good economic crisis go to waste. Well, this is what France did in the 70s, when we had an oil shock then. France decided to embark on a major nuclear program that allowed us to go down from 90% hydrocarbon in our energy mix to 60. So 40% of our energy now is coming from nuclear. It's carbon-free, it's cheap, and it's completely sovereign. It doesn't depend on anyone else. And because we don't want this economic crisis to go to waste, we've just announced that we're doubling down. So we're going to bring that energy mix from 90 to 60 to 35 by investing again in nuclear, as well as hydro, as well as renewables. At the end of the day, we have a convergence now of three major driving forces that we have an interest in investing. Geopolitical issues. We have to be sovereign. We have to be more independent of what's happening elsewhere. The environment. I think climate is coming back because it's been on a bit of a back burner for a while, but because we see we're depending way too much of one region of the Gulf and of hydrocarbon, it's coming back. But also jobs. By doing this, we're going to create hundreds of thousands of jobs, because building a nuclear power station, building wind farms and solar farms are helpful for the jobs on the ground.
This is all expensive, and it takes money at a time where the amount of debt globally has reached record highs, has surged dramatically since the pandemic. How much fiscal headroom do you have?
Well, it's all going to be about priorities. We can't have it all. And today we have one priority, which is sovereignty, which has two pillars. Defense sovereignty. We will have doubled defense spending in France between 2017 and 2027 by the time we get there next year. and energy sovereignty. So that means we have to save elsewhere. You know, we have to save on our health spending, we have to save on our retirement spending, and you know it's a big debate in France. We've done so. We've managed to get a budget through, and I can tell you it wasn't easy with Congress that looks, you know, as I said to my Italian colleague, a bit like an Italian Congress, you know, lots of different groups having to discuss and muddle through, but we did. And we're going to have to do it again. But most importantly, I think there's a presidential election taking place next year. And the candidates are going to have to make that choice. Do they want priority on sovereignty, defense and electricity and energy to make France, and at the end of the day, Europe, a stronger place? Or do we still want to be kind of stuck in the past of things we have to change and reform?
Do you expect growth to have to go down because you're saving in these other areas to preserve the sovereignty with respect to energy, with respect to defense?
Well, we entered that crisis on quite a strong footing. I heard Jamie Dimon saying that the US economy is resilient. So is the French economy. It was pretty strong getting into that crisis. So we will have a slowdown in the short run. But again, what we're doing is investment. At the moment, when someone wants to put a data center somewhere, not in the US, they look at France. Because we have carbon-free, ample and cheap electricity, and they need that. So at the end of the day, this is investment in the French economy, in the European economy, but it is attracting investments, including from the part of US investors who want to diversify. We're having, you know, the Magnificent Seven looking at France to invest. We're having US banks looking to invest, and we have French and European companies also looking to invest. So again, short-term resilience, but a bit of a risk. Long-term, we need to invest in the future. That's the only way out. Growth is the way out.
When you look at the long term, when will France finally stop buying Russian fossil fuels?
Well, you know, we're committed to that. We're already committed to stopping gas import. There's no new contracts. This has been decided at the European level this year. And any gas import is going to be stopped by January. So we are on the path. The only thing we wanted to do is to make sure that this was done respecting international laws. We are a law-binding country, and the EU is a law-binding country, so we did it respecting some contracts that were still in the go, respecting European decisions, the sanctions decision as well. And this is all taking place the way it should be, respecting international law, which Russia doesn't.
A final question, an important one. You've used the word belligerence to describe others. The US might be in that group in your mind. You can confirm that if you want to. The other question and the other answer you've offered is the word sovereign. This is important with regards to the future of a relationship with the US. Just what is the transatlantic relationship, given the way the discourse has evolved over the last month?
We've been friends for 250 years, you know, and this is going to go beyond the ups and downs, and there are some of the somewhat interpersonal relationship or somewhat disagreement on the short-term way of dealing with such and such problem. What gets us together is much stronger than what divides us. And I can see it every day when I talk to US and French and European companies. We need those companies to keep on working together to give us the right example of what we need to do. When we disagree, I'm going to chair a G7 meeting this week. Sometimes we don't agree on everything with our finance colleagues. We address it in closed rooms. We are allies and friends, and this needs to go beyond what's going on in the ground. We have the solutions to the problem together, and we need to make sure that everyone understands this. We're stronger together than divided. Despite sometimes the somewhat short-term disagreement, we need to look beyond that and make sure we do.
Minister, it's good to see you. Thanks for your time.
Thank you.
Enjoy New York.
Thanks to the three
I know
of
you're
you.
heading back to DC as well, so enjoy America. Equity futures right now, the S&P 500 positive by 0.1%. Lots of bank earnings out there and stories elsewhere. With your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. A U.S. sanctioned tanker linked to China made its way through the Strait of Hormuz despite President Donald Trump's naval blockade. Rich Starry, a medium-range tanker earlier known as Full Star, was blacklisted by Washington back in 2023 for helping Tehran evade energy sanctions. And on those bank earnings, we are seeing JP Morgan shares falling 2.6%. The bank cutting its net interest income forecast for the full year. Still, JP Morgan reporting a strong first quarter, fixed sales and trading revenue rising 21% compared to a year ago. Wells Fargo shares also lower about 0.8%. The company reporting net interest income for the first quarter that missed estimates, Wells Fargo still seeing its full-year net interest income at about $50 billion. That's your Bloomberg Brief. John.
Yahira, thank you. Thank you very much. Up next, bank earnings in focus.
Most of the volatility, I think, is positive. I think the companies understand how to make a dollar when you have these topsy-turvy markets. This uncertainty can pass just like it did last year. So I still think there's a very good road ahead.
The numbers from JP Morgan were good. The guide was a little softer than expected. Gerard Cassidy of RBC joins us next.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The quarterly numbers were good. The guide was soft. JP Morgan down in the pre-market by 2.6%. With the details, Danny has more. Hey, Danny.
Hey, John. It is that net interest income guide. The confusing thing and the details that we will want is the fact that JP Morgan is actually reverting to an old guidance. In the quarter prior, it had told us that for 2026, net interest income would be $104.5 billion for the year. In January, it had said it would be $103 billion. It's gone back to that forecast. So there's going to be some question marks about what's changed in the outlook for JP Morgan to cause them to do that. Now, otherwise, it was a really bright earnings, and that's why you saw originally shares surge higher before you had this new forecast, because everything beat. It was a record quarter for equities. FIT came in for a second best quarter, the best one being during COVID trading times, and that was a number that Goldman Sachs had missed on. Its investment bank also really strong. Its advisory fees surging 82% year over year. Again, this is a bright spot for JP Morgan after seeing some of its deals pipeline pushed into the first quarter. So it is that one sour spot. Now keep in mind that it's not exactly trading at high valuations coming into this. JP JP Morgan and the rest of the big banks are down on the year, but still there's some disappointment. It's about that guidance. And again, to Jamie Dimon's point, he's pointing out resiliency in the economy. He does talk about risks and uncertainties and around geopolitical stress, but saying that there are many pillars supporting them, including AI-driven capital investment.
Danny Berger with the latest. Danny's with us all morning breaking down these results. Citi is up next. Jared Cassidy of RBC spent the morning with us as well. Jared, welcome into the program. We used to beat and raise from JP Morgan, not beat and cut. What's behind the cut?
I think, John, what we're seeing is that there was very strong loan growth, both by JP Morgan and Wells Fargo, but both of them experienced a slight decline in the net interest margin. So there was a compression in the spreads, and I think that's probably attributing to the lower guidance on the NII for JP Morgan for the full calendar year 2026. But as you pointed out earlier, John, Wells Fargo held their guide for net interest income. So it's a question of volume versus spread, and the spread came in a little tighter for both those banks.
Gerard, I'm struck by the fact that even though it's beat pretty much across the board, the shares are lower. Do you think that this truly is net income interest, or just simply buy the rumor, sell the news?
I think it's the latter, and I think you bring a good point. It's a little surprising that the stock is down that much on these results, and even the outlook. The outlook, though, the net interest income, as you guys just pointed out, has been moving around between 103 to 105 billion. It's not a significant lowering to suggest why the stock is down. And also, as you guys pointed out, the capital markets numbers for JP Morgan were very robust this quarter as well.
We heard Goldman Sachs' CEO yesterday blame the analyst essentially for their miss in FICC, saying that they just simply had expectations that were way too high. It's their fault. Do you expect similar commentary from JP Morgan this morning?
I'd be surprised, because I was looking at our numbers and consensus compared to JP Morgan's numbers, and generally they came in better than expected, including FICC. So it's going to be interesting to see what others report. Citi, as you know, reports later this morning. Then we'll, of course, receive Bank of America and Morgan Stanley later in the week. And if everybody beats expectations on FICC, then Goldman had a tougher quarter. They didn't indicate yesterday that there was any trading losses or anything, which is what we suspected. But when questioned on their call about the softness there, that once again it was more due to the rates business and mortgages being partially offset by better commodities trading and currency trading for Goldman yesterday.
Jared, it's good to see you. You're going to be sticking with us through this morning. Looking forward to catching up some more. Jared Cassidy there of RBC. I've never enjoyed that. Blaming the analysts, blaming the media. Just own the results.
Well, it didn't seem to work.
And own the outcome.
Well, it didn't seem to work, because ultimately you saw the shares respond heading lower. A question, though, here of how much the optimism has been overbaked in some of these book-to-loan values in some of the banks, and that, I think, is maybe what we might see in some of the post-results trading.
JP Morgan down by close to 2% in the pre-market. Just not what we're used to, Bremo. Usually when you see beats like that on a quarter from JP Morgan, the headline that leaks a couple of minutes later across the Bloomberg terminal, and you see it cross, it's the guidance for net interest income, and usually it's higher than it was before.
And $103 billion isn't nothing. But yes, the idea of guiding lower is something unusual.
Stock is down by close to 2% in early trading. The conversation continues. In the next hour, we'll catch up with Eric Johnson of Cantor, Rachel Ziemba of CNAS, Amy Gower of Morgan Stanley, Sonal Desai of Franklin Templeton. The second hour of Bloomberg Surveillance is just around the corner.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix. an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this field forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Inflation is now too high.
We live in a world of higher, more volatile inflation.
There's still a number of unknowns.
Uncertainty breeds conservatism in terms of spending and hiring.
There's damage that's going to persist.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. Equity futures firmer by about 1/10% on the S&P. On the NASDAQ, up by 1/3. The NASDAQ, 9-day winning streak. The S&P within 2% of all-time highs. In the commodity market, first thing you look at still, most mornings, crude, Brent, WTI, below triple digits. 99 on Brent, WTI at 97. Holding us back just a touch today, these numbers from JP Morgan. Quarterly results were good. The guide was a little soft. The stock is down by more than 1%.
Yeah, the guide a little soft, bringing us back to where we were in terms of the guide from January. $103 billion versus $104.5 billion. Still massive numbers and beats pretty much across the board. You got FIC outperforming. You had equities, trading, and sales outperforming. You had net interest income for the quarter outperforming. The commentary from Jamie Dimon of JP Morgan, interesting, saying that ultimately this is a difficult moment. There are fiscal stimulus and AI-driven capital investments that act as tailwinds. At the same time, the headwinds of energy costs and geopolitical conflicts still loom large.
The economy's resilient. We've heard that from Jamie Dimon and JP Morgan a few times. Consumers are still earning. They're still spending. The risks, they're complex. They include wars and energy prices.
And what we see, depending on these results, what the CEOs are saying in the C-suite, is very different than what you see in the polls. In the polls, you see everyday consumers are concerned about where gas prices are, north of $4 a gallon when it comes across the average for the United States. At the same time, they are still going out and spending, which is why you have executives saying, we do see this consumer to be resilient. They might not be happy about it, but they're still spending.
Things have been pretty mixed so far. JP Morgan, Goldman Sachs, we've heard from Wells, Citi, the next to go. Then we'll hear from Bank of America and Morgan Stanley in the next 24 hours.
One of the difficult aspects of this is they are potentially preparing for difficulties down the line, not seeing it yet. You're also not hearing concerns about private credit, or any kind of serious credit deterioration that is at least making itself manifest on the balance sheet. So how does an investor deal with this when the unknowns are still a complete black box? The crystal ball that people look at is completely cloudy. So how, as an investor, do you game this out? I would say look past it. It's a FOMO market.
And it's very difficult when you really don't understand what is going to happen in the Middle East. We're supposed to have the end of this ceasefire, potentially talks just before them. What's on the table right now is what's been on the table. It was on the table in February before Trump decided to escalate and start striking Iran. So this could, as Victoria Coates said, this could drag on for months, especially given the Iranians are very aware that there's a midterm election in this country. Then the president after that only has 2 more years.
We have thrown so much of this equity market. Private market jitters, AI disruption, a major, and I mean major energy shock, and we are within 1.5% of all-time highs on the S&P 500. Futures this morning positive by 0.1%. Coming up this hour, we'll catch up with Eric Johnson of Cantor as big bank earnings roll in. Rachel Ziemba of the Center for a New American Security on hopes for a US-Iran deal, and Sonal Desai of Franklin Templeton as the Fed weighs its next move. We begin this hour with stocks looking for direction following JP Morgan's first quarter earnings. Eric Johnson of Cantor Fitzgerald writing the US economy and corporate earnings are quite strong and can handle a short-term spike in oil and short-term supply shocks across different inputs. Eric joins us now for more. Eric, good morning. Good to see you.
Good morning.
Just to add to that, I've talked about what we've thrown at this equity market, private market jitters, AI disruption, an energy shock. And to your point, the negative supply shocks elsewhere as well, across labor and goods. And here we are, very close to all-time highs. What's anchoring that for you?
So I would say a couple of things. Even though price is only down, call it 1.5% from the all-time high, as you said, if you look at the multiple, that's down very significantly. So the peak was about 22.8 times forward earnings. We entered this year at a little over 22 times forward earnings, and now we're just above 20. And that's because earnings estimates have, over the last 6 months and over the last, 2 to 3 months have surged. So by going sideways, the market has actually been correcting the multiple. So if you look at a multiple chart and you said that was a stock price chart, you would say, wow, we're still very oversold. So I think that has created that sort of, entry point, making it look attractive, even being 1.5%, from the highs.
How sticky do you think that multiple compression is?
So I think that 22.8 probably was not correct and was too high. But the earnings growth rate right now, and most of it is really, it's due to AI, right? It's due to the build out. But you're seeing a growth rate that's likely going to persist in this mid-teens range. And if you look at it versus history, you've got mid-teens growth. You've had debt levels that, looking back over the last 50 to 75 years, corporate debt is very low. CapEx, of course, has gone up of late, but also relative to history is also on the lower end. So a 20 multiple, while I still think is on the higher end, I think is something that could be sustained and potentially move a little bit higher from here as the year goes on.
Does that mean that you think that big tech has to lead on any kind of rally, any kind of upside, given the diminished expectations for growth due to the conflict in the Middle East?
Absolutely. I think this earnings season is going to be a very positive earnings season for mega cap tech relative to their stock prices. And so, mega cap tech has gotten hit hard. The multiples have gotten hit hard. And a lot of this earnings estimate revision higher has actually been from tech while the stocks have been getting hit. So I think as you look to this earnings season, I think you're going to see, growth rates in cloud that are going to be very attractive. I think the commentary about the outlook for that growth rate over the coming years is also going to be quite favorable. So yes, I think you need mega cap tech, and I think you'll get it.
John's been talking about this for quite a while. How much room do they have to keep increasing their CapEx spending, given the fact that there are some concerns by investors of exactly what kind of return they're getting, and frankly, the fact that they're becoming more asset heavy in terms of their overall model?
I mean, there's still a very large mismatch between the demand for compute and the supply, and there's likely going to be continued issues in terms of just building it, like actually just being able to physically get all the pieces to build the data centers to meet the demand. And so that's probably going to elongate the cycle. And so I think that in the near term, I don't really see any change to that CapEx outlook.
There's also been concern from some individuals, especially on the Federal Reserve, that maybe they can't do anything. They have to sit on their hands because of what is going on, given the inflationary shock of the energy story. But you actually think the Fed is going to cut this year. You still think that?
I do. So the market's only pricing in a 40% chance of one cut. I think we're going to see multiple cuts. And I think it's really with, I think core inflation. So presumably the end of the war will be there sometime in the next coming weeks and months. And so as we get to the back half of the year, I think that the headline inflation numbers are going to be looked at by the Fed as old news, and they will have already seen the starting of the move lower in oil, and I think it's going to go a lot slower than people hope for, but it is on the move down, and that core inflation is going to really be what is going to be moving lower and will be the rationale for the Fed to cut. And I think that this AI, surge in, you look at Anthropic's revenues, right? There's likely going to start to be headwinds or continue to be headwinds for the labor market. And I think that's going to be for years to come.
And you think we'll see that this year, AI impact basically layoffs?
I think some of that impact in the back half of the year, but we're also going to be lapping tariffs, which I think is going to be very important for goods prices. I think the owner's equivalent rent is just on a downtrend, and based on the current data, should be on a downtrend for the next year plus. And then I think wage growth is certainly going to be under pressure due to that AI dynamic. So I think if you put that all together, we'll be looking at core inflation rates in the back half of the year that are going to be enough for the Fed to cut. And of course, you're going to have a head of the of the committee that is going to be quite incentivized to cut. He's only one vote, but is going to be quite incentivized to cut. And I think that could have significant influence on the committee.
Just extend that a few steps further. You've got AI disruption leading to layoffs in the labor market and the Fed chasing something they can't affect. Cutting interest rates. For a jobs market, they can't change, right? How far are they going to chase that? Because arguably, them cutting interest rates will just accelerate further AI investment, no?
So historically, the Fed has been much more sort of backward-looking, and I think one of the changes that they want to make is becoming much more forward-looking. And I think with Warsh in there, leading, I think he's going to be much more forward-looking. Now, what is the impact going to be? That's where it gets very, murky. And likely the impact is not necessarily going to be there, but ultimately the goal is going to be to spur, demand beyond what it would be otherwise. That's going to be a tricky.
I'm struck by the fact that it feels like this market's saying mission accomplished. I feel like this market is collectively on some sort of aircraft carrier with a huge banner saying mission accomplished, we're moving on. And at the same time, oil prices are going to be materially higher. I just wonder at what point higher inflation starts to really bleed into the calculus in a more sustained way.
So one of the interesting things, if you look at a chart of oil prices over the last 15, 20 years, oil prices today are the same as they were in 2008. Okay, that was during the spike in 2008, to be fair, but the same as 2008. Wealth since 2008 has gone up by about sixfold, like 600%. And so the impact, while oil clearly has an impact on a certain segment of the consumer and a painful impact on that segment of the consumer, if you look at the consumer broadly, consumer spending is not really being impacted because of this wealth creation that makes oil prices on a relative basis such a small part of the consumer's spending. And even though we've seen a surge in oil prices, and of course rate of change is super important, but we're also the same price. If you look at 6-month oil, it's the same as it was in 2024, same as it was in 2023, below where it was in 2022. So I think as long as we are here around oil prices, the economy and earnings can definitely handle it. Now, to your point, the market, I think, is saying that we are pricing in a very high probability that it is mission accomplished and that we're not going to see a further move higher in oil. And I think in war, you can assume nothing. And so that is something, until we have a deal, it still remains a risk, even though, I think the odds have certainly gone down that this is going to be extended and that the ceasefire will be broken. I think that those odds are definitely moving lower, but they still exist, and you can assume nothing.
This stock market has taken a lot of comfort from the futures curve in the oil market. Eric, it's good to see you.
Great to see you.
Thanks for breaking it down. Thank you. Eric Johnson there of Cantor Fitzgerald. Within 1.5% of all-time highs on the S&P 500. Equity futures this morning positive again by about 0.1%. With an update on stories worldwide, with your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. Starting with bank earnings, shares of JP Morgan and Wells Fargo both lower in the pre-market. JP Morgan cutting its net interest income forecast for the full year, with CEO Jamie Dimon seeing, quote, an increasingly complex set of risks ahead. Wells Fargo posting net interest income that missed estimates. Meanwhile, we are seeing shares of CarMax plunging 6.7% in the pre-market. The used car retailer reporting fourth quarter results that beat Wall Street estimates, but said it will spend $500 million in fiscal 2027 to support longer-term growth. And California Congressman Eric Swalwell is resigning from his seat after suspending his campaign for governor. Swalwell is facing allegations of sexual assault by a former staffer, with the House Ethics Committee set to launch an investigation. Texas Congressman Tony Gonzalez is also resigning after admitting to an affair with a former staffer. That's your brief. John?
Yahira, thank you. Thanks for the update. More from Yahira in about 15 minutes' time. Up next on the program, putting the ball back in Iran's court.
The Iranians, I think, did make some progress. They moved in our direction, which is why I think we would say that we had some good signs, but they didn't move far enough. The ball really is in their court.
Up next, we'll catch up with Rachel Ziemba of the Center for a New American Security, live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Stocks higher for 8 days out of the last 9. Up again this morning. Futures positive by 0.2% on the S&P. On the Nasdaq up by 0.4. The enthusiasm continues on the prospect of further talks in the Middle East. And the earnings keep rolling in as well. This from JP Morgan. Trading revenue up 20% from a year earlier. This stat from Hannah Levitt here at Bloomberg. Traders at JP Morgan posting their highest ever quarterly revenue in the first 3 months of the year. The stock is slightly lower. We're down by close to 0.9%. The guide net interest income for the year ahead, just slightly softer than what they were guiding towards just before.
Yeah, there was this feeling back in February, a long time ago, when everyone expected the expansion to surprise to the upside in the United States. And so any enthusiasm that was baked in during that period had to be retrenched a bit back to where it was earlier this year. Still $103 billion of net interest and income. Not a terrible haul.
The JP Morgan down by 0.9% in the pre-market. Up next is Citi at some point in the next hour. Under surveillance this morning, putting the ball back in Iran's court.
The Iranians, I think, did make some progress. They moved in our direction, which is why I think we would say that we had some good signs, but they didn't move far enough. The ball really is in their court. We've made clear where we're willing, again, to be accommodating, and we've made clear where we absolutely need to see the nuclear material come out of the country of Iran. We can start to wind this thing down. I'd much rather wind this thing down with a big, successful negotiation.
So here's the latest this morning. The US and Iran weighing a fresh round of talks before the ceasefire ends next week. Bloomberg's Tyler Kendall joins us now for more. Tyler, what is the potential for a much bigger, successful negotiation?
Hey, John, good morning. Well, at this point, it seems that potential is ramping up as we get indications that diplomacy is still a viable option on the table. People familiar with the matter telling us here at Bloomberg News that the goal is that there could be a face-to-face negotiation ahead of next Tuesday's ceasefire deadline. President Trump indicated as much yesterday, too, telling reporters that Iran had reached out to the U.S. for talks, but also maintained that the timetable for a deal with Iran has not changed. Now, this White House has repeatedly maintained that the reason why we didn't see a resolution to the last round of talks has to do with Iran's nuclear ambitions. However, we're getting multiple reports from different outlets that the U.S. has actually shifted its asks when it comes to Iran's program. Outlets including Axios, the Wall Street Journal, and the New York Times now reporting that the U.S. had asked Iran to agree to a 20-year moratorium on uranium enrichment, different, of course, from a previous demand of a permanent ban, though, of course, we still need to get additional details on what else was in this ask, including further restrictions. Now, John, at this point, even as we have the potential for more dialogue, there is, of course, the potential for more escalation. New overnight, Saudi Arabia asked the U.S. outright to end its blockade amid concerns that there could be real retaliation in ports in the region. President Trump indicated yesterday we could get some more details today on which countries may be willing to help when it comes to securing the Strait of Hormuz. But as the French economy and finance minister told you all earlier on the program, it appears clear that our allies need to get more signs of de-escalation before they commit any other assets to the region.
Tyler, good to see you as always. Tyler Kendall there down in Washington, D.C., in the nation's capital. Joining us now is Rachel Ziemba of the Center for a New American Security. Rachel, welcome to the program. Anne-Marie and Victoria Coates were talking about this in a previous hour. The American strategy has changed. They've gone from lifting some sanctions on some Iranian crude to ultimately blockading all Iranian crude. Rachel, what do you expect to be the outcome of this shift in strategy?
Yeah, well, the U.S. government, thanks for having me, John. The U.S. government is really hoping that this blockade will bring Iran to not only back to the table, but make more concessions. I would note that the Iranian response to the U.S. 20-year moratorium has been to come back with another 5-year one, which I think is similar to what they were offering back in February before this war. So we'll see how much movement we've seen. But ultimately, what this means is that oil flows, is that the oil flows from Iran, if this blockade is effective, could fall. That could be 2 million barrels a day further offline that was going to China. Taking, outages from the Gulf from 10, 11 million barrels a day to maybe 13 or so. So it would just increase the outage that we're seeing here. But the U.S. government is hoping that we get to a resolution. But right now, we're seeing a few sanctioned vessels making their way through the strait. Will they be stopped by U.S. military when they get further out into the Gulf of Oman? We'll see. I think that will be one of the stories for today and the next few days.
Rachel, speaking of that blockade, if the United States does take over a tanker, is it clear to you where exactly they would bring it?
No, it's not. You know, we are in uncharted territory. There was a point earlier this year, before the war, where the U.S. was. I mean, I called it at the time. They were using, you know, kinetic force to implement financial sanctions. They did it with Venezuela, a little bit with tankers going to Cuba, a couple Iranian tankers, but a lot of them just sort of spent time out at sea. Some of the Venezuelan ones eventually came to the United States or went to Caribbean ports. It's possible some of these could go to Oman, could go somewhere else and get processed, could go to friendly countries in Asia. But it's not clear to me that CENTCOM has been charged to stop these vessels. It's not clear that they have a guidance about what to do with them after the fact. This is really a point of leverage that the U.S. government is trying to impose on both Iran and China, right? China has been the buyer of first and last resort for Iran. It's also been the primary buyer of the Russia sanctions. And I'd note as well that the U.S. government I'm sure I've talked about this, but have let the Russia sanctions lapse within the last couple of days, largely because China was the one who was still buying most of that oil.
In order for the Iranians to maybe capitulate for the United States, does the blockade need to go on for longer? Because before the blockade, and we were just discussing the sanction lift on Iranian crude at sea, the regime brought in hundreds of millions of dollars because they were allowed to now export without the sanctions, so at a much higher premium.
You're spot on, Anne-Marie. Iran has been earning more in the last couple of months. They got more vessels out ahead of the war compared to what they were normally doing. It's pretty volatile oil flows out of Iran, I must admit. And they've been able to sell at much higher prices. Now, the sanctions relief that hasn't yet expired, but has been converted into this military blockade, did not lift any of the sanctions on what Iran could buy, how they could spend their resources. That's one of the reasons they want to be paid in crypto or renminbi or assets that don't touch the U.S. Treasury. But undeniably, you know, Iran's military-led government has been able to support itself, and, you know, it's sitting on more cash now, even as more cash is locked up. Now, that's not going to be enough for rebuilding Iran, but it could be enough for the regime to remain in place. And so I think that's where the U.S. government's view that this could be just a couple more weeks of pain, the timelines might not line up, in my view.
Rachel, good to catch up. Thanks for dropping by. Rachel Ziemba there of CNAS. To Bramo's point earlier on in the program, it just feels like this market has just moved on completely from this story. We've got crude south of triple digits, the front month of the futures curve we're talking about here on both Brent and WTI. The physical market's still very disrupted, of course. The market's taking comfort from where the back end of the futures curve is trading, or at least further out on the futures curve, which implies crude's going to come back down, if you view the futures curve that way. And the equity market's looking elsewhere, looking hopefully to robust earnings for the year ahead.
The team over at Deutsche Bank just put out the chart of the day. The playbook pays off again. And it's the S&P 500 around geopolitical events since 1939, talking about how fade any kind of geopolitics since 1939. We're still in the geopolitical event. It's just that people are saying, you know, in some ways, it's all clear. It's kind of mission accomplished. People see the off-ramp, and they're going to buy on it.
It's not over yet. To your point, still in it.
We still haven't found out really a feasible resolution going forward.
Up next, we'll catch up with Amy Gower of Morgan Stanley with metals rising on renewed Iran optimism. Plus, Yahira's got your morning movers. The bank's in focus this morning from New York City. Good morning.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
The S&P 500, here's the reset. Wiping out the losses from the war, now positive on the year, an 8th day of gains out of 9 days of trading. The rally continues. Futures up this morning by 1/3%, call it 0.2% on the S&P 500, within, not 2%, but within 1.5% of all-time highs on the S&P. A 9-day winning streak on the Nasdaq 100, up again. Could be day 10, up again this morning by 0.4%. That's how the stage is set this morning. Let's get you some single names 2 hours away from the opening bell. Your morning movers with Yahira. Hey, Yahira.
Hi, John. Taking you through those bank earnings and how the stocks are reacting. We start with JP Morgan. Its traders blew past expectations with a record quarter, which is something we were watching after that massive Goldman miss yesterday on FICC trading, but it was the guidance that it disappointed investors. Shares are down 0.8%, but they have trimmed earlier losses. Meanwhile, we are also seeing Wells Fargo shares down 2.4% after the firm missed on net interest income and fees, key areas for that bank. Staying on Wall Street, we turn to BlackRock. Those shares up 2% in the pre-market after the company pulled in $130 billion in client inflows, with ETFs accounting for almost all of that. And we end on the airlines. One of the biggest airline deals ever could be on the table. We're reporting that United CEO's Scott Kirby has floated a potential merger with American Airlines, that he's talked to senior government officials about that. So now we are seeing American adding to its earlier gains, up 7.4%. John?
Yahira, thank you. I find this a major flex. It's just a flex. Got a really tough moment for the airlines, given a fuel cost situation, and you've got one name coming out and saying, yeah, we're ready to buy. We're ready to go.
It's a specific flex, too, because remember that the CEO of United used to work as the president of American Airlines. So it's a really interesting moment and an increasing rivalry between the big three.
More still to come on that story. On our radar this morning, the US and Iran weighing further negotiations as President Donald Trump presses ahead with a naval blockade in the Strait of Hormuz. The two countries aiming to extend the 2-week ceasefire before it expires on April 22. Elsewhere, that story, United, the CEO, Scott Kirby, floating a massive merger with rival Americans. Sources telling us here at Bloomberg, Kirby pitched the idea to senior government officials. A deal would require approval from both the DOT and the DOJ. And finally, let's finish on the bank. Shares of JP Morgan and Wells Fargo trading lower in the pre-market. JP Morgan Bank cutting its net interest income forecast for the full year. Wells Fargo posting net interest for the first quarter that missed analyst estimates.
Just to put it into perspective, I feel like a broken record, but $103 billion was the downgrade from 104.5. That was the upgrade from January to February, and then February back to where we are in April, and suddenly we're back to where we were when we began the year. These are wonderful earnings. The question is just how much expectations had gotten elevated heading into this. The fact that you're having a record investment banking, a record markets activity with respect to JP Morgan and Goldman Sachs highlights just how much energy there still is in the capital markets. And that, I think, is going to be the takeaway, even if there is a one-day snap in terms of the performance.
And it comes at a time when I know Jamie Dimon also likes to moonlight as a geopolitical risk analyst. He's talking about all of the risk. And at this moment, they feel like the wall of worry, those bricks continuously stack up. They are still doing so well.
Stock is down by just 0.8%. Let's talk about the shakeout in the commodity market, and not in crude. Gold snapping a two-day losing streak with inflation concerns easing on renewed optimism for a peace deal with Iran. Amy Gower of Morgan Stanley writing the longer-term effects of current events in the Middle East are more bullish than bearish for metals if they bring more stockpiling. Amy joins us now for more. Amy, good morning.
Good morning.
And welcome to New York as well. Let's talk about the degree of disruption you've seen in your space over the last 6 weeks. How have things changed?
Yeah, so look, the big change we've seen is really the aluminium market. This has been the most physically disrupted from the conflict so far. First of all, it was a question of we couldn't ship anything out. The region is about 9% of global aluminium production. Then we started worrying about getting those raw materials in, so the alumina and bauxite. And then we actually had some strikes on facilities and on energy infrastructure. And so we've lost about 4% of global aluminium production. And bear in mind, in commodities, we care about those very small imbalances. It's the price is set at the margin. So aluminium has been one of the standout performers so far. And what you typically see is when these disruptions happen, you're looking at 12 months to fix them. So that's been the big disrupted one. And then, of course, we've had some changes in these macro factors that have been a big driver for metals. So things like the dollar weakness had been a big tailwind. That reversed briefly, obviously coming back towards weakness again, changes in interest rate expectations. So that has taken a bit of the wind out of the sails for some of the others.
Let's just stick on that line, 12 months to fix. 12 months to fix the production, to get back to where we were pre-war. What does it mean for the demand story over the next year? How do you anticipate that's going to change?
Yeah, look, we anticipate there'll be about a 2 million ton surplus in the aluminium market, which is a lot of demand to try and destroy. I think what we're seeing at the moment, similar to oil, we've got a very steep backwardation, so a downward slope in the aluminium curve. What that's trying to do is disincentivize holding excess inventory at end users at the moment. So we're sort of trying to incentivize everyone to hold as little as possible for now while we try and figure out where we can get a bit more supply. We might also start to see a bit of switching. So could you see perhaps some substitution towards things like steel in the auto sector, but I think it's going to stay a very, very tight market.
How much have you seen different regions pull up the slack, given the fact that in the Middle East there has been a destruction to facilities and a destruction to supplies? Are you seeing, for example, South America start to ramp up production? Australia, how much do you see sort of a shifting to different parts of the world?
Yeah, look, the challenge with aluminium is it's really all about electricity supply. And if we think about everything that's going on in the world with data centers and AI, the one thing that we're struggling with is electricity supply. The two regions where really you would think you could have a bit of response is China and Indonesia. Now, China is actually capped on its capacity. Potentially there's a room to increase slightly your amperage and get a little bit more out of it, but there's not that much that China can do. And then Indonesia has a good pipeline, but we kind of knew that that was coming already. They can't really do much quickly, and again, takes 12 months to fix a smelter. Also takes time to ramp one up, and power costs are just becoming very, very difficult. I mean, even in the US, we've had smelters being sold to data centers, even where in the US you've not just got aluminium prices, but you've got this record Midwest premium. So the all-in price here is about $6,000, and that's still not been enough.
So this sounds really problematic. This sounds like it should be moving markets more. It seems like a shortage. It seems like something that's going to cause inflation. Are you as sanguine as the rest of markets that seem to be just sort of declaring the all clear, mission accomplished?
I think, look, there's clearly an element of positioning and flows here. Aluminium was already a very, very long market coming into this, so I would say it's not like the market was caught short and had to suddenly cover, and I think that explains partly it. Some of this is playing out also in the physical premiums in different regions. So, for example, in Europe, you used to pay about $300 on top of the aluminium price to get metal. You're now paying $600, so that's doubled. In the Midwest as well, keeps rising. Japan premiums. So I think we are seeing it, but I would say the physical realities of this are going to become clear as time goes on.
I mean, this is just the latest shock when it comes to what's going on in the Middle East. A lot of importers were also dealing with the on and off potential of what was going on with Donald Trump's tariff policies. Are you seeing more countries stockpile base metals?
So I think we're seeing more countries definitely talk about it. At the moment, we haven't seen too much in terms of what we could say extra buying. But what we see is, first of all, this started off with the US Project Vault, talking about, we need to have stockpiles, we need to make sure we've got security of supply chains. We're now seeing the EU, the UK, Australia, South Korea, everyone's starting to bring up that word stockpiling. And so I think as we've had enough supply shocks now, we had this in COVID, that definitely drove increased inventories at the company level, but this time governments are paying attention too. So I think this is going to be a theme for the next few years that's actually going to be pretty bullish for the complex.
Yeah, how much of a premium is that adding to prices?
So I think this will probably keep your prices well above sort of, typically we would say prices should be anchored around cost support or incentive price, what you need to bring on for a new mine. But if you think about inventory building, it's essentially demand. So that allows us to trade at a premium. So for example, in copper, we would say that kind of incentive price is more like $10,000 a ton to bring on a new mine. But we forecast prices staying well above that, sort of $12,000 through the medium term, just to take into account that stockpiling.
Can we finish on gold?
Absolutely.
South of 5K. What's going to happen to demand for gold now, and how has that shifted? How has that changed? We've talked so much about this massive tailwind of central bank buying. Is that still going to be the story, or has that ended?
So I think the central bank buying has been the sort of stable level of gold demand under the surface, although what we did see in March was Turkey selling gold to underpin the lira. In contrast, though, we had China actually buying the most gold they had bought since January 2025, so a bit of a reaction to that pullback in prices. I think the bigger factor that's going to swing around is what the exchange-traded funds are doing. So last year, they bought nearly as much gold as the central banks, having bought zero the year before. So they are the ones that really swing their behavior. That's much more dependent on interest rates. So again, they have been selling. And I think also there was quite a lot of buying that was just related to how well gold was doing. So I think the fact that it has come off, we've sort of reconnected with that real yield story as well. I think maybe that stops a bit of the near-term upside and just keeps it a little bit more to do with fundamentals.
Gold this morning, slightly positive by 0.8%. Just one final question, slightly outside of your remit, but try and indulge me. In this market, particularly in equities, they've taken a lot of comfort from the shape of the futures curve in crude. At the very front, you've got these very elevated prices. The closer you get to the physical spot price, you've got a lift in the price. Further out, you've got a massive decline. That's the backwardation people have been talking about now for weeks, 6 weeks, more than a month. People in equities see that as a market-implied bet on the future price of crude. Is that the right way of looking at things when you look at a futures curve?
Yeah, so look, I think the way we would think about the futures curve is more a reflection of inventories and flows rather than a forecast for the price. And this applies to metals as well. Typically, when you have that downward slope, spot prices higher than futures, that's telling people we need to clear everything out of inventory. We need as much oil as you can give us at the moment. So if anything, that downward slope is usually a bullish signal for commodities rather than a bearish one.
Interesting. Amy, it's good to see you. Thanks for being here. Thanks for breaking it down. Amy Gow there of Morgan Stanley on the commodity market. Brent crude and WTI just south of triple digits so far this morning, and closing below triple digits for 4 consecutive sessions, just adding to some of that enthusiasm in this equity market. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. NVIDIA is denying a report that it's acquiring a large company that would, quote, reshape the PC landscape. The website Semi-Accurate saying the chip maker has been negotiating a deal for more than a year. The report sparking a rally in both Dell and HP shares. Treasury Secretary Scott Bessent saying banks may soon need to collect citizenship information from their customers. The move could make it more difficult for immigrants and some citizens to open U.S. bank accounts. Bessent saying an executive order mandating the change is in process. And a Blue Owl fund raised $400 million from bond investors, marking the first deal of its kind in over a month. The bonds were issued by Blue Owl Capital and priced to yield 6.5%, with proceeds to be used to repay existing debt, though shares up 2%. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour in about 30 minutes' time. Up next on the program, calculating the impact of war.
If we were going to have an extended $90, $100+ a barrel of oil month after month after month, we would have to, here in the U.S., start factoring that into our calculations. It would start spilling over.
Well, we've done month after month. We're just waiting for the next month, I guess. You know, it's adding up. Sonal Desire Franklin Templeton joins us next from New York City. You're watching Bloomberg TV.
in case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
Stocks up again. Getting used to saying that. Up another 0.2% on the S&P, up 0.4 on the Nasdaq. Lots to talk about in the bond market as well, so let's do it. In fixed income stateside, yields just about unchanged on a 10-year at 4.29. Things haven't been unchanged over the last month. We talked about it in the last hour. The move high you've seen in UK yields through the month of March up by close to 70 basis points, levels we haven't seen since 2008. Well, the buyers have stepped in with those levels. The Debt Management Office in the UK just issued £15 billion of 10-year bonds at a yield of just a little over 4.91%, the highest since 2008.
So the good news for the United Kingdom is they had a record volume of investor demand coming in to buy said debt offering. Yay, that was the headline earlier today. A little bit of a problem, though, when you take a look at what kind of premium they have to pay up to get that interest, which, again, goes back to the core question we keep asking. How much fiscal headroom do a lot of these nations have to meet any softness in the economic outlook based on higher energy prices, higher inflation?
And also another dimension, and we talked about it briefly, the degree of demand that will step in. Now we've backed up to these levels. We saw it in Japan, the highest yield since the 1990s through the month of March into April. In the UK since 08. In Germany, I think, since 2011. And this is why bond investors are seeing this as an opportunity. Now, whether it's the right opportunity, I don't know. Not for me to say. But we've heard that repeatedly over the last month, that with this backup in yields, the buyers would step in.
If somebody wants a relatively risk-free, although you can make that argument, a relatively risk-free portfolio at 5%, well, if you don't have to lever it up, it looks pretty good, especially based on where we were, say, 6, 7, 8 years ago.
The latest out of the bond market so far this morning, under surveillance this morning, calculating the impact of war.
A lot of it just depends how long does this go. If we were going to have an extended $90, $100+ a barrel of oil month after month after month, we would have to, here in the U.S., start factoring that into our calculations. It would start spilling over. It'd first go into airlines, anybody who has to drive, and then it would probably pretty quickly start getting into food pricing.
So here's the latest this morning. The Federal Reserve weighing the impact of increasing fuel costs with fresh inflation data due out in less than an hour's time. Sonal Desire Franklin Templeton writing, the Fed will stay on hold. It's too early to panic about the damage that high energy prices will do to growth. Sonal joins us now for more. Sonal, welcome to the program. I've got to ask you the question. What kind of damage, if any, do you expect from the higher prices we've seen so far?
So the prices, hi Johnson, thanks for having me. The price increases we've seen so far
in real terms, are still 20-25% below what we saw in 2022. What damage did they do? No, I mean, clearly, on the margin, having $4 a gallon gas prices is problematic. But you have to remember, since 2019, we've had 27-28% inflation. So in real terms, $4 today just doesn't mean what $4 even 4 years ago meant, let alone $4, say, 2007-8.
Is that an argument, Sonal, for higher yields from here?
Yeah. So I would say that as far as yields are concerned, I do think that this at 430, this isn't a buying opportunity. I think we are for the US. I hear what you're saying about the UK and parts of Europe. I think that there will be more significant damage over there to GDP growth, and potentially you do have opportunities. However, in the US, I think there is scope for inflation to go higher because there's scope still to get that famous tailwind from consumption that we've been waiting for from the tax refunds. In addition, I think that the budget deficit could go higher, as we start seeing more defense spending. At some point, we'll have to see that. It's hard to say that it's all going to happen this year, but over time, just restocking our military implies a higher budget deficit, unless they cut expenditure, which nobody seems to have any desire to do.
So now it seems like heading into this year, people were looking for a yield curve steepener. Then it suddenly became a yield curve flattener. You saw the flattest yield curve going back to 2022 at the end of last month. Now people are gaming out what you're talking about, a Fed that might remain on hold or even cut rates, even as inflationary pressures remain. How much do you expect the yield curve to steepen over the next, say, 6 months?
So since I don't expect the Fed to cut, and I do think long-end yields are probably going to go up, I think that the yield curve can steepen. How far can the long end go? Depending on, I hate saying this, but depending on how long the war lasts, that has inflationary consequences eventually, and it also has certain implications as far as the budget deficit is concerned. So I'd say, could you see 25 basis points more? 30 basis points more of yield curve steepening from here on? Yes, and even more as if markets start pricing out rate cuts.
At what point do government bond yields start crowding out some of the corporate bond issuance, given the fact that the United States and other countries are going to have to sell debt to raise money to pay for some of the expenditures that you were talking about? And given the fact that right now we're seeing a record amount of corporate bond offerings come to market.
Lisa, we are awash in liquidity. If I look at how much we have in the short end in cash, in liquidity, in the ultra short parts of the bond market, I think we still have an overhang of liquidity from close to soon 20 years of massive QE, which has never significantly been reined in, and budget deficits. We're just awash in liquidity. I don't see that crowding out happening. I mean, rates will be higher, and I think we will see interest in the bond market.
So now, when you look at a higher budget deficit in the United States because the restocking of the military and a higher defense budget, do you have to start pricing that in before the midterm elections this year? Because at minimum, likely, the Republicans are going to lose the House.
Yeah. Now, I think that the question of how that deficit increases and the timing of it, I think some of it probably does start showing up as we get closer to midterms. For one thing, we probably won't see the tariff revenues, which were never really budgeted, coming in quite as strongly as was anticipated, given the changes which are in place as far as tariffs are concerned. There are a variety of reasons to anticipate the ex-post budget deficit is going to be somewhat higher than the ex-ante one, despite the fact that higher inflation does lead to higher budget revenues mechanically. That happens.
When it comes to tariffs, doesn't the U.S. government have another bill to pay, the refunds?
Well, the bill to pay and the refunds, is it going to take years or is it going to take months? I really don't know, because I have no idea how quickly that will be done or how the logistics of it are actually going to be solved. And nobody's really been able to give me clarity on what the logistics of tariff refunds, how it's going to actually play out.
So no, if I was in line to be the Fed chair, I'm not. If I was, I'd be delaying processing my paperwork because I'd have nothing to do with what's going to happen this summer. How messy, I'm not implying anything, how messy is communication going to be later this summer?
Actually, Jonathan, I think that communication would be rather easy because I think that inflation will probably help any incoming Fed chairman by showing up high. You don't cut rates into that. I did hear there's still a big expectation that somehow rates will be cut because Walsh is coming in and Trump has given him the job. But if inflation picks up, and again, it shows up. Inflation, when we see fuel prices go up, it will show up in inflation. It's a separate question as to whether it's enough to actually have a very detrimental impact on consumption. However, it's going to show up in inflation, and I'm not anticipating a massive slowdown in the labor market. So you put those two together, communication is actually not complicated at all.
Would make it complicated for a man that was employed to cut interest rates, but that, I guess, is a different story. So, no, it's good to see you. It's good to see you, as always. So, I'll decide there of Franklin Templeton on the future of the Federal Reserve and this bond market. Check out this move, American Airlines in the pre-market. This market's shown that report by us a lot of respect. Stock is up by 9% in the pre-market. That report, if you're just joining us, United Airlines CEO Scott Kirby exploring the potential of tying up with American Airlines. American Airlines up in a pre-market by close to 9%.
Yeah, and United shares also up in pre-market trading. The market is saying, please, this looks like a great deal. Whether or not regulators think the same, highly unlikely, although we shall see, because evidently Scott Kirby talked directly with President Trump about this. Heading into higher oil prices, we're getting reports that the European Union is preparing for shortages in jet fuel in the very near future. How much better of a hand do the strongest players have? They have an incredible upper hand when it comes to maneuvering through this, and Scott Kirby wants to take advantage of that with acquisitions.
It would be a big hurdle to clear for the DOJ and for the Department of Transportation to allow this merger to go through. But this isn't the Biden era where you can't have a Coach handbag tie-up. So potentially there is some runway for a sort of airline deal. And maybe to your point, they're anchoring to the extreme. It's not this one, but this is where they're going to set the debate around. And then they'll say, okay, if you think that's too big and there's too many problems for antitrust.
How about JetBlue?
Yeah, how about something smaller?
How about that? America right now, up by 8 to 9%. Can you imagine if that did go through? What that would open up, not just in that industry, but in other industries. Other players who would look at the competition.
Google and Amazon?
My goodness. Beyond that.
It'd be crazy.
Just crazy. Coming up in the next hour, Joe Cassidy of RBC, Alicia Levine of BNY, the Port of LA Executive Director Gene Soroka, and Stephanie Roth of Wolfe Research. The third hour of Bloomberg Surveillance is just around the corner.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the camera, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
It's going to be a lot of stress on the market.
Investors always hit the sidelines when you have uncertainty.
It's risky not to take risk.
The market is being very calm about this whole situation.
There's a lot of other themes that people are going to have to sort of roll their sleeves up on again.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pushing higher by 0.25% on the S&P 500. On the NASDAQ, up by 0.5 on the NASDAQ. A 9-day winning streak. In the commodity market, Brent and WTI pulling back. WTI this morning down by 2%. Brent down by 0.8%. 98 on Brent. 96 on WTI. This headline just crossing the Bloomberg terminal. Iran mulling pausing its Hormuz shipping to avoid derailing talks.
Yeah, this according to a person familiar with the Tehran's deliberations, as reported by Bloomberg News, saying that this maybe signifies this desire to keep talks on the rails to avoid escalation in any form as they continue to have ongoing face-to-face negotiations. A real question here about uranium enrichment as well as reopening the Strait of Hormuz. Not open yet, nonetheless, not escalating the conflict further.
Well, exactly. This says to me that Tehran wants to have these talks, potentially, as Reuters reporting this weekend. We reported that talks are potentially underway, but as soon as maybe Friday and Saturday and Sunday. So basically what they are going to do is hold back on any sort of maritime activity to make sure that there isn't an escalation. So keep things at this moment, the status quo, so the ceasefire holds. That, at this moment, would be viewed as a very pragmatic step for this regime.
That is contributing to the reset we've seen in this equity market, wiping out the losses since the start of the war. The S&P 500 coming into this morning, positive for the year. Supporting that maybe some bank earnings. And the bank earnings so far have been very, very mixed. From JP Morgan, from Goldman Sachs, Citi just crossing moments ago. Citi crossing seconds ago.
Yeah, and coming out with a beat for fixed income currencies and commodities sales and trading, coming in at almost $2 billion versus the estimate of $5.02 billion. Equity sales and trading coming in at $2.08 billion versus the estimate of $1.73 billion. Pretty much across the board, there was a slight miss on the banking side. The CEO, Jane Fraser, coming out and saying services had an outstanding quarter. You're hearing that there is this ongoing right-sizing of Citigroup and that the banking bank is entering into its final phase of divestitures, but the real takeaway here, capital markets very strong, expectations were very high. For the most part, most banks are clearing those hurdles. The response in markets, though, has been a little bit more differentiated.
This is the early move. In the pre-market, the stock is a little bit higher by more than 1%. Danny Berger's pouring through those numbers. We'll get to Danny in just a moment. To set up the next 60 minutes, we'll catch up with Alicia Levine of BNY Wealth following a morning of bank earnings. The Port of LA Executive Director Gene Soroka joins us as war in Iran weighs on global supply chains. And Stephanie Roth of Wolfe Research breaking down the latest inflation data. The latest earnings then, to wrap them up, we've heard from JP Morgan this morning, from Wells Fargo and Citi just moments ago. Danny has more. Hey, Danny.
Hey, John, and the story is trading very, very strong for Citi, posting $5.2 billion of trading for FIC. That comes just under the high watermark of a record they set in 2020 during COVID, but easily above expectations. Their equity business, which keep in mind this is much smaller for Citi, posts a record sum, $2.1 billion of trading. The estimate was for $1.7 billion. This is the first time in Citi history that we have an equity trading figure that's above $2 billion. Lisa did mention this. There is some disappointment coming around their banking revenue. That comes in at just over $1.7 billion. The estimate was for 2.1. But the big takeaways and the reason you are seeing positivity for Citi, this was the highest quarterly revenue in about a decade for Citi, the best return on tangible common equity in 5 years from Citi. And Jane Fraser and the team go on to explain that they are 90% of the way to completing their programs around their back office, their regulatory reporting issues, something that they had really been hit through. So it's this transformation of Citi that Jane Fraser has been undertaking as CEO, and they are getting closer and closer to completing that. In the meantime, notching very strong numbers for trading.
Danny, great coverage this morning. We've seen those strong numbers for trading at JP Morgan as well. Citi up by 2% in the pre-market. Jared Cassidy of RBC is back with us for more. Jared, you had an outperform on JP Morgan, an outperform on Wells Fargo, an outperform on Citi. Let's just sit on Citi. The revamp under Jane Fraser, how impressed have you been so far?
John, very impressive. As you can see from today's numbers, the return on tangible common equity was lifted up to about 13%, as it was just pointed out on your program. This is one of the better numbers we've seen in quite some time, and she's done a very good job in divesting the unprofitable non-U.S. consumer businesses. The last one up is, of course, the IPO for the Mexican subsidiary. They have the anchor investors, so we should see that this year. They have their big investor day coming up in May, John, and I think you're going to hear a lot of positive commentary about the outlook for Citi at that investor day.
I was struck by the commentary that we heard from Jane Fraser, in addition to the positivity that you're expressing and that the results most broadly did seem to demonstrate. She said, we're off to an exceptionally strong start in 2026. How do you pair that with concerns about what's going on with the Middle East, with some of the sort of warning discussions we heard from the CEOs of Goldman Sachs, JP Morgan, and beyond?
Lisa, it's a good point because, the first quarter was a tale of two quarters. When you think about coming into the year, up until the end of February, the quarter was very strong in many of the different areas for Citi and its peers. Then the breakout of hostilities at the end of February increased that volatility, particularly in the capital markets area. So there is still a lot of uncertainty out there, but should the hostilities in the Middle East start to die down and we get this resolved sometime in the second quarter, that points to a very healthy second half of the year for the banks like Citigroup.
You were talking about what's left in terms of the revamp. Jane Fraser said that the bank was about 90% of the way to completing the programs it established to fix back office and regulatory reporting problems as pegged by regulators a number of years ago. How different is the bank today than, say, 5 years ago? And how does that sort of set us up in the current environment?
I think it's very different, Lisa, because obviously you've had a change in leadership compared to 5 years ago. And I think that this leadership, led by Jane Fraser, is very focused on delivering the numbers and holds people accountable within the organization. And that's probably one of the biggest differences. And it's showing up on the bottom line. And so once they finish the complete revamp, as you point out, it's 90% completed. Once they finish it, then it's going to pivot from not a turnaround story, but to now it's a growth story. And this first quarter results really gives them a good jump on that growth story.
Jared, we know you're super busy this morning, so thanks for making some time for us. Jared Cassidy there of RBC, breaking down the results from Citi. Citi up on the year by about 8% coming into today, up again this morning by 1.6%. For stocks more broadly, finding a firmer footing of late with the big banks kicking off first quarter earnings season. Alicia Levine of BNY Wealth joins us now for more. Alicia, good morning. Good to see you.
Good morning.
This market's moved on from events in the Middle East. Do you agree with the direction of travel?
So we do agree with the direction of travel. We obviously remained concerned but not willing to change our allocations because we felt that ultimately the damage that would be imposed by $120 oil for a long time would not allow this war to continue much longer. And so as a result, we came into this with a pretty strong economy, a good setup with fiscal support, all the refunds coming from the IRS this season right now. The labor market looking like it was turning a little bit. And so you have all the incentives on the corporate side for investing. And so when you put it all together, the view that perhaps the U.S. could have grown at 3% or more this year was the narrative coming into the war. And so maybe you shave some growth off of that, but ultimately with earnings expectations at double digits, on March 1st, now 3% higher than they were, you have a situation where the fundamentals actually got stronger even as we worry about inflation and as we worry about where this conflict could go on the left tail.
Difficult to get your head around that over the last 6 weeks, given everything that's happened, the outlook for earnings actually improved. It didn't deteriorate.
It did not deteriorate. It's really shocking. When we tell clients, look, earnings expectations are actually higher than they were January 1st. It's not just driven by energy. I mean, that's the obvious one, that energy earnings are now positive. They were expected to be negative, but materials and the tech sector. So, the great partner to the S&P forward motion is tech earnings, and it's just, they moved higher. The expectations moved higher. So the other thing that happened or didn't happen is that there have been no downgrades at all. And so that's the thing to keep a look at. We're at the beginning of earnings season. You have to see, are input costs higher? Do we have to shave revenue on the expectations? Because that's what didn't happen. We haven't heard anybody bring earnings estimates down. So that's really the tension here. We're now at a 15% expected earnings growth for 2026. Is it realistic? Because the margins are the highest too. I'm not sure that's so realistic, and that's where we would look for any kind of moderating force on this.
So it's been a storm. It's been a month-long storm. It's been a 46-day storm, and a real question of what has changed fundamentally in the outlook going forward as a result of the Iran war. A number of people have pointed to leadership. To your point, the gains have come in profit expectations at big tech, at materials, not necessarily consumer discretionary. How much is this back to where we were at the same time last year when tech just reclaimed its leadership?
Look, we had this conversation a few months ago where I said, look, I think tech can actually move higher into the rest of the year. Everybody's selling software. They're getting out of tech, getting rid of the queues because they see more interesting opportunities in international and more traditional, I call it the dirty industry, so materials and energy and utilities. And in the end, tech has actually done quite well since March 1st because the earnings power are there. And if you're worried about growth and you're worried about inflation, you flee to tech. And I think there's a little bit now of a two-way conversation. Are you being paid to take a risk in this sector? And I think the answer is yes.
The other thing that people were talking about earlier this year is the broadening out away from the United States to the rest of the world. We had BlackRock, Jean Bovin, come on and say that he liked emerging markets. We had the same kind of commentary earlier this morning from Brian Levitt of Oppenheimer. How much do you expect the dollar to revert back to a weakening trend to allow that type of broadening out geographically?
So I think one of the most shocking things that's happened during the war is the fact that the dollar has not strengthened more. The dollar is essentially 1% higher than it was March 1st. One would have expected that the dollar would have strengthened much more based on the concern of the risk. So then what you have to say is, look, if this is simply a crisis-induced strength in the dollar and ultimately it means there's downward pressure on the dollar, ex-US markets will do quite well. And I think we're in that place where we never thought the dollar was going to collapse this year the way many folks did, but it does seem that it should have been stronger than it was, and it wasn't. So I'd say rest of world looks okay. If you are worried at all about tail risk, then emerging markets and developed international are going to be the areas where you feel it first. You spoke about the bond yields here on the show earlier this morning. Global bond yields have sold up much more than in the U.S., and that is a concern. So I think you a little bit have to be careful about the, is this a trade or is this an allocation for the next 12 months? For the next 12 months, I still prefer to be in the U.S.
Within the U.S., you like industrials?
I do.
Can you just tell us why?
Because you have incentives for, first of all, I think you have to think about this. What's driving the growth here? The AI build-out is remarkable. What's happened to some of these energy providers and industrials is remarkable. You have stocks up 40 to 50% year to date, and that's because there are massive incentives to build from the tax code, but also the end user demand is there. And that story is still intact. That's why PMIs are positive. That's why, the ex-housing manufacturing is positive, because you are having this forward push. What got lost in this conversation is that we're really undergoing an industrial revolution. So we've all become geopolitical strategists for a month, but actually the AI forward push is moving forward. And so we see the reshoring theme and the AI build-out theme as enduring for the next 2 years.
We've certainly seen that in the ISM. Some decent momentum in that data. Alicia, it's good to see you.
Great to see you.
Alicia Levine of BNY Wealth. Constructive and has been throughout this war. And we should give people a nod, tip our hats to the people who have been constructive throughout this war, because there was a lot of risk out there, and this market has reset big time. There's still a lot of risk out there, but this market has basically done a round trip.
And pretty much everyone who has remained bullish has pointed to earnings and earnings expectations that have risen during this period of turmoil, and we haven't seen guidance materially lowered, and I mean materially from where they were earlier this year.
We haven't seen the cuts, to Alicia's point.
Yeah.
We haven't seen the cuts. Now, are analysts just too slow? They're waiting for the management teams over the next month to do the work for them?
It seems like the actual management teams haven't been guiding them that way either, because you heard from the airlines saying that they're going to maintain guidance even with the potential hit from oil prices. So a real question about whether growth was just expected to be so much higher, and so now the actual outlook is pretty much the same as it was earlier.
Adding to gains this morning, we're up by 0.25% on the S&P with an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Taking another look at Citi, we are seeing shares up 1.3% after the bank posted a beat on revenue and profits. Citi saw $5.2 billion in fixed sales coming in above estimates, while equities trading crossed the $2 billion mark, pushing the bank to its highest quarterly revenue in a decade. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And we are seeing shares of Global Star rising 9% in the pre-market. Amazon agreeing to buy the satellite operator for $90 a share. Amazon is aiming to compete with Elon Musk's SpaceX and its Starlink network. The deal is expected to close next year. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Bit of an update as well on Kevin Walsh. We talked about that in the past 10 minutes or so. Is a hearing underway? Coming up soon.
That's according to Tim Scott, who, of course, is the chairman of the banking committee, so it's important what he says. And he says he's cleared all the hurdles, and now we will go to have a hearing for Kevin Walsh next week.
The latest details from Senator Scott so far this morning. Up next, we'll get you some morning calls, plus we'll catch up with the Port of LA Executive Director Gene Soroka as the war in Iran weighs on global supply chains. That's next from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
CENTCOM has been charged to stop these vessels. It's not clear that they have a guidance about what to do with them after the fact. This is really a point of leverage that the U.S. government is trying to impose on both Iran and China. The U.S. government's view that this could be just a couple more weeks of pain, the timelines might not line up, in my view.
That was Rachel Ziemba of the Center for New American Security weighing in on the situation a little bit earlier. Your equity market update looks like this. We're positive by 0.3% on the S&P, up by 0.5% on the NASDAQ. In the commodity market, Brent and WTI trading softer this morning. WTI is down by close to 3%. Brent's down by 1.3, 98 and 96 respectively. That's the price action. Let's get you some morning calls. First up, Bank of America lowering its price target on Goldman to $10.50 after it reported earnings, seeing results that are likely to give investors pause. Your second call from UBS upgrading Tesla to neutral, believing shares are currently at a more reasonable level following the sell-off. And finally, Citi raising its price target on Alphabet to $405, believing its first quarter results are likely to beat expectations. That name is up at a pre-market by more than 1%. Let's turn back to trade. The war in Iran weighing on shipping as the U.S. blockade of the Strait of Hormuz enters day 2. The Port of Los Angeles Executive Director Gene Soroka writing, it will take months to untangle global supply chains. The economic ripple effects are real. They are growing. Gene joins us now for more. Gene, a good friend of this show, and thanks for making time for us this morning, sir. Let's start with the economic effects, the ripples you're seeing. Where do they start? How have they started, and where are they going from here?
Good morning, John. An adage in our port industry is that for every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Now there may be some fits and starts and some quick answers that could be delivered, but once the strait is open, there is a lot of work to do in the supply chain. We're seeing right now where vessel fuel prices have doubled over the last month and a half, and that carry-on effect to importers and exporters right here in the U.S. is happening today. They probably will simply pass on these costs to the American consumer and buyer.
So, Gene, fuel costs are going up. The length and duration of the trips is getting longer because they've had to reroute a lot of this stuff. We've seen diversions pop up in different places as well. From your perspective, are you expecting congestion as well? How lumpy are some of these arrivals going to be, and how complicated does that make life for you?
Each trade, John, is a little bit different. For now, the 46th day, you're not seeing a lot of traffic move from Asia to the Arabian Gulf. Red Sea and East Africa also disrupted. In the Trans-Pacific trade, the ship transits are fairly normal. We're seeing the regular departures and arrivals from Asia, but it's the ports that we share with those Middle East destinations that are becoming somewhat worrisome. Singapore, Kaohsiung, Shanghai, Korea, and then Japan ports. If this cargo continues to pile up at these locations, it may just simply get in the way of cargo that's more fluid, like that coming to and from the United States. I must say, though, with calls over the weekend and last night, the Asia ports are doing a fantastic job of keeping that cargo separated, so the fluidity of the trades that continue to move remains intact.
Gene, when you see individuals having to change basically some of their supply chain routes because of what is going on, do you see any of this sticking even if the strait opens? We have a little bit more of structural changes going forward.
Anne-Marie, this is always an outcome of disruption. Once cargo finds its way to a cleaner or smoother path, it tends to stay in that way for some time. We've had troubles over the past years with drought conditions in the Panama Canal, the Red Sea security issues leading to drops in Suez crossings by up to 80%. More cargo now moving towards the west coast of the United States in that trans-Pacific trade, where previously it had alternative routes and those that were quite lucrative for shippers going through those canals. More than likely, what we'll see is a reset at some point, because that consuming public in the Middle East is very strong. Albeit only 10% of worldwide container trade, the buying power for furniture, footwear, perishable commodities, and other retail goods will continue to be a primary market for those serving the Middle East.
I know there will be a delay even when the strait opens, but we haven't even seen the Red Sea get back to normal levels given what took place in the previous years with the Houthis. When do you think the Strait of Hormuz will actually get back to normal levels after there is a more lasting ceasefire?
That's the biggest question, and I don't think it's going to be a straight line, Anne-Marie. One day we're going to get a message that says all clear. I think this is going to be an iterative process. We're hoping that both sides can get back to the negotiating table to find a way towards some semblance of a truce, and then start having a conversation about the commercial implications and how we restart this engine. Right now, this blockade is for negotiating purposes to try to put some pressure on the system, and especially with the price of oil over $100 a barrel, this is a huge revenue pop for some, and it could be a tremendous cost implication for those that can't get their oil and energy products to market. Probably at the same time, there's some minesweeping going on in preparation for the day. We can see that strait open up a little bit, but when we've gone from basically 110 ships a day down to just a trickle, it will take some time to get these products moving in and out.
We're all hoping for the best, Gene. Appreciate your time. You're a gentleman. Thank you. The Port of Los Angeles Executive Director, Gene Soroka, on the situation, the congestion at certain ports in Asia, and the workarounds those guys have been playing up and trying to work through over the last 6 weeks.
Yeah, a lot of this really goes down to a fundamental question that a lot of people are asking, which is how much is the concept of free passageway on the seas truly in jeopardy or becoming obsolete? And how much does this set a precedent for that versus, say, some of the previous conflicts and what's happened there? And that's really going to be crucial to a lot of the supply chains.
Things have got messy very quickly. Up next on the programme, we'll talk about the data, PPI data set to cross. We'll get reaction from Stephanie Roth of Wolf Research. She's with us to break it down. Plus, the latest from the earnings call with JP Morgan's Jamie Dimon and some comments on there on Kevin Walsh. That conversation up next.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Every trading day, only on Bloomberg.
Another read on inflation data in just a moment. PPI is just around the corner, seconds away. Mike McKee will break it down for you in just a moment. The scores heading into that. Equity futures positive by 1/3 of 1%, 1 hour away from the open of We're up 0.6 on the NASDAQ. On the NASDAQ 100, a 9-day winning streak, and it could be 10-day. Phenomenal. Could be a 10-day winning streak on the NASDAQ 100. In the bond market, we're set up as follows. Yields on 10s just about unchanged throughout much of this morning. Let's call it 4:30. With your economic data, Mike McKee has more. Hey, Mike.
Good morning, John. It's a little bit better news than anticipated. PPI on a headline basis up just 0.5%. The expectation was for 1.1%. On a year-over-year basis, that puts us at 4% from 3.4. The expectation was we'd hit 4.6%. The core up just 0.1%. The forecast was for 0.4. Last month it was 0.5, and that puts the year-over-year for that at 3.8%. The core ex-food, energy, and trade is up 3.6%. That's a tick up from the last time. In the March rise for final demand prices, 1.6% advance in the index for final demand goods. Prices for final demand services were unchanged. And what's interesting about that is that final demand services were the issue in last month's big rise in terms of what happened. The one thing I want to check here is what happened with the services prices that we anticipated would go up. And that's the main issue here for airline fares and things like that. It doesn't look like that's immediately going to come up. So I'm going to leave that for you guys. But airline fares were supposed to go up. Gasoline prices, of course, going up significantly, and those are major issues. I want to leave you with one other thought, and that is that you have reported that the senator from South Carolina, Tim Scott, who's the chairman of the Banking Committee, says that Kevin Warsh, the Fed chair designate, will have a hearing next week. I'd point out that on Tuesday, the 21st, Christopher Waller, the Fed governor who was considered for the chairmanship, is giving remarks on how he would change the Fed in the future. It'd be very interesting if the two of them end up on the same day.
Mike McKee, thank you, sir. Appreciate the update. Mike McKee breaking down the PPI data and the future of the Federal Reserve. Just an update on the future of the Federal Reserve. This from Punchbowl just moments ago. The Kevin Warsh's confirmation hearing for Federal Reserve Chair will be next Tuesday, April 21. According to multiple sources with knowledge of the plans, the Senate Banking Committee is planning to notice the hearing later on today with just a month or so left on Jay Powell's term. So things are moving forward, slowly, but moving forward.
Yeah, so he has this hearing. The question is, does the Jay Powell probe get dropped so then Senator Tom Tillis can then vote for Kevin Warsh to get through the hearing and then have a full vote, not in the committee, but actually on the Senate floor? That is going to be the key question, because Kevin Warsh getting a hearing, okay, great, that moves it forward slightly, but unless Tom Tillis decides he's going to vote for it, he could just be stuck in this committee. And we don't know if Tom Tillis is going to vote for it until we know what goes on with the DOJ probe on Jay Powell.
In addition to that, we don't know what Chairman Powell himself will do with regards to his future.
Yeah, whether he'll stay on as a governor even after his term as Fed chair is up. He said he will make that determination at a later point. Unclear what the characters are going into that. Nonetheless, it's even less clear to know what exactly the Fed is going to do with the panoply of potential data as well as events that are coming down the pike. Kevin Warsh might want to hang tight before he has to make the argument to cut rates, given the fact that there's a lot of dissent on the committee and some real pressure coming from the White House.
So we've got two things to do here. We need to talk about the future of the Federal Reserve. We need to start on the economic data. PPI softer than expected, pushed that through the bond market. No big moves here. The US 10-year yield is unchanged so far. In the equity market, still positive by about a third, call it a quarter of 1% higher on the S&P 500. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning. Good to see you.
Good to see you.
Your reaction to that data for the month of March?
Yeah, so the details that matter for core PCE is really what we're looking at for. Airlines were up similar to CPI, 2.8. Physician services were kind of light. Finance wasn't too strong. So our tracking for core PCE for March should look, in the 0.2% range. So when we're thinking ahead, the question though is, are airline fares going to start increasing more materially in the upcoming months? And that's when it's going to become a bigger question. And I think that's what the market kind of told you after CPI is, yeah, okay, we get that the March data were okay, but what happens in the months after that? And that kind of fits with our move that we made somewhat recently, pushing out our Fed cuts from previously 2 cuts this year to now 1, and then we added 1 cut into 27.
What's your base case for inflation? What's the trajectory of things through the summer and into the fall?
Base case is that you'll stay around 3%. We think you'll actually end the year at 3.1, but that, of course, compares to the Fed's 2.7. Our expectation is the Fed's ultimately going to have to revise that up, which then makes it a little bit more difficult for the Fed to be cutting in the next couple months.
That said, doesn't the fact that you're getting less inflationary pressure heading into this period a positive with respect to the Fed's ability to cut rates? I mean, doesn't it sort of take off the table the idea that inflation was heating up in a dramatic way that would force a lot of these producers to raise prices for consumers?
It's certainly a positive sign, but then again, your February core PCE was 0.37, so you're kind of starting at an okay place, not amazing, and core inflation year over year is still, around 3%. So I would say it's an okay spot. It's not as if you were starting from a very low inflationary backdrop. And now you're going to have just a little bit of upward pressure in the next couple of months.
What data actually makes sense to look at right now? Because it seems like the market kind of looked past this, is looking past other factors that have come down the pike. It seems like old data, not relevant, not necessarily going to track. What are you waiting for that will give you a sign of whether we really are in an inflationary kind of upswing or not?
It's going to be the realized inflation data. Today is another indication, but we probably need to see April and May to get a sense of whether you're really seeing the pass-through in terms of airfares. I think that's probably the cleanest component that feeds into core inflation that is directly tied to the energy shock. So if we don't see stronger airline fares in the next couple of months, I think might feel better about the pass-through. Of course, then that tells you maybe there's a problem for airlines to be able to pass through those costs. But that tells you the inflationary backdrop certainly looks different than 2022.
We need to talk about the future of the Federal Reserve as well. Kevin Warsh making an appearance on the JP Morgan call with Jamie Dimon, not literally, but his name was mentioned. Danny Berger was tracking that. Danny joins us now. Hey, Danny.
Hey, John. I have to say, it was extremely brief, Jamie Dimon's comments around this. Basically, a journalist asked, Mr. Dimon, how do you feel about delays to the nomination of Kevin Warsh? And I have to say, this question was asked right before Punch Bowl reporting the impending maybe process coming forward. And Jamie Dimon said simply, Kevin, I guess they're on a first name basis, Kevin is a great candidate. The sooner, the better. And then he ended it there. He also goes on to talk a lot about economic confidence he has despite the war and despite some of the uncertainty going forward, but a very confident Jamie Dimon on the economy and basically just saying, yep, Kevin Warsh, he'd be great, and the sooner the better.
Danny Berger with the latest. Danny, thank you. Looking forward to the programme alongside Matt Miller, kicking off in about 20 minutes' time. It makes the question around Chairman Powell's future, I think, all the more important. I've raised this question over the last month or so since the last meeting with the chairman, when he refused to say that he would leave even if the investigations went away, and even if we had a new chair appointed, he wouldn't rule out staying on as a governor of the board. He seems to be worried about central bank independence, which is curious because so many establishment figures back Kevin Warsh to lead this Federal Reserve.
There's some speculation that Fed Chair Jay Powell was trying to take back a little bit of control or at least push back from what the White House is doing. Whether he will come clear with respect to what he's going to do if Kevin Warsh is nominated remains to be seen. Right now, markets have been incredibly sanguine about the future of the Fed. It's sort of a parlor game for us and for analysts to talk about what this could look like in the lack of certainty. But the conviction in markets that this Fed will anchor inflation, I can't get over that. The fact that that has persisted, even with all of this drama, even with the questions of the politicization of the Federal Reserve, is what I keep coming back to. So I agree with you. I think that there are some real questions here. The market implications, though, I'm not seeing it, which I think is interesting.
What was so interesting about when Jay Powell did that at the podium was that he wasn't actually even asked about that question specifically. It was third on his list. He didn't even need to go there, but felt the need to say that as almost to the White House, I still hold this card. Remember, he is still being investigated in the Federal Reserve by the DOJ. And I think that was a reminder to the White House, I could still make this complicated.
An update from Punchbowl News. I mentioned it earlier. If you're just joining us, this on Kevin Warsh's confirmation hearing for Federal Reserve Chair will be next Tuesday, April 21. That according to sources with knowledge of the plans. That's according to their reporting. The Senate Banking Committee is planning to notice the hearing later on today with just a month or so left of Chairman Powell's term. Stephanie, inflation expectations. Bank of America had this note this morning, and I thought the headline was catchy, that tankers are anchored and inflation expectations are too. It's a curious moment, isn't it, that inflation expectations have been so well anchored. What's behind that?
Yeah, I mean, I think it's a combination of an expectation that it's not just about one person on the FOMC, and they have proven that they are focused on keeping inflation anchored. And it's been an FOMC over the past couple of years that has been very willing to hike rates in the face of the elevated inflation, and it's not just up to one person's view. And what we've seen so far is an energy shock that ultimately could hurt demand. It's different from where we were in 2022 when inflation expectations started to show signs of potentially becoming unanchored, because today the economy is not the same as it was. Back then, payrolls were running at 600,000. Today they're, call it 50, 60. Unemployment rate was low and headed lower. Now it's up with, some upward pressure from AI. It's just a very different economic environment. And I genuinely believe if we were to see an oil shock that's more significant than this, we would start to see demand destruction, and the Fed will ultimately be easing as opposed to having to hike.
Based on this reporting, this hearing will take place a week today. What is the argument that Kevin Warsh can make for lowering interest rates at the Federal Reserve? Given everything you've just said, what do you think the argument will be that he'll present?
I think it's going to be all about productivity and AI, and a backdrop where AI is disinflationary, and ultimately that will mean neutral rates are lower in the medium term. And that was the view that the market had held before the Iran shock really hit. And it's his sort of best argument, especially in the face of where inflation is today, where the economy is, and the sort of the potential direction of travel. If you do really have a strong productivity cycle, you don't usually have inflation problems at the same time.
It's incredible how little expectations for earnings in this economy have changed over the last 6 weeks, given this major shock we've seen in the Middle East.
Even for some of the most exposed sectors. And what you're hearing is maintaining, even on the margins, upgrading. Again, how much does this go back to how much momentum there actually was in the U.S. economy ahead of this war in Iran, and how the upside was the potential surprise? Now we're sort of getting back to the expectations maybe at the start of the year.
Stephanie, good to see you. Thanks for being here. Stephanie Roth there of Wolfe Research. Equity still positive by 0.3% on the S&P with an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Recapping the data we just got, producer prices rising 5% in March. It's less than the 1.1% that was estimated, but follows a 0.7% rise in February. Companies are navigating a surge in energy costs tied to the Iran war. Stripping out food and energy, producer prices rising just 0.1% in the month. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And Kevin Warsh's confirmation hearing to be the next Fed chair is reportedly scheduled for next Tuesday. Warsh clearing a key hurdle, Senator Tim Scott saying Senator Tom Tillis is now planning to support Warsh. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you for the update. Up next on the program, we'll catch up with Eric Friedman of Northern Trust Wealth Management, with stocks trading very close to record highs. Plus, Yahara's back with your morning movers. Amazon shares rising in the pre-market on its latest acquisition. That story up next.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
For every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Once the strait is open, there is a lot of work to do in the supply chain.
Real physical disruption, this market's looking through it. That was the Port of Los Angeles Executive Director, Gene Soroka. This market, the gains continue. Up 1/4% on the S&P 500. The run continues on the NASDAQ. 9-day winning streak on the NASDAQ 100, the longest since September 25. You make it day 10, the longest since November 2021. The NASDAQ this morning up by 0.5%. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. One of the biggest airline deals ever could be on the table. We're reporting that United CEO Scott Kirby has floated the idea of a potential merger with American, that he's talked to senior government officials about this. So you are seeing American up 8.5% in the pre-market, even though any deal would, of course, face intense antitrust scrutiny. And it's official, Amazon agreeing to buy the satellite firm Globalstar in an $11.6 $6 billion deal as it tries to compete with SpaceX and its massive Starlink network. So you are seeing shares of Globalstar up 11% in the pre-market. The deal is expected to close next year. And we end on Lucid Motors. Those shares up nearly 5% in the pre-market as the struggling EV maker tries to reset, naming a new CEO and locking in $750 million from its biggest backers, Uber and Saudi Arabia's public investment fund. John?
Yahara, thank you. Great work this morning. As always, appreciate it. As we count you down to the up and about, some things to look out for through the next 24, 48 hours or so. Coming up tomorrow, results from Bank of America and Morgan Stanley, plus the Fed's Beige Book, another read on how they're thinking about the situation in the global economy. On Thursday, another round of jobless claims and more earnings for you. Netflix results just around the corner. The run we've seen in some of these tech names, phenomenal. 9-day winning streak on the NASDAQ. We're looking at day 10. Eric Friedman of Northern Trust writing the following: we do not expect the Iran conflict to severely impact the corporate profit cycle or credit markets. We remain overweight risk assets relative to bonds. Eric joins us now for more. Eric, welcome to the program. I have lost count of how many times I've asked this question of an equity market bull. What is anchoring that view, given the turbulence we're seeing play out in the Middle East?
I think the biggest things, Jonathan, are twofold. Number one, we still think consumers will remain resilient, not necessarily lower income consumers, but middle income as well as upper income consumers. Those have really been resilient. We think that continues. Also think that CapEx is still a variable that will be durable as well. So those are the two variables that we're probably domestically most bullish about. But I would say part of our opinion has changed with respect to the non-U.S. equity picture. We came into the year a little more excited about things like Japanese reflation, European deficit spending. Those may get somewhat crowded out by how challenged those regions in particular will be to the energy issue. So I think if anything, Jonathan, we're still bullish, maybe a little more of a relative value opportunity set we're seeing right now. But again, we think CapEx as well as consumer durability in the U.S. likely remains the case.
Eric, can you just stay on that? The vulnerability of what's happening internationally, because the key trades for many at the start of the year, Japan took off, that continued. South Korea just exploded higher. Are those stories under threat, even though they have some connection, particularly the Kospi in South Korea, with the developments in tech in the U.S.?
Yeah, I think that's well put, Jonathan. If you look particularly at the issues with, for example, helium and the various parts of the hydrocarbon cycle that play into technology, those aren't going away. In fact, those have gotten worse. And so, you know, part of the issue is will there be some sort of redirection of both trade as well as will there be some new winners within the technology space that are maybe not as affected within some of those shortages. So again, we have to respect that the direction of travel is a bit different with respect to both technology as well as what may be playing out across some parts of the consumer cycle, in particularly in Europe. That's a significant issue that may be different.
Eric, from February 27th till today, what's changed in your portfolio?
Yeah, the biggest things, Lisa, one is that we've shrunk tracking error, which is a long-winded way of saying that, hey, when the world changes quite a bit, we shrink our exposures, meaning we had a somewhat outside view in terms of an overweight for our tactical clients within non-U.S. equities. We've actually shrunk that. We've retained our bias within real assets. So the biggest thing that we've done is really shrunk that exposure with respect to the non-U.S. equity portion of our portfolio, and we've been more emphasizing the real asset side. That's been something that's been consistent, and we'll probably keep that on for some time.
And now the fun starts where we actually get earnings. We get to hear from different companies. The banks have been first, and J.P. Morgan came out earlier this morning on the call with analysts. The CFO said consumer spending growth is outpacing last year, talking about how engagement and pipelines remain healthy looking forward, talking about mergers and acquisitions, IPOs, the like. How much do you take a read from some of these earnings in terms of the forward look, if you can put aside the conflict in the Middle East, to get optimistic heading into the rest of 2026?
Lisa, it's critical in terms of what we're seeing with respect to consumer activity, particularly do we see credit change? And when I say credit change, are we seeing an extension of, again, we saw personal savings dip a bit, we saw personal income remain somewhat flattish, but are people extending credit in terms of financial services providers? And also, we're more concerned about what some of your other guests have talked about in terms of, you know, what happens with budget deficits, what happens with the back end of the curve. We're in year 19 of the 10-year Treasury yield being below 5%. We've become accustomed, if anything, we've become incredibly desensitized to interest rate volatility. So the Fed, with respect to front of the curve, not really a big concern for us. We're more concerned about, was there upside risk, if you will, if, for example, the administration decides to get very aggressive with pro-growth policies that the bond market rejects. That would be more concerning to us than what the Fed may have to offer on a next couple of meetings basis.
Eric, it's good to see you. It's always good to catch up, sir. Thank you. Eric Friedman there of Northern Trust Wealth Management on the Federal Reserve. The front end of the curve there, you can see it on the screen, 380. Anchored around where Fed funds is right now at about 377, 380. This is a Fed that's not going to do anything anytime soon, as a market is well priced for it at the moment, at least on a 2-year yield. Looking at the situation in the Middle East, just how is the blockade holding up? Is it being tested? We were tracking one particular ship. What's the latest?
Yeah, this was a U.S. sanctioned tanker linked to China, and it seems that it has made a U-turn. So everyone was talking about the fact that this is going to be a huge test for the blockade. Does the blockade allow this sanctioned Chinese vessel through? And it looks like it's a no, and it U-turned, so not being able to make that journey out of the strait.
The potential for escalation avoided, at least for now. On top of what we've seen over the last week, Bramo, the market rally continues. You talked about it earlier. This market's moved on very quickly over the last week. The prospect of more talks encouraging this market to move on even quicker.
The fact that we had a blockade announced on Sunday or Saturday, and that Sunday night people came in, and I thought, wow, it's going to be a bloodbath. No, not at all. Actually, we ended the day higher yesterday. We're really close to where we were. We actually surpassed. We took out all the losses since the war began. Gives you a sense of where people's minds are at. This morning, just adding to that, the fact that there are reports that Iran doesn't want to escalate things. They're going to avoid trying to even have any ships U-turn to just avoid the conflict. And the fact, okay, U-turning, but at least there's nothing violent that's happening as a result of it. So people are looking at this and saying, next, earnings, let's hear it.
Minds are firmly on the future, on the summer. A touch of summer in the air in New York City into the 80s. Later, spring with a splash of summer, right? You know?
I'm actually very angry about this. I would like spring to be spring. I don't want it to be 85 and humid, but you're right. People are just looking to...
I'll take the 85 and humid.
I know.
Yeah, and you're complaining about the aircon. Interesting. Okay. Let's see how comfortable you are. Let's make it 85 and humid in the studio, and we'll see if you're happy with that.
No, but there's a happy medium. It doesn't need to be 64.
Okay, we can continue having this back and forth. Just a moment. I look forward to it. All right, coming up tomorrow, I really don't. Noel Dixon of State Street joins us, David George of Baird, Phil Camporelli of JP Morgan, and Pooja Sriram of Barclays. From New York City this morning, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content and never the two shall meet, but there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're getting closer and closer to another record high on stocks. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Iran may pause shipments through the Strait of Hormuz in an effort to avoid escalation and keep peace talks on the table.
And a mixed bag, bank results. JP Morgan CEO Jamie Dimon sounds off on geopolitics, the Fed, and AI.
Plus, United explores a blockbuster deal with American that could shake up the industry and spark a regulatory fight.
That would be incredible.
It would be bonkers.
Truly bonkers. That's the appropriate adjective for this situation. I'm looking at the bank stocks this morning. You can see a very mixed performance for them. JP Morgan, I have to say, across the board, really strong numbers, except for the fact that it guided lower for its trading revenue for the year. Citi, really strong numbers, some records when it comes to varieties of their trading figures, including equity trading. Wells Fargo, it was a miss across the board. At interest income, they reported also, for the first time ever, very granularly broke out their exposure to private credit. $36 billion is what they see. We also heard from the asset management giant BlackRock, $130 billion in client cash in the first quarter as ETF inflows surged. Catherine Doherty will break that all down for us later in the show, Matt.
That's very cool. Wells Fargo breaking out those numbers because I think shareholders demanded.
Yeah, to be clear, they've broken it out on other filings, but this is the first time ever on an earnings report where they said, here's our exposure to private credit.
Well, we're going to talk about that. Also, we're going to talk about Bloomberg Scoop. United CEO Scott Kirby pitched a possible tie-up with American Airlines to senior government officials. That would create the world's largest airline. In normal circumstances, it would be a regulatory nightmare, probably a non-starter. But maybe it could happen now. You see United Airlines rising 2%, American up almost 9%. So the U.S. could get fewer and fewer major airlines. There's only 4 right now.
And if this is something that could happen, like what else in the world could happen? What other kinds of mergers of different industries, of giants, that could we get? Let's get back to those bank earnings, though, with Bloomberg finance reporter Catherine Doherty. I know we got a lot. Maybe let's just start with the behemoth that was JP Morgan. What were the takeaways there?
So trading strong across the board. This is continuing what we saw from Goldman yesterday. Citi as well reporting today with strong trading results. Wells Fargo as too, but they're on a much smaller scale than those 3 other banks. And I think that the other kind of strong point across the board was investment banking, specifically advisory. So for JP Morgan, they're also reporting one of their strongest quarters for advisory on a year-over-year basis. It is up. This is consistent with what they were signaling last quarter, which was that a lot of the deals that they saw towards the end of the year held off. You're seeing that come through in the first 3 months of 2026. And the other kind of numbers that we're watching, the disclosures from both Citi and Wells today, you mentioned the private credit exposure. So they're giving a lot more detail today. We had Citi put forth their $22 billion in the first quarter but they're noting 0 losses. So while they're giving more disclosure, they're also giving some comfort to investors and across Wall Street, saying this is our specific exposure and this is these specific losses that we have seen, giving some comfort there.
So JP Morgan does very well on trading, pulls back on the forecast a little bit. Wells misses a couple metrics, including revenue. Citi's the only one with a clean beat, right? I mean, a very impressive move from...
Except for their banking division. I think there was a slight miss there.
Yes, so their banking division was a slight miss. That's a good point, Danny. But I think across the board, this is consistent with what Jane Fraser has been signaling to the street, has worked really hard to bring the company forward from their completing the back office and regulatory reporting problems that the bank has seen. So those have been the target of penalties imposed by banking regulators in the past. We're really moving forward with that, is what you're seeing in these results. And from the commentary that you heard from Jane today, talking about their diversified business model, which is continuing to drive the revenue growth, is what she's noting. And then you hear some skepticism. She says that we remain a source of financial strength and trust for our clients during uncertain times. This is very consistent across what you've seen, the statements coming out from the CEOs of these banks. They're noting their own strength and what they're seeing as resilient consumer spending and savings across the board, but they are making note of this uncertain economic environment.
All right, Catherine, thanks very much. We're going to continue to talk to you about these bank results. Bloomberg finance reporter Catherine Doherty. On the data front, U.S. wholesale prices rose by less than expected in March, despite a surge in energy costs tied to the war in Iran. Let's discuss with Bloomberg macro strategist Michael Ball. So I guess the PPI numbers not as concerning as they could have been.
Again, everyone's wondering when the shoe's finally going to drop. When are we going to see the effects of the higher energy crisis that's occurring right now? So far, it's not necessarily moving beyond just the energy data that we're getting in these official prints, which is a positive because then again, as we know, risk sentiment is improving. We are building on this kind of positive vibes that the negotiations are still on track. And as a result, we can see kind of continual appetite to take on greater exposure as funds start to net up, the retail starts to re-engage again.
Just on that point, I mean, the S&P 500 is now back to pre-strike levels. We're up 8.5%, more than that, from the low we hit on March 30th. It's the second best run over 9 sessions in the past 4 years, only surpassed by the bounce back from Liberation Day. So is this a market where there is anywhere we are still pricing in a war premium, or is it back to business as usual?
It's starting to look like it's back to business as usual because the option backdrop is something I always like to lean into. Has become far less negative. We're seeing actually call buying now has become quite lucrative now, given how cheap calls were, given where put call skew was. But basically what that means is everyone had downside protection. Now everyone has sort of had to be taking that off. It's become very expensive to hold. You've lost money on all that. And as a result now, the chase is sort of occurring as people are falling behind the benchmark. To your point, it's been kind of an astronomical shift so quickly.
In terms of what we see in markets, I mean, we're almost back to record highs on stocks. We closed yesterday at a higher level than we did on February 27th. So before, the president started a war in the Middle East. Why all this optimism? Is it just that higher oil prices can't hurt our earnings?
There's a little bit of that. There's still this hope that there's a window of where this kind of higher oil price hits the real economic activity is available, meaning that this can all kind of end and we can still salvage from a global recession. And when you look at some of the surveys, we saw a Bank of America survey recently, there's still a very large belief that's going to be a soft landing scenario from this whole scenario. But to your point, a lot of people were just caught low exposure, low net exposure. Now they're having to chase. So what started as a short squeeze last week was really concentrated more in the mega cap tech has now widened. And yesterday's breadth in the market was much better, showing that people were actually participating in cyclicals again, and small caps, as we know, are also outperforming.
All right. Michael, thanks so much for joining us. Bloomberg macro strategist Michael Ball. Now, Treasury Secretary Scott Bessent is speaking at the Institute of International Finance in Washington. Let's listen in.
Impact. They're more vulnerable to disease, to hunger, to bad education, to corruption. The World Bank and the IMF need to get back to making rational priorities. For instance, using cost-benefit analysis, as Tim also just mentioned. These organizations used to lead the world in cost-benefit analysis. As I've argued for a long time, and the reason I think we're having this conversation now, is that we need to scrap these climate targets and get the World Bank and IMF back to their core missions. In your speech here last year at the IIF, you made this exact point, and you called on the World Bank and the IMF to refocus on their core missions. In your view, how has the bank and the fund responded, and what more do they need to do?
Good. Well, Bjorn, thank you. And good to be back here a year later to talk a little about a report card for the multilateral banks, and to also, the U.S. leads the G20 this year, and I can tell you that our agenda is growth. We believe in the U.S. that the biggest risk to financial stability is a lack of growth. When I look at the choices, say, that Europe has made, that they unable to follow the Draghi report from Mario Draghi on how to increase growth. The EU was originally the European Economic Union, and it was meant to facilitate trade among the members, make it more seamless, create more prosperity, and it turns out that it's probably been a hindrance. In terms of the IMF and World Bank, I'm informed by the Grace Hopper, who was the first female admiral in the U.S., who I was a big fan of. She has some great sayings. Two of them, one is the most dangerous words in the English language are because we've always done it that way. And the second is the way to get things done is to get things done. And I think we need to step back and look at the IMF and World Bank, their core missions. The IMF, I believe, is global financial stability and stabilizing on the countries that are in bad equilibriums and getting them back to a sustainable path, an economically sustainable path. World Bank is to pull people out of poverty. And we cannot have, as Bjorn said, these kind of elite beliefs get in the way. And if we think about, I go back and I think a lot about this Nature magazine article that came out in April of 2024 that became the guiding principle for so much of the climate beliefs that GDP was going to be 60% lower by the turn of the century. And then, so it was the gospel for 18 months, and then it was refuted. So everything was based on that. So, I don't think that we can have this kind of short-termism. I think we have to stick with core principles. And I do think we are starting to see at the World Bank, they are starting to take more for energy abundance and all of the above tact. They have now gotten on board with nuclear energy. I'm not sure why it ever went away. And then the IMF, I think, needs to lead by example, probably get rid of their golf course out in Maryland, which I said last year, and focus on global imbalances, because I can tell you, like this slow motion buildup of global imbalances after a lack of sustainable growth is the biggest risk. The world cannot take a China with $1 trillion trade surplus.
And I think you're absolutely right. And one of those points that we believe somehow that climate is so important that we need to do everything. The Nature study that you mentioned that suggests that we could lose 60% of global GDP if we didn't fix climate change, which later turned out to be wrong. But of course, the point is, if that was really true, it should have been rich countries spending rich country money on dealing with climate change. But that's not what's happening. It's mostly rich countries deciding to spend poor people's money through the World Bank and the IMF badly. And this is not what the world's poor are telling us that they want. So I had the fortune to work together with Nobel laureate Tom Schelling, and he often asked the very simple question: how do you best help poor people? Through development policy or through climate policy? Remember, climate policy costs hundreds of trillions of dollars, and it shaves off a tiny fraction of a degree in a century's time. Development policy, like avoiding death, costs just billions or maybe even just millions of dollars and save lives right now. And that, of course, is why development policy often is much, much better if you actually want to help poor people. And of course, it also builds much more resilience. Look, a hurricane that hits poor Haiti kills hundreds of people. The same hurricane hitting rich Florida kills virtually no one, because prosperity protects people. And so we need to get this conversation back, and I think this is exactly where the IMF and the World Bank needs to get back to their core missions.
I think it has to be resiliency, supply chains. Again, I think both the IMF and the World Bank have an important role in understanding this debt loop and downward spiral that many countries are in. Several countries, one in particular, have done the equivalent of a loan-to-own program with a lot of these countries, and there's a lot of undisclosed debt. There are a lot of tolling arrangements that are unfortunate, and I think only these multilateral banks can effectuate that. But again, I do want to congratulate them. The IMF was willing to say this time it's different with Argentina, and Argentina's been a fantastic success. They're accumulating reserves every day as we speak. The tens of millions of people there that are being brought out of poverty. The government of Javier Milei, I'm very interested to see, it was the poorest elements of Argentine society who voted for him this time around, and the young people. So there's optimism there. And then the IMF is working on bringing Venezuela back into making it look more like a normal economy, and I think will play a very, very important role there. And the World Bank leadership in terms of energy and unlocking resources and stability for the very poorest countries, I think is back on a good trajectory.
Yeah. If you don't mind, I'll pick you up on that energy point, because last October, you withdrew the United States from the Green Climate Fund because, in your words, their goals run contrary to the fact that affordable, reliable energy is fundamental to economic growth and poverty reduction. And I think that sort of shows the general point of, we often forget how energy really powers modern life. It warms us in the winter, it cools us in the summer, it transports us. I mean, I look around this room and I think pretty much everyone is from somewhere else, and this is what energy does. Energy allows us to live better than kings of the past. Energy really is prosperity. Yet, the climate fixation that we've been talking about means that both the World Bank and the IMF has pushed for a rapid shift away from fossil fuels and towards renewables, and for total ban on fossil fuel investment. And I think they need a reality check. There is no transition taking place. Globally, we use more renewables, yes, but we also use much more fossil fuels. The world still gets more than 80% of its total energy from fossil fuels, and the decline is so slow that on current trends, we will only get to 0% in 4 to 10 centuries. Germany has spent famously 700 billion euros on its energy shift since 2002. Electricity prices more than doubled, and yet Germany's energy is still 79% fossil fuels. China produces most of the world's solar panels, wind turbines, and electric cars, But much of this, of course, is produced with coal. China's energy is still 87% fossil fuels.
I would say a Chinese EV is a coal-powered vehicle.
A lot of it is in China, and of course, especially some places which are driven enormously on coal, for instance, India. They emit more. But the real point, I think, is that poor countries want to get rich like China did. They want to use more energy, and much of this will be fossil fueled. They don't want to copy Germany, and they don't have 700 billion euros to blow on climate policies. So forcing poor nations into renewables that even rich Germany or China aren't achieving is just simply hypocritical. In your IIF speech last year, you called on the World Bank to focus its efforts on expanding developing country access to reliable and affordable energy, and you criticized its climate targets. You noted that the IMF devotes disproportionate time and resources on climate, even though it's not part of the fund's mission. So what have you seen from the bank and the fund in these areas since your speech, and what more do you expect from them?
Again, as I said earlier, I think the World Bank has made a good pivot. They are now pushing, or they are a proponent of nuclear energy. I'm not sure how that wasn't considered a renewable for so many years. I mean, if you look now, France is powering the European energy grid, and their reactors are running the full blast.
And they're also one of the cleanest.
And it's one of the cleanest. But when you think, the Europeans got into this terrible recursive loop because they decided to turn off their nuclear energy. The Germans became more dependent on Russian crude, and then the Russians were selling them the crude to finance the war against them. So, but I do think that the World Bank is moving to an all-the-above energy process and program, and again is getting back to the core mission of lifting people out of poverty. And I would just say too, I always find it's very good to follow not only what people say but what they do. And Bill Gates, who for a long time had pushed this climate agenda, again has also changed tack. And if you read his recent speeches, he believes we're going to innovate our way out of this. And if you look, I think the Gates Foundation has something like 13 billion of investments in energy innovation. And look, no one's expecting Deus ex machina one day and everything will be fixed. But in the U.S., we were going to run out of
everything.
Well, we're going to run out of everything, but we were going to run out of the crude derivatives, and then fracking was invented, and now the U.S. has the larger reserves than Saudi and Venezuela. On the other side, the IMF, I think, getting back to this message of stability, of monitoring global imbalances, of stepping in early, and I didn't always agree with Ben Bernanke's monetary policy, but what I always admired with Federal Reserve Chairman Bernanke was he had a framework. And you could almost see, if you ask him a question, he ran it through his framework, and everything was always consistent with Chair Bernanke. And I think with the IMF and the World Bank, the framework needs to always be consistent.
Yeah. I think, and on the Bill Gates point, I think really two things stand out. First of all, the innovation point that you just made. I mean, this is what has always solved the problem. Tim mentioned the green revolution that we had in the 1970s when we worried about running out of food. Remember, we didn't fix the problem of the world not having enough food by telling everyone, I'm sorry, do you mind not eating as much? And then we'll send it down to whoever it is that we worry about. The point was that we innovated a way to generate much more food. And of course, we'll do the same thing with climate. we are going to solve big problems through innovation. That's how we've always done it. But I think another point that Bill Gates made, which I think is incredibly powerful and useful when you talk about climate change, is he said, we've for so long been talking about climate as if the point is to cut carbon emissions or to reach a certain temperature limit. No, the point is to make the world better for humans. And there, the question is, do we make the world better for humans by cutting carbon emissions by whatever tons? Or do we make it better by, for instance, making sure small children don't die? Or that children get better educated in school. There's so many other ways that we can also do this, and this, of course, reflects back on the IMF and especially the World Bank on what can be done, and there are just so many incredible things that we can do first.
Yeah, again, I think keeping the main thing, and not getting distracted, but because it feels good, it's convenient, it's kind of part of the Davos consensus, which much of the Davos consensus seems to have been shattered.
Yes. So I want to just take us to our third and last point and talk about trade-offs. Because all international financial institutions need to get back to the core point of trade-offs. Look, the money that the World Bank spends on a solar panel can't be invested in healthcare or education. And the world's poor tell us very clearly not to focus on climate first. When Africans are asked in the Afrobarometer on what worries them the most, climate change came almost at the bottom. A vast survey of more than 50,000 Africans across 39 countries found that climate change ranked 31 of 34. The top concerns are not surprising. There's unemployment, the economy, health, education, poverty, roads, electricity, hunger, and corruption. And then it goes on for a long time until you get to 31, which is climate change. When your child might die tonight from a preventable disease, no family cares about shaving a fraction of a degree off global temperatures in a century from now. Elected leaders of poor countries tell us the same thing. In a large survey of low and low-middle-income countries, they show climate ranks 12 of 16 issues. Even the World Bank's own client surveys show climate ranks low. So international financial institutions should get back to focus on their strengths. As you've said, the World Bank should focus on poverty reduction and the IMF on macroeconomic stability. But the world's poor are very clearly saying, don't focus on climate first. So from your perspective as Treasury Secretary, how do you view the international financial institutions and their effectiveness in general, and the bank and the fund specifically?
Again, I would also highlight that it's not a unique survey item among the world's poorest. Germany instituted very, very strict remodeling and rebuild requirements for German households. So you had to spend, I can't remember, it was 30, 40, 50,000 euros to upgrade to a more green house, and they're all getting voted out. So privation is not a good motivator. But again, I do think that we are determined, as I said last year, with the multilateral institutions, the banks. The U.S. wants to be in it to win it. We want to be good partners. America first does not mean America alone. And we want to go back to basics. And these banks were invented around Bretton Woods, which was post World War II. Europe was, and Asia was a unique time in America, and it led to incredible prosperity across the world. So, why can't we do that again? And why can't we focus on growth? Like, what are the tools? What is hindering growth of these economies? Is it the unsustainable debt, which is the IMF? Is it the poor infrastructure, health and hygiene, which is the World Bank? Because I think for a time, we kind of skipped the foundational elements and tried to jump to something else, kind of luxury beliefs, in terms of if a government was not able to fund itself, or if people are not able to feed themselves. And I think we've just got to get back to that. I think Ajay and Kristalina have gotten the message and are moving forward in a very, very constructive way, and I want to congratulate them.
Yeah, no, that's great. And again, when you have to decide what to do, obviously, I'm an advocate for cost-benefit analysis, so I'm going to be sitting and saying they should be looking at it. But really, if you think about it, the World Bank and IMF used to be world leaders in cost-benefit analysis, and it makes sense. If you only have limited money, if you have to think about trade-offs all the time, you have to ask yourself, where can we spend scarce resources and do the most good in the world? And this is exactly what cost-benefit analysis does for you. It allows you to pick out the really, really good policies and make it just much more likely that we can actually achieve all these goals that we're talking about.
Well, yes, and I think projecting anything that if you look, economists have trouble projecting 3, 6, 12 months, whether it's my economist at Treasury, whether it's the IMF or World Bank economists, and try to project something so far into the future. If you think about a y-axis and an x-axis, what we're really thinking about is the z-axis in terms of the trajectory. And why does the trajectory matter? Yes, the climate does change. As we all know, the natural habitat for the Earth is actually water. Ice was probably it's a very long cycle, but ice was an unusual cycle. And we are going through cycles, and I believe that it is very difficult to deconstruct the reasons around why anything changes, but I think we've got to step back. What do we know? We know it's changing, and how do you increase resiliency?
Yeah, exactly. And resilience really comes from more prosperity. And at the end of the day, of course, yes, climate change is a real problem, but if you're poor, if you have all these other problems that you struggle with, and you're vulnerable to disease and corruption and bad education and so on, these are the things that we can really help people with first. And so this is where both the world's poor is telling us we should focus, and this is where we can do the most good. And the cost-benefit analysis very clearly says this is where we should be spending our money.
Look, I couldn't agree more. U.S. foreign policy got off course at a point in Afghanistan that it became a social mission, and the mission was, okay, we have to do this in the schools, and we have to have these goals. And now, like, Afghanistan's fallen back into ruin, and what we should have done was try to make a sustainable government rather than try to, from the top down, overlay our values on a completely different system. I think we could have gotten a very different outcome.
I noticed that we've run out of time, but I wanted to stop you when you said, I couldn't agree more.
Right. So
thank you.
Well, thank you. And again, my message is, I think that both of the institutions.
All right, that was a half hour of your life that you're never going to get back. Treasury Secretary Scott Bessent speaking at the Institute of International Finance in Washington, and I don't know what to tell you about that. Let's focus back on markets, please, because we want to see what's going on with the most important equity benchmark in the world. It continues to rise, now more than 6,900. Stocks are higher now than they were on February 27th when we started a war in the Middle East. And since then, we've seen oil almost double in price. It's coming back a little bit today, but still more than $90 a barrel on Brent and NYMEX. And yet, we continue to see risk assets soar. The NASDAQ back at over 25,500, Danny.
It is incredible for us to watch stocks price out any sort of risk premium around war. In the meantime, we are looking at some individual stocks. JP Morgan, all the banks basically reporting today, not all of them, but the majority of them. JP Morgan, they had a really strong set of results. The issue for them was, though, that they lowered their net interest income guidance, but trading was huge, as it was at Citi too, and it had its highest quarterly revenue in a decade. Shares up 3.25%. Wells Fargo, it missed on basically everything, so shares down 4%. And then there was BlackRock, notably not a bank, an asset manager. It had $130 billion in client cash in the first quarter. ETF inflows surged. As we know, retail has been trading heavily in the first quarter on the market volatility.
All right, so we are focused on the banks right now, less than Bjorn Lomborg, I'm sure. But we're seeing real movement in these shares, and also what would be one of the biggest mergers that we've seen, and what would make the biggest airline in the entire United States and the entire world. In fact, if United and American got together, which is the Bloomberg scoop, that the CEO of United, Scott Kirby, has pitched this to government officials, normally the kind of thing that wouldn't be allowed on a competition basis, on an antitrust basis, but it looks like they might try and get this done under the Trump administration. As a result, United shares are up about 0.5% in the cash trade, American up more than 5%. So some real news out today. Joining us as earnings season ramps up is State Street Global Chief Investment Officer Lori Heinel. Lori, I'll get to the banks first because we've seen, again, kind of a mixed picture, as we did yesterday with Goldman Sachs, from JP Morgan, from Wells Fargo, from Citi. What's your take on how the biggest banks in the world are operating here?
Well, look, I think this is part of a broader view around where do we see the economic recovery going from here. There was a lot of concern that we were going to have pressure here in the U.S., particularly because of inflation. Certainly, we're worried about that as this conflict continues. But I think on balance, banks have lots of different ways that they can capitalize on this environment, including a lot of the market making activity, which has driven some of the results.
Lori, I was listening into the media call with Jamie Dimon, and he was saying to reporters, he got asked the question, at what level do you see stress for this consumer, especially when it comes to gasoline prices? He basically said that there's no level. There's no level of gasoline that would worry him as long as jobs remain plentiful and the labor market remains strong. Would you agree with that, too, that things like consumer-related companies or really this American economy can be held up regardless of what gasoline prices are as long as this labor market doesn't crack?
Well, there certainly are stresses, and particularly if you disaggregate the American consumer into those that are in a better position and those that aren't. So I would agree completely with the assessment that jobs matter, and we've been watching labor markets quite closely for many, many months now, both as signals of the U.S. economy, but also as signals of what the Fed might do. But increasingly, you have a lot of concentration of wealth. You've had markets that have rebounded radically, as we've just talked about, and then you also have a situation where a lot of these consumers already own their homes. They're seeing price appreciation in the aggregate over the last several years. So they're feeling pretty flush. I wouldn't, however, say that none of the consumers are impacted by higher energy prices. Certainly at the lower end of the spectrum, that is a concern.
What do you make of the Fed here as we see, the price of gasoline, the price of oil rise? It's not too dramatic at the pump. I'll remind our viewers that it was $5 and change across the national average in 2022, and it's only about $4.11 today. But it still is something that the Fed is going to have to contend with as the labor market looks fairly strong. I mean, still 4.3% is a fantastic unemployment number, and we added almost 200,000 jobs last month.
Yeah, I think there are a couple of things there just to pick up on. I mean, certainly the amount of paycheck that goes towards energy is just nothing like what it once was. So in addition to the fact that we're not at that $5 threshold, coupled with efficiency gains and gasoline consumption and things of that nature, all in all, it's not as big of an impact. But I think that there is some concern that inflationary pressures may not be as short-lived as we think. And if you look at just some of the underlying dynamics of what was driving having the latest CPI number, there were some disinflationary things around things like used vehicles that probably are going to roll off. So I think we're in this window that for the next few months, the Fed's going to be on hold because the inflationary pressures will feel a little bit more immediate, but we still hold true to our call that by the end of the year, the Fed is cutting again.
I guess, Lori, and that makes sense, and you do see two-year yields remain elevated because of that concern. But that gets to this odd cross-asset picture, where as we've been talking, stocks are back at the levels they were before this conflict. You look at what oil has done before the conflict. It was hovering in the mid-60s. Now it's in the high 90s. And two-year yields, they were about 3.4%, are now near 3.8%. Doesn't make sense, even if you expect some things to dissipate, that you have yields and oil still under pressure while stocks show none of it.
I think there are a couple of things that are happening here. First of all, and you've talked about this at the top of the program, is that earnings are actually looking pretty good. So if you actually look at the re-rating that we had when markets pulled back earlier this year at the start of the conflict, coupled with actually improvement in earnings outlooks, you've actually seen stocks look relatively attractive. And then when you layer in some of the other themes around artificial intelligence and other ways that productivity gains can happen, that paints a relatively good picture. But as you also know, this conflict's far from over. And so there is still risk that we have another shoe to drop, if you will, and that the energy constraints become a real problem globally, not just here in the U.S.
You know, we talk so much about the broadening out, Lori, but I'm looking at the index here since February 27th and seeing that even though we're up, we only have 175 stocks that have gained in that time, and the rest are down. Obviously, energy has been a big beneficiary of this war, and the AI trade is something that benefits the economy greatly, but not necessarily all of the people in it. What do you think about the idea that we're still seeing a broadening out trend in terms of earnings growth?
So we are fans of that broadening out trend, and we do think if you look at just the gyrations of market, it has been a little bit hard to parse that out. But if you look at some of the underlying factors, things like quality have done better. Value year to date, even though it's had a little bit of a lag in the last week or so when we had the sharp rally again, value stocks have done a little better. Now, that doesn't mean that the tide lifts all the boats, but I think that there is this kind of growing broader input, whether it's, an economic recovery that we thought was going to have more legs, but now is threatened by the Iran conflict. But that kind of broader sentiment, we think, is something that investors should still focus on for the longer term.
Lori, we're going to have to end it there. Thank you so much for joining us, State Street Global Investment Officer Lori Heinel. Let's get a check on your equity market about 10 minutes into your trading day. And we are looking at gains 0.4%. We are less than 1.5% away from all-time highs, a remarkable turnaround for this market, as we've been discussing, that is now back above the levels of where we were pre-war. The best 9-day streak, it has been up for 8 of those past 9 days, but the best 9-day run since Liberation Day. Microsoft, Amazon, NVIDIA all having good days. Amazon with a new deal to buy a satellite operator. Oracle is in the top pick too. They are now going to be buying energy from Bloom to power its AI data center. So that gets a big boost of more than 7.5%. BlackRock's also up, as is Citi, both reporting strong earnings. On the downside, as oil prices fall, so too do the oil majors, Exxon and Chevron in their Wells Fargo disappointment for their earnings. Shares down 5.33%. Walmart is also down. Intel is down after a big run for Intel, where they added a huge amount to their market cap, about $100 billion. Let's look at some of the sectors. Consumer discretionary having a very nice day too, maybe as oil prices come down. Infotech, a good day for them. I point out some of the big caps, but I should also note that software, IGV, the ETF, is up nearly 3% today. To the downside, it is energy. Staples are down. I point out Walmart down. Energy down 2.7%. Again, Matt, for an overall index, which is looking for another day of gains.
Yeah, I mean, 60 points away from an all-time closing high. 69.68 is what I see there back in January. So coming up, Jamie Dimon says the U.S. economy remains resilient, but there's an increasingly complex set of risks. We'll discuss today's bank results with Baird analyst David George. This is Bloomberg Open Interest.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
15 minutes into your trading day, let's see what the sell side has to say with your top calls this morning. First up, UBS. They upgrade Tesla. They say the stock looks more fairly priced after a stretch of worries about weaker EV demand, higher costs, slow progress on projects like robo-taxis and Optimus. The firm, though, still expects that those bets will improve over time, and they see Tesla as a long-term AI leader. A nice little share pop for them today, up 1.7%. Next up, Morgan Stanley says that U.S. steel stocks are looking stronger thanks to higher prices and tariffs. The firm is raising its price target on Nucor, Steel Dynamics, and Reliance. Shares up as much as 1% this morning. Finally, Wall Street is weighing in on BlackRock's strong quarter that sees their shares up nearly 4%. TD Cowen points to lower taxes and solid inflows. KBW highlights higher fees and lower costs. Evercore says that better management fees and leaner expenses show that the business is performing well. Matt.
All right, JP Morgan trading revenue beat, and traders posted their highest ever quarterly haul. The bank, though, cut its net interest income guidance back down to where it had been before it last raised its net income guidance. Let's take a deeper dive into the bank earnings. Joining us now is Baird senior research analyst David George. He has a neutral rating on JP Morgan with a price target of $290. And David, let me just start with the net interest income. What is it? Competition? Is that the holdback here?
Yeah, good morning, Matt. A couple things. Loan growth is maybe a little bit slower. Deposit costs maybe a little bit higher. I think markets revenue and the tightening of spreads is also having an impact. I would caution market participants or viewers of the show this morning to not get too worked up about $1 billion NII swing. I mean, the bottom line is this is over a $2 trillion balance sheet. They could print any net interest income number they want. I think they're just trying to be conservative and thoughtful as it relates to kind of capital allocation going forward. But overall, Matt, the quarter was pretty good.
And I mean, huge trading numbers across the board, David, for all of the banks. In the media call, we heard from the CFO of JP Morgan saying, I wouldn't extrapolate these out. We don't know what the environment is going to be like. How are you viewing the trading desk and these trading revenues? Obviously, there was huge volatility in the first quarter. Given the macro stresses we're still expecting, how does your outlook appear?
Well, we feel pretty good, Danny, about the capital markets outlook. There's a lot of M&A that's been announced in very large scale and very diverse from a sector perspective. And with the markets coming back, equity capital markets should also be relatively robust. You know, the trading numbers, to your point, probably aren't sustainable, but nonetheless, they were very good in the first quarter. It seems like many, many moons ago, but we had significant volatility in gold, silver, oil, rates, equity markets, vol, and you know, the money center banks, JP Morgan specifically, really benefited from that this quarter.
In terms of the war and the warnings on geopolitics, I mean, does that really provide any headwinds to JP Morgan? Is it only, you know, the weakening of the consumer for slightly higher prices at the pump?
Yeah, I think you just nailed it. From my perspective, at least, I think the major kind of lingering issue and I'm clearly not a geopolitical expert, but to me, the biggest concern that I would have in terms of the macro from a credit perspective is how long do oil prices stay here, and the related impact on the consumer, but also supply chains and just kind of how, as you both know, higher oil prices kind of manifest themselves in a number of different inputs. And to the extent we stay elevated, to what degree does that have an impact on inflation broadly and corporate profit margins as well?
David, just a minute here, but some of the other headline risks that we've been watching for the banking sector, and a reason that shares had been weighed down earlier was private credit exposure. We had some details from banks, Citi out, saying that they have $22 billion worth of exposure to private credit. Wells Fargo goes even into more granular detail, $36 billion. They say only 17% is software. Is there any reason to be concerned around private credit exposure?
We're always concerned about credit, Danny, but from my perspective, the private credit, and I'm not trying to be dismissive, but the private credit fears that market participants have, I think are, we say, overblown, particularly given the size of these exposures and really the nature of these exposures. A lot of these are among the lowest risk loans on these balance sheets. These could be to large insurance companies. These could be capital call lines to private equity companies, which are extremely, if not zero risk. So it's not something that we spend a lot of time worrying about. Again, oil and the related impact on the consumer and corporate profit margins is really where we're a little more focused at the moment.
David, thank you so much for joining us. That's Baird Senior Research Analyst David George off the back of earnings from the big banks. Later today, catch the CFO of Wells Fargo. He'll be on the close at 3 p.m. New York time. Coming up, more corporate news. United CEO Scott Kirby pitching a possible combination with American, something we would not have even dreamt of in past administrations. We're going to get the details next, right here on Bloomberg Open Interest.